Of Ukraine and the United States taking that potential deal to Russia. We will see how that plays out for markets more broadly. Puma certainly in focus, warning in terms of the first quarter EBIT. They're citing trade and FX volatility. Yes, there is also a one-time cost for efficiency efforts, but they are talking about these big global themes. And Zealand Pharma, could that be a big gainer at the open, Guy? A deal with Roche?
Absolutely. Some single stock names you definitely want to focus on this morning. Let's talk about the broader market open. It is time for the opening trade. Let's show you some numbers, give you an idea of what is going on. The tailwind coming out of America is positive. That should propel Europe along this morning. Defense sector firmly in focus as well. Keep an eye on the consumer story more broadly, though. You've got Inditex out with numbers. You've got Puma out with numbers. That is an area you want to focus your attention. The Stock 600 is up by 0.3%. The FTSE, as indicated, underperforms a little bit, only up by 0.2. The IBEX, though, is up by 0.6%. What is Inditex doing this morning? We'll find out in just a moment. The CAC is up by 0.8%. So we are seeing some positivity emerging here in Europe, but it's a big day coming up. Are we getting a reaction from the White House on what the EU has announced this morning? We heard from Ursula von der Leyen an hour ago. What is the US CPI print going to deliver? So a long way to go, but these are the early indications from a session that initially, Kriti, looks positive.
Absolutely. Green on the screen across the board, at least to your point, the early indications. We still got about 3 minutes to go before the DAX does open. Right off the bat, though, when you're looking at some of these movers, I'm not seeing a real narrative. I'm not seeing a ton of kind of outperformance in one sector over the other. 429 stocks approximately higher, 78 lower. Across the board, though, telecom seems to be your laggard this morning. You're also seeing an eye on, when you look at the sector picture, and the basic resources, I think, and construction materials seem to be the outperformer from a sectoral basis.
Yes, absolutely. I was just looking at what's driving some of those, and construction materials, we've got a real outperformance by Balfour Beatty, one of the UK listed businesses. In fact, off the earlier highs, but it has opened strongly, and they put out numbers, so that's an earnings story coming through there. Interesting, away from construction and the basic resources, which of course includes some of the metals businesses. So ArcelorMittal up by 2.4%, which I find interesting this morning, given we've seen the imposition of these tariffs from the United States on Europe, and then Europe hitting back with countervailing tariffs against the US. But a lot of the fear is, well, what does this mean for Chinese product and other product from cheaper locations in Asia? Will that find its way into Europe to compete with some of the European manufacturers? But that doesn't seem to be weighing on sentiment this morning.
It's interesting that the Chinese are telling Walmart, don't expect your suppliers here in China maybe to provide lower prices in order for you to get around the tariff story. Is that an indication that maybe the Chinese don't want to take the hit here, and they want others to take the hit? So that'll be a fascinating story. Defense stocks are down. BAE Systems, Leonardo are two big stocks that are lower. You've got Thales lower as well. I talked about earlier the fact that the defense stocks are a big driver in Europe. This morning, that's a negative momentum story rather than a positive momentum story.
The exception to that is Rheinmetall, higher by 1.4%, but really fighting the momentum on that. You bring up Walmart, though. I feel like we should take the show on the road from a Walmart, perhaps, and not just look at the China piece, but look at the American consumer piece as well. Walmart outperforms in a recession. That's the
theory.
It has in the past, at least from a stock perspective, because it's those everyday low prices, which is literally their commercial motto. So we'll see. I'm a little obsessed with Walmart.
But they've got to deliver the low prices is the point that I got to make, which is going to be the struggle if the Chinese are basically saying, don't expect us to foot the bill for that.
Absolutely, and they have an entire kind of fuel component as well, because there's gas stations across the country. So there's an energy story there as well. So plenty to watch for when it comes to that consumer story, especially on this side of the Atlantic. I'll just quickly mention here that the DAX is officially open, higher by about 0.8%. A lot of that driven by some of the defense story. We're going to let that shake out a little bit and then come back to it. In the meantime, let's bring in a true expert. Matthias Born, head of investments and CIO for equities over at Berenberg, joins us around the table. You picked a great day. The markets are flying. They're very happy this morning. Is this going to last?
I would say shorter term markets could struggle a bit. Yeah, so Europe has gone a bit too far shorter term. Yeah, so the outperformance of Europe versus US was massive. One of the biggest outperformance periods, or in terms of the extent in such a short time frame ever over the last years. Yeah, so therefore shorter term, I think markets could be struggling, and for sure shorter term. It was a momentum sell-off in the US, so therefore that was also beneficial for Europe. So therefore, if markets are rebounding, for sure, US will rebound much sharper than Europe. Yeah, so the midterm picture, I would say, looks better for Europe still, from my perspective. Yeah.
We're now the second guest to talk about the medium term or the midterm as well. Let's go a little bit more short term than that. Yeah. Let's talk about 6 to 9 months down the road. When we look at a stock market sell-off, as you said, a momentum-driven sell-off perhaps in the States, it usually, at least in theory, is pricing in some sort of recession in 6 to 9 months. Is that a viable reaction? Is that fair?
I would say, first of all, the sell-off was driven by two parts. Yeah, it was the tech sector in the US, which is maybe not the recession fears that were affecting the tech sector. It was DeepSeek in the first place, which was affecting the tech sector, and for sure also the tech sector was the best performer now over a long period of time. So therefore, for sure, some momentum is here going out of the sector. Secondly, recession-wise, I would say playing a correction of the economy in the US is fair. If it's a recession, to be honest, I don't know. Yeah, so a correction is fair to play at the moment, and that's what markets are doing. Yeah? A recession, I would say, is not priced in so far. Yeah.
What is a correction of the U.S. economy as opposed to a correction of the stock market?
It's a slowdown. It's a slowdown of, let's say, the U.S. economy may be going down slightly over the first quarter, the second quarter this year, but not dipping into a recession. Yeah, so and that's what we see. So also markets are in correction mode. They are not in bear market mode at the moment. Yeah, so that would be the case if we are pricing in a recession for sure.
I can ask you about the global consumer, because we're looking at European markets this morning, and one of the big standout sectors to the downside is retail. And we've had numbers out of Inditex, we've had numbers out of Puma, and they both look really weak. The Puma share price down 22% at the start of trade until it was halted. Inditex looking weaker, and that's obviously a real heavyweight, the biggest listed global fashion retailer. Are we seeing something quite negative at the start of 2025 on the consumer, and will it just get worse as uncertainty continues?
Yeah, uncertainty for sure is one topic, and it's both affecting consumers in the US also. That's part of the downturn in the US, but it's also affecting European consumers. But also the stories you mentioned, like Puma and so on, are more, I would say, also stock specific or sector specific. So the sporting goods industry, for example, has been in a weak period for a while because of overstocking in that part of the market. And also for sure, these companies are affected potentially by tariffs in the US or tariffs of China. They are sourcing products from China, and they have a big proportion of their sales in the US, which is for sure not a good place to be in if tariffs are coming in.
Yes, and Puma citing that very thing just this morning. I suppose I wonder how much, because we're talking, yes, so that's on the cost side of things, and maybe the prices have to go up. And so it sounds as if there could be more negativity for the consumer to come. So whatever we're seeing right now, is it just the start of something?
I think it's the start of something if tariffs are coming, yeah, because then the consumer is affected much more. I would say in consumer, the safe play there at the end is luxury. Yeah. It's the safest play in consumer because they are able to put through prices quite easily, usually. Yeah. Hermes and other brands are easily putting through prices if tariffs are coming in. So therefore, if I would be in consumer at the moment, I still would be in luxury, in European luxury names.
If I don't have to be in equities, should I be in equities?
I think it's a good time to invest now after the correction.
Right. So you're buying the dip. You want to buy. You're happy to buy the dip.
Yes, I am. Yeah.
At these kind of levels.
Yeah.
Should I be averaging in? How should I be playing? Is this a moment that is going to exist for a while? i.e. we're going to be down here for a while? Do I have time? Is it going to be a V-shaped recovery in terms of the stock markets? How should I be? What are you thinking about in terms of what you see in front of you?
I think especially, I would say, if we look to Europe, so Europe has some upside scenarios. So the upside scenarios are fiscal stimulus in Germany.
Yep.
It's ceasefire in the Ukraine.
Yep.
It's potentially also China stimulus. And that could also serve for a good earnings recovery in Europe throughout this year or into the next year, because fiscal stimulus at the end will be not there this year. It will affect earnings maybe in 26, 27 and the economy overall. So therefore, there's a good upside scenario from all of this. And therefore, I would say Europe could outperform, as I mentioned before, more medium term, maybe not short term, because fiscal stimulus will hit the economy in 26, 27.
The DAX is up in dollar terms 20%, 19% year to date.
Yeah.
Is not all of that in the price already?
Yeah, shorter term, I would say yes. Longer term, Europe and especially also Germany. Look to German mid-cap stocks, for example. They have been in a downturn for a long period of time. There have been outflows out of German stocks. They have German funds, German equity funds. There have been outflows out of European equity funds. European small cap funds, it was one of the longest periods of outflow. So I think there's still potential in terms of positioning of investors globally, that flows are coming back into Europe and flows are coming back also into Germany after that long period of outflows. Yeah. So therefore there is still some remaining potential over the year and into 26, 27 maybe, if fiscal stimulus and ceasefire Ukraine will be also helping markets and helping also European markets and earnings. So because there is a potential impact on earnings of, let's say, 5, 10, if not more percentage points of uplift of European earnings, and that would be the driver, because valuation alone is not the driver, it's earnings.
It's been cheap for a while. Cool, nice to see you, Matthias. Thanks for joining us around the table this morning. Matthias Born, Head of Investments and CIO for Equities, joining us from Berenberg. Core 6 looks like this. We've seen strong performances over the last couple of days from some of the tech stocks. That continues this morning. ASML is up again. Schneider is up again. Schneider rose yesterday. Today it's up another 2%. Novo's a little bit softer this morning. You've seen the Zealand Pharma deal that we've announced, or talked about, not announced. We didn't announce it. We just brought you the news a little bit earlier on. But broadly, it looks like European equities are higher. But there's some quite significant volatility out there with a single stock name this morning. Joe Easton brings us that.
So Zealand Pharma guy, as you say, really the big mover in the market today. A massive jump for this stock. It's up 30% at the moment over in Copenhagen. Now, this is kind of one of the smaller, lesser-known obesity drug providers around the world, but it has got this big deal with Roche, potentially worth around $5 billion. Roche previously did buy another US company that was doing obesity drugs a couple of years ago, and now this looks like their second deal in the space. Zealand Pharma, their biggest gainer that we can find this morning, up around 29% now for that one. Then in terms of Puma, that one looking really, really rough at the open. It was down 22%. I saw it going into a bit of a trading halt. Does seem to be ticking now, at least it is down 22%. There we go, down at a low of 22.29 euros. Another profit warning, the second one this year, according to analysts. And then we're going to go over to Inditex, the Zara owner, not looking any more cheerful over there on that one, unfortunately. But this is a much bigger company, bear in mind, 150 billion euro market cap, one of the biggest clothing retailers in the world. So a 7% drop in Spain for Mancio Ortega's company, really hitting his wealth and that stock today. We're down 7%, the Zara owner, seeing a slowdown in sales, kind of predicted actually by analysts heading into that, and potentially more discounts over the winter period as well, hitting that one. Then in terms of shipping stocks, that one caught my eye this morning because the Houthi rebels once again threatening to resume attacks on ships, Israeli ships heading through the Red Sea, and potentially meaning there is going to be more disruption in that area. Remember, it is kind of a little bit of a perverse situation where the higher shipping rates come up because of disruption. This actually positive for shipping stocks. So we're seeing a little bit of outperformance in AP Moller-Maersk and Hapag-Lloyd following those headlines today. Then a couple of downgrades to bring you. IAG, as we mentioned earlier, and Lufthansa cut at Barclays to underrate. Barclays does cite those two profit warnings we saw from the US yesterday and the day before, Delta Airlines, American Airlines. They say there's going to be a read across from those into Europe, so they downgrade the North Atlantic exposed companies this morning. And then finally, in defence, it is a broad move lower given some of those headlines that we've seen, of course, around the ceasefire, but also Leonardo downgraded at Kepler Chevrolet today. They go to hold, previously buyers for a long time, but of course, we've had a massive rally in that stock. So Leonardo, probably one of the worst performers on defence today, down 3.6% in Milan this morning.
Joe Easton from our equities team, we thank you so much, walking us through, of course, some of those early movers that we are seeing in the European session. At the same time, we are getting some early indications when it comes to the U.S. session, at least in terms of pre-market trading, because of that change, the time change that we're seeing. A big move already when it comes to the chip sector. It looks like TSMC, these are according to just reports, not confirmed yet from these companies, TSMC reportedly proposing a joint venture with NVIDIA and some others, including AMD and Broadcom, to manage Intel's foundry operations. Now, this is a really big deal. We know Intel has had a very long turnaround story. Pat Gelsinger really trying to get some momentum into that company. Those shares higher by 7.6% off of that story. NVIDIA also higher by now 0.9%. You're seeing boosts in the numbers from Broadcom and AMD as well. Dell Technology, I want to give a little bit of love to this morning, higher by 1.2%, not because of any fundamental news, but because Mike Dell actually commented off the back of some conversations with the Trump administration, saying there are more conversations happening this week, and specifically with Doge as well. That is your positivity this morning, those pre-market U.S. stocks. Let's talk about the negativity. Guys been talking about it all morning when it comes to Walmart and that move and that concern around what price cuts what price hikes, should actually mean, specifically when it comes to the Chinese market. Those shares down by about 0.7%, but in a broadly positive market on both sides of the Atlantic, at least in pre-market and in early signs of Europe, Walmart is the underperformer.
Coming up on the program, we'll take a closer look at the defense sector after Ukraine accepts a U.S. proposal for a 30-day ceasefire against Russia. Of course, this has not been put to the Russians yet. We'll see what President Putin has to say about the proposal on the table. More on that next. This is Bloomberg.
Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back to the opening trade, Wednesday, the 12th of March. It is only Wednesday. The European equity markets are trading higher this morning, off earlier highs, perhaps a little. Novo Nordisk battling it out with Inditex to be the biggest weight in a point sense on the Stock 600 right now. Some competing narratives around where the gains in obesity are and where the weakness in the consumer is, and that's certainly one focus. So that's the overall picture then, Guy, in terms of where we are on these markets. But the defense sector, there's quite a lot happening sort of beneath the hood when it comes to defense stocks.
So what is interesting, what I think is really interesting, so Rheinmetall this morning is the one stock that stands out to the upside. So it's talking about very strong numbers going forward from here. But actually what the margin number told us was that actually there is going to be a struggle in terms of the ramp here. It's going to cost money, and that is going to be a factor that I think a lot of these defense companies are going to have to deal with. But elsewhere, you are seeing Leonardo, which just had numbers, BAE, which obviously has a huge component, obviously, in the United States as well, so you need to think about that slightly differently, and Thales, all under a little bit of pressure. So it's interesting to see what the mix looks like here this morning. But my takeaway on on Rheinmetall was fascinating, what it's saying on that story. Am I looking at the right? So Rheinmetall in and out,
yeah, but it's completely fading its early gains. So it was fighting the curve, and now it's getting on board. Yeah,
Unch.
It's Unch, then positive, then down quite a lot. But if you still compare it with what else we're seeing in the space, other stocks down 2, 3, 4%, it is still flat. Flat in a market where everything else is falling feels like a win. Let's talk about the deal could be spurring some of these moves as well, which is the fact that we could potentially see a peace proposal being pushed through in Ukraine. Ukraine has accepted this 30-day truce with Russia. It comes with the idea that maybe we see a lifting of restrictions on weapon shipments and intelligence sharing. The US is now going to take the proposal to the Russian President, Vladimir Putin. Will he agree? Let's talk about the details of the deal, because that maybe gives us a good starting point. Ollie Crook joins us in Berlin. Ollie, what do we know?
Yeah, so listen, a couple of things. We should just say that this was not what the Ukrainians wanted. They've been saying repeatedly until that sort of blow up in the Oval Office that they really did not want to have any discussions about a temporary ceasefire. What they wanted to get to the table was the ultimate, lasting, just peace proposal to sign off with the support of the Americans with the Russians. That is, of course, not what materialized after that blow up in the Oval Office, and then the withdrawal of the military aid, or I should say the suspension, and of course of intelligence to the Ukrainians by the United States. That has basically forced this deal forward and into the acceptance by the Ukraine. So what it includes is a 30-day ceasefire. This is something that can be extended by mutual agreement. There's going to be some exchanges of prisoners of war. There's going to be some release of civilian detainees. This is the idea behind this, and the return of the forcibly transferred Ukrainian children. And also both sides need to now name negotiating teams to begin the negotiations for enduring peace. And this will basically now, this is if this is agreed to. What this does, though, or do right now, is it will resume the aid of military aid and intelligence to Ukraine from the United States. But now, really, the situation is that the ball is in Putin's court, right? We have Steve Witkoff, who is actually the special envoy for the Middle East, but seems to be the sort of broker for ceasefire and peace deals. He's going to head to Moscow this week, and this is going to be now a discussion for the Russians. What was interesting that we heard from Marco Rubio after these talks in Saudi Arabia is basically everybody saying that they hope that the Russians will sign the deal, and that if they don't, we'll know what the impediment to peace is. That prompts the sort of major question from the Trump side, which is what is the Trump administration willing to do if the Russians do not want to come to the negotiating table? We've heard about potentially augmenting sanctions on the financial sector, fossil fuels, that sort of thing. Could they flood Ukraine with more weapons? But again, this is a United States that wants to have less involvement with Ukraine rather than more, so it's hard to know exactly what the Trump administration would be willing to do if indeed the Russians do not want to come to the negotiating table and sign this 30-day ceasefire agreement.
Yeah, really fascinating to see how much of the US conversation with Russia is about Ukraine and how much it is about other areas, other spheres of potential cooperation or other reduced impediments to Russia. Let's talk about the earnings story and the defense companies in Europe then, Ollie, because we had numbers out from Rheinmetall earlier this morning. That stock was doing okay in the early part of the trading day, paring those gains a little. How do we factor European defense spending then into what happens next in Ukraine? Because on the one hand, there's been a sort of short-term need to spend more, and then there's the longer-term need to spend more.
Yeah, so listen, I wonder how much of the sell-off we're seeing across the defense sector is potentially about, the potential incremental step towards peace. I think it'd be hard to say. We'll give it a little bit of time to wash through, but let's just look at what we got from Rheinmetall, right? Talking about their sales estimates for 2025, looking at the year ahead. When we've spoken to a lot of the defense companies that we've spoken to over the last, couple of months, they basically forecast 10% growth annually kind of for the foreseeable future. Rheinmetall is talking about 25 to 30% growth for 2025. They're looking at margins at 15.5%. We should say that's a little shy of what the analysts were hoping for this year. They were looking for something just north of 16%, but still 15.5% is more than they delivered last year. And you have this record backlog, and this speaks to one of the main issues within European defense. 55 billion euros, record backlog for Rheinmetall. It is the difference between the order books that are coming in and the ability to actually get this hardware out to the clients, and that is sort of going to be the big story of the ramp up over the next couple of months and really years.
Bloomberg's Oliver Crook there walking us through the latest developments when it comes to Ukraine, but also the latest developments when it comes to that defense spending. Now, that's just one piece of the equation that Europe has to deal with in terms of an inflationary impulse. The other piece is, of course, the tariff story. Now, the European Commission has launched, quote, swift and proportionate countermeasures to new U.S. metals tariffs worth up to 26 billion euros. Adoption of the tariffs due in mid-April. EU Commission President Ursula von der Leyen saying she remains open to negotiations with the U.S.
Our countermeasures will be introduced in 2 steps, starting with April 1st and fully in place as of April 13th. In the meantime, we will always remain open to negotiations. We firmly believe that in a world fraught with geo-economic and political uncertainties, it is not in our common interest to burden our economies with such tariffs.
Let's break down the details here. Bloomberg's Brendan Murray, who leads our global trade coverage, joins us around the table. 26 billion euros on what?
Yeah, we don't know the list exactly yet, but it will be commensurate with what the U.S. is punishing Europe with regarding the steel and aluminum tariffs. The Rubicon that's been crossed here today is we now have a global trade war. It involves the major economic engines all over the globe: Europe, North America, and the big exporting powers in Asia, in China, Japan, South Korea. So what we've seen is a different response today. Some countries, like the economy, like the European Union, are saying, here's what we're going to retaliate. Here are the dates. Let's sit down at the negotiating table, or these are going to take effect. There's been a more measured approach taken by Japan, South Korea, Australia, and even the UK to say, why don't we just not threaten things right now and let's sit down at the negotiating table? We've seen this kind of hardball tactic that Canada played over the past few days versus the more measured approach that Mexico takes. So I think we're seeing 2 different approaches to dealing with Donald Trump. And who knows who's going to come out on top, but he's shown he could escalate and de-escalate the threats that he's making.
And interesting that we've seen no exemptions despite pleading by various countries. No late exemptions, just briefly, Brendan.
Exactly.
Yeah. Okay, Brendan Murray, Bloomberg's Brendan Murray with the latest on the tariff story. We continue to watch that. We were hearing there from Ursula von der Leyen about the 2-stage approach that Europe is going to introduce. And of course, we're still working our way towards those wider tariffs, away from just aluminium and steel, to a wider suite of products that the Trump administration has promised. We will think about what the tariff impact is having on small businesses. Coming up, we'll talk to the Sage Group CEO, who joins us on set next. This is Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture. It's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
This is the opening trade. About 30 minutes into today's session, seeing green on the screen across the board, but outperformance as usual. I'm almost getting a little tired of saying it over in the DAX. Also seeing the French index catch up as well. Both indexes higher by 0.7%. Your notable laggard in Europe this morning, although still in the green, higher by 0.2% on the FTSE 100. This feels like the buy the dip moment, Guy, when it comes to equity indices on both sides of the world, despite getting not so great data over in the States when it comes to small business optimism.
Is it by the dip? The gap higher this morning is pretty small.
We went from red to green.
European stocks on a 3-day basis, Monday, Tuesday, Wednesday, are still down by 2.5%. Are we going to see a sustainable bounce? We bounced a little bit, but we're now kind of going sideways. I think we're looking for the next catalyst to come through in the form of US data. We're going to get CPI a little bit later on. The data we got yesterday I thought was really interesting in terms of the NFIB data. Got that right. And I think two takeaways from that. One of which is they're still trying to push prices through, which I think is interesting on the inflationary front, taking us to the CPI number. But there's caution out there, and it's growing. And normally, I think what the expectation was that small businesses would benefit from tax cuts. They did last time around. Trump 1.0, small businesses in the States did really well off the tax cuts that came through early on.
Yes.
And you had that kind of burst of enthusiasm. Small businesses are highly sensitive to that, it seems, in the States right now. It's not coming, and as a result of which that started to show up in a bit of a more cautious
And President
approach.
Trump was pushing that with big businesses, with Wall Street, just yesterday when he talked to them. But from the NFIB, the thing that stood out for me was the CapEx number, CapEx plans at a 5-year low. And that's the kind of uncertainty that weighs, of course. That takes us nicely into our next conversation. Economic uncertainty is also impacting UK small businesses. New data from the FTSE 100 software company Sage Group reveals firms are strengthening their financial positions amid declining profit and productivity. This ahead of planned tax and minimum wage hikes that are coming next month. The Sage Group CEO, Steve Hare, joins us around the table to discuss this and many other things. Steve, very good to see you. Thank you for taking the trip down to come and see us. So we'll start on the UK because you've got this interesting tracker out, but of course, half your business is over in the US, isn't it? So you can definitely speak to that theme as well. Let me ask you about small businesses in the UK. Your research is for the fourth quarter, so we're looking at how businesses are positioning for the impact of the budget, I suppose. And you see nervousness there. Before we even factor in any sort of tariff story, you see a bit of nervousness, but businesses are protecting themselves. What's the takeaway?
Yeah, I think the starting point is that small, mid-sized businesses, they have a bias for optimism. So they
they're running their own businesses, they're trying to grow their own businesses, and they tend to focus on what they can control within their own environment. So that makes them optimistic. The flip side, as you say, though, is they can see cost pressures coming. That makes them more cautious. I think the noise, the uncertainty that we're seeing in the world, whether the UK, US, or anywhere else, it tends to make people cautious, which means that they hold back. So you can see in our survey data that people are holding more cash. If you like, they're waiting, and if they get the right environment, they'll invest. But at the moment, they're being cautious.
Yes, and waiting seems to be the theme of that NFIB survey from yesterday. Last time we spoke to you, Steve, over satellite link was November, and we just had some NFIB data then as well, and it showed that optimism about tax cuts that Guy was referencing. This time around, you don't see that optimism. You see nervousness. You see holding back on capex. Is that what you're seeing then in your clients?
Yeah, so we are seeing a bit of that. I think it's the same thing. People they're ready. They have the capacity and the capability. And, with tax cuts, there's the available capital in the US to spend them with small, mid-sized businesses. But because it's a noisy environment, because they're a bit unsure, are we going to get inflation? Am I going to have more headwinds? It tends just to make people a little bit more cautious. So if you ask them, how do you feel about the next 12, 18 months, they'll tell you they're very optimistic. But then in the short term, there's just a little bit of hesitancy.
Does that mean they don't employ people?
I think actually, there's two sides to that. One is, depending on which market you're in, there's also still skill shortages. So, when I talk to, businesses, for example, here in the UK, small business owners, which I do all the time, say plumbers, electricians, etc., they often talk about how hard it is to find the right skills to create the capacity. I mean, actually, if you talk to plumbers and electricians, they're not short of work. There's plenty of activity going on, but they need to create more capacity.
So does that mean they can push through? Let's look at it from a different angle. If there's lots of work and there's not enough supply, that usually implies price rises.
Yeah, I think the risk, I mean, again, it's, people are nervous about inflation. I think if you ask small business owners, they're looking forward, they're looking at their cost structures, they're worried about inflation. And at the same time, they're looking at, well, depending on which sector I'm in, how much can I push price through to my customers?
That's on the consumer side. What about kind of on the supply chain side? When it comes to purchasing power, it feels like so many of the large businesses are sitting on piles and piles of cash to be able to navigate that. Small businesses not so lucky. How do you navigate this environment with less purchasing power?
Yeah, so I think small businesses are sitting on more cash now, so they're kind of preparing for any eventuality. They also, when it comes to supply chain, depending on what industry they're in, there's a lot of local, people buy from each other. They buy from local businesses. They buy from other small businesses. So this is kind of a bit of a circular thing, right? If everyone's pushing price, we're going to see inflationary pressures. But at the same time, people are also focused on efficiency. So with the latest technology, investing in things like AI, etc., you can also drive your own efficiency and productivity.
So Larry Fink very famously came out early on out of BlackRock and said that if you're concerned about wages, you're concerned about labor shortages, for example, AI is the solution to all of that. Are you seeing that kind of adoption process, that replacement of labor, insulate small businesses from those risks?
Yeah, we're starting to see more take-up of AI, led by the US. There's more take-up. The US tends to be early adopters of new technology. But what we're seeing is really small businesses, the human is still at the center of everything that's going on. So what they're doing is they're using AI to automate tasks, to increase the effectiveness and efficiency of both themselves and the people they employ. So to some degree, it's countering the skills shortage. It's not really replacing jobs, because at the moment in the US, the UK, South Africa, where I was a couple of weeks ago, actually what you're seeing is this focus on increasing capacity. And AI is contributing to that.
Yeah, thinking about the UK's ambitions on AI, Steve, where do you think the UK should pitch itself? Because I remember a time when we were trying to create Silicon Valley along the M4 corridor west of London, and then we tried to create Silicon Valley, in inverted commas, in the Silicon Fens between Oxford and Cambridge. What should be the extent of the UK's ambitions on this front, realistically?
I think what we're very good at is applying the technology. So we don't need to compete with the big technology companies who are spending billions of dollars, creating the large language models. I think what we need to do is focus on, well, what are we good at? So in our case, we're focused on how can we help small, mid-sized businesses with their accounting, their payroll, their HR, etc. And so how can we leverage off those big models, those big large language models, but create domain-specific capability, which allows us to then automate for our customers. So it's kind of real solutions for real situations, as opposed to this kind of more grand vision of, having these agents that sort of become your companions. This is about automating stuff that matters to you every day.
Steve, you've been down for a few days in Newcastle. The government's getting ready for a budget. I'm sure they're listening to people like you. Your advice is valuable. What is your advice right now? What do you want to see from the budget? What's the message to government? It's been a confused, difficult message for business thus far from government. Do you expect clarity? What are the key things you're looking for?
Yeah, so the key thing I'm saying when I get the opportunity is exactly that. It's you need to have clarity. You need to have consistency. To some degree, we've had our big budget, and it doesn't matter whether you liked it or you didn't like it, right? Yep. Politicians face tough choices. What we need now, though, is we need to get rid of the speculation that there's more to come, so that people can plan, they can invest through the cycle without worrying whether there's going to be some more tax rises or there's going to be uncertainty.
And the feedback you're getting is?
They understand that, but obviously they still have some challenges in terms of balancing the books. So, they've got to look at the expenditure side, which they are doing in terms of public expenditure. And in the end, the economy's got to grow.
It does. Let's hope it does. That would certainly make balancing the books a lot easier.
It would.
Steve, great to see you. Thanks for dropping by to see us. We really appreciate it. Steve Hare, the CEO of Sage Group. Coming up, we're going to cross to Frankfurt. ECB President Christine Lagarde will give her opening comments on the ECB Watchers Conference. We will bring them to you live. That is coming up. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big. 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
There is this real momentum from Wall Street.
we are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Wednesday morning, 43 minutes into the equity market session. This is the picture. We are up but down. European equities this morning, let's call it up circa 0.75%. On the week, we are still negative. There is a small gap higher this morning that is taking us to the kind of numbers that you're seeing on the screen at the moment. The story, I think the takeaway, though, this morning is one of consumer weakness. That is showing up throughout the equity story. Take a look at what is happening with stocks like Inditex, big heavyweight stocks that we are so focused on right now. That is where the weakness is coming through, and I think that is significant.
Certainly something that we're going to keep a very, very close eye on. In the meantime, as we've been speaking, we've gotten headlines coming out of an EU official, actually, talking about that the EU is going to be targeting GOP-led states with retaliatory tariffs. This is according to one official, also saying that the EU tariff retaliation will include the House Speaker Johnson's state. That is the home state of Louisiana, I'm being told. GOP-led states have major exports to the EU in two key areas: energy, oil and natural gas, and agriculture. So it kind of feels like agriculture, which has been a sticking point between the U.S. and the EU for quite some time, may be where the pain lies.
Yeah, I mean, very different regulatory environments that have been fully entrenched for a very long time. I mean, maybe that shifts at the margin, we'll see, but very different backstories there. In terms of energy, the Europeans have offered to buy more LNG from the United States and buy a lot of it already.
Europe needs to buy a lot more energy from the United States, and obviously that comes out through Louisiana in one of the key areas. That's where a lot of the trains are in terms of the gasification that it's become a key area for. So, yeah, it's hard to see that being the target. I wonder what effect that will have. Does that, though, is there a danger that that strategy backfires? That ultimately this just reinforces the idea that Trump and the GOP feel that they need to do more on this. And it may be, and the lesson from Canada over the last few days has been, you hit us, we're going to hit you back twice as hard. Is that maybe the response that we get out of the Trump administration, out of the Republican Party?
It seems almost it's dangerous if you push back hard and dangerous if you don't fight back. It seems as if you can craft both narratives. And let's have a look at some headlines dropping across the Bloomberg terminal. We are waiting to hear from Christine Lagarde. She's going to be speaking at the ECB and its Watchers Conference. A few lines from her prepared remarks have already dropped onto the Bloomberg terminal, so worth just going through those. Central bankers will need to show agility. Well, that certainly seems sensible. Maintaining stability will be a formidable task. And she goes on to say that the era of shocks makes the ECB's inflation job harder. So these are the early lines coming through from Christine Lagarde.
Does that sound hawkish to you? Shocks are shocks. In some ways, the tariff shocks are going to be inflationary. Is she basically signaling maybe a more hawkish stance? Certainly we're going to sit on our hands and do less stance, maybe. You could maybe take that as a given. It's a more difficult task. Maybe the difficulty is going to be sitting back and doing nothing. That can often be a challenge. But in some ways, that sounds tougher to me. And I'm wondering if that's a slightly hawkish tone being delivered by Christine Lagarde.
Yeah, perhaps. And as we await those official comments from Christine Lagarde and waiting for her to speak, we are suddenly getting comments from ECB's Simkis as well, saying a lot of what you just said, actually, which is the direction of travel hasn't changed. It's irrational to commit on future rate decisions. But ultimately, the question I think everyone's asking, is it a cut or a pause in April? And does a pause signal a change in pattern for the next few months?
Well, maybe that's what agility goes to, this not wanting to pre-commit. I mean, central bankers don't ever want to pre-commit too much, or maybe they do sometimes, but not often they don't, and they want to be data dependent and all that good stuff, but wanting to show, to be agile, to be able to be agile in the face of things that will come at you that you don't even know about yet might be important for 2025.
Does agility imply doing something? Or does it, is sitting there doing nothing.
Is that agile?
Is that agile? I don't know, because that's maybe the question we're going into. Is it? Are we going into a period where the ECB does nothing for a while and waits and sees?
Well, if it changes in financial conditions, then doing nothing can be doing something.
Well, the other piece that we haven't even talked about is this is all the rate cut story. What about QT? What about the higher yields in bonds? I mean, the surge that you've seen in the bond market, already you've seen tighter financial conditions. So the case for a cut is to combat the markets already kind of tightening, right?
Maybe. How do we fold in the fiscal? How does she think about the fiscal? How does the ECB's Governing Council think about the fiscal impulse that is coming? Again, really hard to tell. We don't know the details yet.
Yeah.
How quickly is it going to come? How quickly is Germany going to spend money? What's the trickle-down effect
into
of
the
all
economy?
of that?
Yes.
So many unknowns at the moment.
And we're talking in Germany, just in Germany, about a policy that takes on infrastructure and also takes in military spend. And the multiplier effect on the German economy of those things will be really different. And I was reading some research yesterday that suggested even the infrastructure spend takes time to deliver, and therefore the multiplier is sort of delayed. And then you look at what happens with the defence spend. Well, that's a lot less clear. Although we did get some headlines yesterday from European voices suggesting that money should be spent in Europe. But, to what extent is that going to be possible?
But that's hard.
Yeah.
There isn't the capacity to spend that money in Europe at the moment.
Well, how many times have we heard of folks coming up on our very own show and saying, you can spend all the defense, but there is still a massive leak to the United States. I think Sharon Bell over at Goldman Sachs said something like 70 to 80% of that defense spend goes straight to the American defense makers, right?
There's a component parts story to that as well. You think about a helicopter or an aeroplane or a tank or whatever. There are all kinds of different subcomponent suppliers that go into that. Are they all from Europe? Do they all come from this region? Does some of that technology come from the United States? A lot of these big defense companies are relatively global in terms of their footprint, and US companies operate in Europe to a huge degree as well. So trying to define what is European and what is American made is also really, really difficult. And trying to get an understanding of that, you always have to go kind of line by line in terms of understanding the products that we're buying and what we're going to need in terms of the capability.
Well, the one thing that we haven't even, it feels like has completely slipped everyone's mind is the deficit story. What happened to surging yields in France and this kind of spread widening in Italy, this spread closing in Spain, arguably in the U.S. as well, where you have this deficit concern on July. I think we heard overnight that the House has now passed a budget, so we're kicking the can down the road again on a shutdown. Does the markets not care? Do the markets not care about the concerns around the deficits that I think have been plaguing these markets for the last 6 months? Let's
talk about inflation. We're going to get CPI data out of the United States a little bit later on. That is going to be a key moment. Is inflation proving to be stickier than we anticipated? Certainly that is the expected narrative coming out of the States. To a certain extent, it's the narrative here in Europe as well.
Yeah, we're going to be looking for that CPI data out of the United States to take a step down, aren't we? Even if we're still worried about whether it pushes up again because of the tariff threat. We are still waiting for Christine Lagarde to speak, we should just point out. She's being introduced at length with a conversation about the German economy. And we've seen such big shifts in the German economy and the fiscal expectations out of Germany. Of course, that it's entirely understandable that we're watching that conversation develop in Frankfurt as we wait for Christine Lagarde. Taking a breath from the Christine Lagarde watch, and we're waiting for her to speak, as I say. Valerie joins us on set. We are waiting for CPI out of the United States, Val, so maybe give us a heads up as to what you're watching for on that front.
Yeah, look, any confirmation that last month's print of a 0.4 reading on core CPI is going to be declining today. The Wall Street consensus expectations is that it will drop down to 0.3%, but we really need to get back to the 0.2 and 0.1 month on month for the Fed to be confident that inflation is on the right track. The Fed is in the blackout period ahead of their meeting in 2 weeks' time. A lot of the focus recently now is on the May meeting when it comes to the Federal Reserve. Are they going to want to keep that open just in case they want to do a cut in that May meeting and the first week of May? It was just yesterday that we saw the odds for a cut in the May meeting hit 50%. They've since retraced a little bit as the equity market has come back a bit, but that May meeting is going to be on focus and whether they want to keep that live.
We kind of feel like we're caught between the devil and the deep blue sea when it comes to inflation in the States, though. If you get a softer print, people are going to talk about recession. If you get a hotter print, people are going to talk about stagflation. That seems to be, those are the options right now.
Look, we should just say that we've never actually seen the U.S. enter into a recession just based on policy uncertainty.
Okay. Valerie, thank you very much. Valerie Teisel with us to talk about the markets. Let's get back to Frankfurt. Christine Lagarde speaking at the ECB and its Watchers Conference.
Within the Eurosystem, we feel very strongly. Good morning to all of you. Everything is okay. You've settled. You've managed to arrive despite the traffic, despite this slow-going move. that has nothing to do with the move that we are observing at the moment in Europe. And this is something that we should be, I'm certainly, excited about. So let me start with a quote by someone that some of you might know. He's French. And some of you might think of Victor Hugo as a big proponent of Europe, Monet and Schumann and many others. Paul Valéry was a great supporter of Europe as well. And he wrote the following: "The trouble with our times is that the future is not what it used to be." He was copied many times by others, and that quote is attributed to other people, but it's him who started with it. And I think it's particularly fitting for the times, because our expectations have indeed been swept aside in the last few years, let alone the last few weeks. Established certainties about the international order have been upended. Some alliances have become strained, while others have drawn closer. We have seen political decisions that would have been just unthinkable a few years ago, a few months ago, a few weeks ago, just to see them overturned the following day. So the level of uncertainty we're facing is exceptionally high. An index of trade policy uncertainty currently stands at close to 350, which is more than 6 times its average value since 2021. And indicators of geopolitical risk stand at levels not seen since the Cold War, except for times of war and terrorism. This new environment raises fundamental questions for monetary policy. How can we deliver price stability in a new geopolitical era? As you said, Professor, our strategy assessment is ongoing under the leadership of Philip Lane, our chief economist, and brings together all Eurosystem experts in these fields. So I'm not going to cover every issue that they are currently discussing. This would not pay tribute to the work that is ongoing. But I will focus on the factors that I consider to be particularly relevant in this new era. And I will ask 3 questions, so bear with me. First, how is the environment in which we operate changing? Second, what do these changes imply for our reaction function? And third, what do those changes imply for our policy communication? My main message, and I will develop that and argue, is that in an environment of uncertainty, a strong commitment to maintaining price stability over the medium term is more important than ever. This commitment will require agility to respond to new shocks, but within a well-defined framework that limits short-sighted reactions and unbridled discretion. As a result, we will need to continue steering the public's expectations. People interested in us will be looking to us, and other policymakers, of course, to understand how we will navigate this more volatile era and help reduce rather than amplify uncertainty. So, is it just agility? No, it's agility combined with clarity. Even if we cannot provide certainty about the rate path, we can provide clarity about our reaction function. So let me go to those 3 questions that I have mentioned and look first of all at the environment. When we last reviewed our strategy...
ECB President Christine Lagarde speaking at the Watchers Conference in Frankfurt. If you would like to continue to follow her remarks, you can do so on the Bloomberg terminal. Live Go is the function you want to be using. That is it for the opening trade. Up next, Danny Berger counting you down to the US Open. Futures are positive. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning from our global headquarters in New York. I'm Danny Berger. Manus Cranny is off today. Welcome to your Bloomberg Brief. Let's set your agenda. No exceptions, no exemptions. The steel and aluminum tariffs officially kick in. President Trump walks back his double levy for Canada.
The president is unwavering in his commitment to restore American manufacturing and global dominance, and I think he doubled down on that with his new statement and the tariffs that will be implemented on steel and aluminum.
Europe fights back. The EU targets $28 billion worth of American goods and countermeasures.
The U.S. administration has opted to pursue a harmful course of unjustified tariffs, leaving us with no choice but to respond, and that's exactly what we are doing.
And on the brink of a correction, dip buyers go missing ahead of the latest inflation print in America. And you are about 3.5 hours away from that CPI print. The expectation is a 0.3% increase month over month for both headline and core. That comes off the back of being down 9.3% from the peak in equities. Are the dip buyers finally showing up this morning? They certainly didn't yesterday after we ended lower. S&P 500 futures up 0.6%. More for the NASDAQ and the Russell 2000, which have been looking weaker as of late. Treasuries did indeed sell off yesterday. That was off the back of a strong jolt, showing that there is demand for labor, that the quits rate moved up to a 6-month high. That, though, some of that selling easing off for a little change this morning. We are at 3.9% on your 2-year yield. Your 10-year yield stands at 4.27. And we also have some individual stocks we're keeping our eye on this morning. This one's an interesting one. Earlier in the month, we had talked about Walmart trying to push its price increases to its Chinese suppliers. Well, now Walmart is facing heat from China over those reports that it asked suppliers to bear the cost of rising prices from tariffs. The authorities warned that Walmart's demands could fracture the global supply chain. Those shares down 0.7%. Shares of Puma, those looking really sour in the European trade, down 22.33%. The company reported softer than expected results and forecast lower growth. We heard something from them that we also heard from the plane airlines yesterday, that demand is struggling in the U.S. They also pointed to China as a weak spot for demand, too. Finally, wrapping things up with Stitch Fix, that is on the upside in the pre-market trade, up 20.5%. The personal styling platform boosted its full-year revenue forecast. The company says its turnaround efforts are working, even as sales continue to fall. In just a few moments, we are going to be catching up with Seema Shah of Principal Asset Management. Later in the hour, we'll be speaking with Priya Misra of JP Morgan. And on the tariffs of steel and aluminum tariffs coming in, we're going to be catching up with Jeremy Flack of Flack Global Metals. But first, just want to bring you some live pictures. ECB President Christine Lagarde is currently speaking at the ECB, giving her annual address and its Watchers Conference in Frankfurt. If you want to tune in live to that, Live Go is where you want to watch it. Just some of the headlines that have come out of that. She is talking about a new era of shocks. She says a new era of shocks makes the ECB's inflation job harder, that maintaining stability will be a formidable task, and it is a moment where central banks need to show agility. Again, Madame Lagarde speaking there in front of the ECB and its Watchers Conference in Frankfurt. You can tune into that on Live Go, speaking about the shocks and uncertainty in this market. Speaking of shocks and uncertainties, back to the main story of the day. It is tariffs. Principal Seema Shah weighs in on the impact and writes, near-term tariff uncertainty may dampen business confidence in CapEx, pushing risk premiums higher and weighing on asset prices. However, the U.S. economy remains resilient. This backdrop suggests selective opportunities and positive market returns. I'm pleased to say that Seema joins me now. She's Chief Global Strategist at Principal Asset Management. Seema, great to see you this morning. That last bit of your thoughts there, does that mean with the S&P nearing a correction down more than 9% from the highs, that you see some buying opportunities?
So, hi, Danny. I think there are buying opportunities. I think the S&P 500 itself, there is still so much uncertainty. There's still so many fears about how actual policy is going to impact the economy as it starts to come in, that it may, we may still see investors wanting to kind of wait around before they start to dip their feet directly into the index. But there are opportunities underneath that index level. Some of the sectors which are somewhat untouched by the tariffs can still, continue to prosper even in this fairly uncertain environment. Some of the ones that we do like financials, utilities, for example, even healthcare. So there are opportunities, but at this point in time, it is really important for investors to actually directly seek them rather than just going straight to the index level.
Can I just linger on that financials points? Because banks have gotten really caught up with the latest turmoil because the concern is one of growth and that hitting financials. Banks, smaller banks in particular. Why do you like the sector?
Yeah, you're right. So I think, it had a wonderful rally in the first part of the year, and now it's started to shift. So we're still fairly confident about the US economic outlook. Certainly the odds of recession have increased. That is true. But when we're looking at the data, what we're anticipating is a slowdown. We're already anticipating a slowdown. We have reduced the forecast slightly. But we don't see recession hitting. We are making a number of assumptions for the second half of the year, though, and those are really key. So we assume that a number of the tariffs, not all of them, but some of the tariffs are lifted in the second half of the year. We're also assuming some Fed cuts. The inflation print later today is going to be really important in paving that way, potentially for Fed easing later in the year. And the third thing is that we're still looking for deregulation. So some of this growth-friendly policies that we didn't see at the beginning of the year still expected to come in the second half of the year, and then that hopefully boosting the economy and enabling the US to skirt recession. So if that is correct, it still means that financials have got some headway to run, and maybe we see some of the losses in the last couple of days being reversed.
In terms of what we could get from policy that could help reverse some of the losses, Seema, you pointed to one of them, some of the more market-friendly measures. This I thought was interesting, though, from the Wall Street Journal. They have on their front page the story that Trump's economic message is spooking some of his advisors. This is what the journalist there wrote, that many in the business community have abandoned efforts to get the president to reverse course on trade, instead pleading with the White House for clarity on his approach, the People said. Seema, is there some degree we're just getting clarity on tariffs, not even necessarily of backing off on tariffs, but that in itself could support risk assets?
Yes, absolutely. We're already seeing that policy uncertainty is weighing on business capex. I mean, businesses, if they really don't know what the policies are, what do? They just kind of stand still. They cancel the various investment plans and maybe pause hiring. So this in itself, that level of uncertainty is very damaging. We just heard from Lagarde referring to it just now in her speech. So we are clearly seeing an impact. It is important, of course, to remember that you've rarely had recession. I think you've never had recession in the US just from policy uncertainty. But certainly having some kind of clarity about what the Trump administration is planning with regards to tariffs and potentially the broad policy mix, how are they directing the US economy? Where are their pressure points? Those kind of things would certainly help businesses plan and provide a bit of a boost.
Well, you make a good point that Lagarde is speaking about it. This isn't just an America's problem. It's a Europe problem, too, now that they also face tariffs and have put retaliatory tariffs in. Seema, we saw a sell-off yesterday in U.S. assets that also spilled into Europe. Previously, to start this year, it had been more of a rotation. U.S. sells off, and we buy into Europe, and we buy into the rest of the world. Is that rotationary trade coming towards an end? Is the uncertainty now manifesting in risk-off in general across the globe?
So this is a really interesting question. We do think that the outlook for European assets has shifted really fundamentally to the positive side. But we have to remember that it's rare for global assets to avoid any kind of US weakness. So that uncertainty weighing into European assets is, it's likely to continue. We just have to think about the various approaches that countries are trying to figure out. What is the best way of approaching and retaliating? Do they push back or do they kind of sit still like the UK? That is still to be seen, and that weighs on that global outlook of uncertainty. I think specifically with Europe, though, a lot of it is still down to what's going to happen with Germany next week. If it does manage to pass those measures, that does lift the economic growth rate for Germany and parts of Europe. And so we would expect that rally to get back into play. But of course, there's going to be pockets of weakness through this year, not just in the US, but certainly in global markets too.
Well, certainly there are hopes that the Greens will reach some sort of negotiation. They can lift that debt brake. Seema, really great to catch up with you. Seema Shah of Principal Asset Management, thanks for your time this morning. Let's get you some other stories now that are trending on the terminal. Rheinmetall predicting revenue will grow by 25 to 30% this year. The German arms manufacturer has been benefiting from surging European defense spending. Speaking of what's happening in Germany, the CEO says that demand is bringing growth forward that it has never experienced before. Shares have surged more than 1,000% since Russia invaded Ukraine and more than doubled in the past year. Porsche has lowered another profitability goal set at the time of its blockbuster IPO listing. That's off the back of lackluster earnings with weak sales in China. Porsche will start an extensive rescaling this year, investing in models, software, and batteries that will hit this year's results. Now, elsewhere in Washington, House Republicans passed legislation to keep the U.S. government open past a Saturday shutdown deadline. That bill will likely need the support of at least 8 Democrats in the Senate to become law. If the measure fails in the Senate, though, Republican congressional leaders could try to pass a shorter-term stopgap later in the week. Coming up, we're going to get more details on the latest tariffs, the latest retaliations, a fast-moving story. That's coming up next on your Bloomberg Brief.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
President Trump's metals tariffs are in effect. That's a 25% levy on steel and aluminum imports. For the EU, it marks a massive escalation on the trade war. China, meanwhile, is vowing all necessary measures in response. And Japan's spokesperson calls the levies, quote, regrettable. Joining us now is Bloomberg's Brendan Murray, who leads on international trade coverage. Brendan, first, let's just start off with what we actually have in effect, because there was a lot of back and forth yesterday. What exactly do we have in terms of metal tariffs?
So we have 25% tariffs on all imports of U.S. raw steel and aluminum, plus consumer products made of those metals. So things about $150 billion worth of imports of consumer goods like caskets, like baseball bats. There are a whole range of things that are made from steel and aluminum. As I said, $150 billion worth of imports. So those will translate into a fairly immediate increase in some of the prices of those goods. What we saw in the aftermath of the deadline of midnight last night in Washington was countries threatening to retaliate, but not a whole lot of actual retaliation against something that was pretty well telegraphed. So that tells you the big steel exporters, countries like Japan, South Korea, China, and the countries of the European Union are looking to sit down and negotiate their way out of some of this. The European Union struck perhaps the harshest tone and said, they actually laid out their dates for retaliation and said, put dollar figures on the amount of products of American products that they're gonna hit. But we've seen a range of responses from no commenting to we're going to hit you back on April 1 or thereabouts from the European Union.
Yeah. Again, no exemptions for this, even with some places that there would be, like Australia was hoping for an exemption, for example. Brendan, thank you so much. Bloomberg's Brendan Murray. And as he mentioned, Europe is fighting back. So over to Brussels, the European Union launching countermeasures. It plans to impose its own levies on around $28 billion worth of goods. European Commission President Ursula von der Leyen laid out the bloc's plans earlier. Take a listen.
Our countermeasures will be introduced in 2 steps, starting with April 1st and fully in place as of April 13th. In the meantime, we will always remain open to negotiations. We firmly believe that in a world fraught with geo-economic and political uncertainties, it is not in our common interest to burden our economies with such tariffs.
Joining us now from Berlin is Bloomberg's Oliver Crook. And Brendan also mentioned it. This is kind of the strongest response that we've seen from any nations, Oliver. What led Europe to this point?
Yeah, I mean, I think that they believe that they are sort of in a position to do a little bit of negotiating and a little bit of fighting back to the United States. We should say that the trading relationship between the EU and the United States last year was about $1 trillion. So this is a massive trading relationship. But having said that, $1 trillion, they're talking about retaliating on about $28 billion worth of goods. So it's, again, this is kind of a drop in the bucket when it comes to the real trade war that could come between the EU and the United States, which really would be in April. And that has to do with the focus on VAT, reciprocal tariffs on cars, the pharmaceutical industry. That is where the real pain is going to come. We don't have the list yet from the EU on how they're going to retaliate. We know from last time around some of the things that were on that list were bourbon. Apparently there's $1 billion worth of bourbon that's imported into the EU, iron, cosmetics, electronics, those sorts of things. But I think, Danny, actually the way in which that these particular tariffs hit Europe the most have actually nothing to do with trade between Europe and the United States. It has to do with the trade barriers that are erected around the United States, meaning that a lot of the steel that is going to be coming into the U.S. from other places like China and other places where it's produced much more inexpensively, all of that shipment gets redirected to other markets that can absorb it, and that is going to be the EU, a very sort of rich continent that can buy a lot of this stuff. And that means that for the steel industry here in Europe, which is already struggling, they cut about 18,000 jobs last year. They had to pull about 9,000 tons off of their own sort of domestic production. And this is one of the biggest issues here for the European Commission, competitive industrial environment here in Europe. And this means that a lot of that is going to be redirected to Europe. So could you have basically a second-hand trade war where now Europe needs to erect trade barriers with other partners in order to prevent that cheaper steel and aluminum from coming into its territory?
Oliver, it is such an excellent point. And it is also a pushback to the bulls who saw the case to buy Europe because of the amount of spending that would be happening and the lift to the economy because of that. What does the balance look like at this moment? Will Europe at least be headed down that road? Will Germany be able to lift its debt brake? Does it at least have a more balanced economy if it is going to be dealing with these tariff threats?
I mean, I think that is the reality that basically a chancellor candidate in the form of Friedrich Merz from the Conservatives, who basically ran on not reforming the debt brake about 3 days after the election, decided, hey, you know what we're going to do? We're going to reform the debt brake. I think, though, that the problem is, Danny, that the market got a little bit ahead of itself in pricing in basically, potentially €1 trillion of debt finance spending by the German government, which is not yet assured. Again, this still needs to be negotiated. The market got a little ahead of itself.
Oliver, always great to hear from you. Oliver Crook there with the latest on the EU. Coming up, we're going to take a look at the front pages this morning on your Bloomberg Brief.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China show live every weekday.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Let's take a look at the front pages on this Wednesday morning. First up, Reuters reporting that TSMC has pitched NVIDIA, AMD, and Broadcom on taking stakes in a joint venture that would operate Intel's factories. Under that proposal, TSMC would run the operations of Intel's foundry division, but it would not own more than 50%. Next up, the Wall Street Journal has this on their front page. The Education Department is cutting its workforce by roughly half. The official said it was eliminating full teams whose operations are deemed redundant or unnecessary. Now on the Bloomberg, we have this. Ukraine has accepted a proposal for a 30-day truce with Russia as part of a deal to lift its freeze on military aid and intelligence. President Trump spoke to reporters about the deal outside the White House.
Ukraine has agreed to it, and hopefully Russia will agree to it. We're going to meet with them later on today and tomorrow, and hopefully we'll be able to wipe out a deal. But I think the ceasefire is very important. If we can get Russia to do it, that'll be great.
Joining us now for more on this is Bloomberg's Greg Sullivan. Greg, great to see you this morning. What has actually been agreed between the U.S. and Ukraine?
Well, we know a few things. One is that Ukraine has agreed to the broad terms of a 30-day ceasefire, assuming that Russia also eventually agrees to it. We also know that that came after intense White House pressure following the disastrous Oval Office meeting between President Zelensky and President Trump. The White House has been piling pressure onto the Ukrainian side to come to the table and make these agreements. But as part of those agreements, the U.S. has also agreed to lift its freeze on sharing military aid and intelligence with Ukraine. So that is quite a significant step there. What is not included in the deal, however, are security guarantees that Ukraine has insisted are necessary for any sustainable peace. So that will be something to look for moving forward. The other thing, of course, that's not agreed to here is the Russian participation in this deal.
Exactly, Greg. So how likely is it that we will have Russian participation in this deal? Will the Kremlin agree to the terms laid out?
This is the key question here. One thing that we do know is that the terms that were agreed to fall short of what the Kremlin has said they need for any cessation of hostilities. Now, we know that President Trump has said that the U.S. will engage with Russian counterparts as soon as today. His special envoy, Steve Witkoff, is expected in Moscow. He's the Middle East envoy, but he's been very engaged in the Russian process. So we should know more about Russia's response to that coming forward. But in the past, Russia has ruled out a short-term ceasefire unless there are serious discussions about parameters for a more long-term peace. And so far, that's just not evident in this agreement.
Well, Greg, quickly here, and to your point, how does this bring about long-term peace? Because Ukraine's not getting the security backing that it wanted.
Well, on one hand, this does seem to be President Trump's strategy, is to force both sides to the negotiating table for a short-term truce, and under which longer-term negotiations can begin. Zelensky said that he would like to see a prisoner exchange happen to build up trust. However, the Russian side has warned that they believe Ukraine will just rearm under any short-term truce. And as you mentioned, those security guarantees, that will be a key sticking point in any long-term negotiation, as well as the size of the Ukrainian military going forth. And right now, it's really hard to see an agreement on what specific security guarantees will be palatable to all sides and still a deterrent to Russia.
Greg, thank you so much for the update. That is Bloomberg's Greg Sullivan. Coming up on the show, it's CPI Day. We're going to push ahead with JP Morgan's Priya Misra. She'll be joining us next. You're watching Bloomberg Brief.
What would it mean for India to host the Olympics?
Heslinda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From our global headquarters in New York City, you're welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. No exceptions, no exemptions. The steel and aluminum tariffs officially kick in. President Trump walks back his double levy for Canada.
Is unwavering in his commitment to restore American manufacturing and global dominance. And I think he doubled down on that with his new statement and the tariffs that will be implemented on steel and aluminum.
Europe fights back. The EU targets $28 billion worth of American goods in countermeasures.
The U.S. administration has opted to pursue a harmful course of unjustified tariffs, leaving us with no choice but to respond, and that's exactly what we are doing.
On the brink of a correction, dip buyers go missing ahead of the latest inflation print in America. We are down 9.3% from the highs, so just inching towards something that looks like a correction. We have downgrades from Goldman, from Citi, from HSBC on their equity market calls, but we attempt to bounce back this morning, led by tech, which let us lower yesterday, up 0.7%. Treasuries, they did sell off yesterday. That seemed to be in reaction to the JOLTS figure, showing that there is indeed demand for labor and the quits rates moving higher. Today, we take a breather from that. We are little change across the curve this morning, 3.94 on your 2-year yield. Your 10-year yield stands at 4.27. So in 3 hours' time, we will be getting CPI coming in, the latest inflation reading in what has been a very volatile market reacting to data and headlines. Pleased to say that Bloomberg's Mike McKee joins us now. Mike, always great to see you on a data morning, getting up early for us. So what are we expecting today from CPI?
I think I'd call it the calm before the storm, because this is going to reflect prices and company decisions that were made when Donald Trump was just coming into office and all we had was rhetoric. We may see a few things go up in price, but maybe PPI tomorrow is going to give us more of a clue as to the tariff implications. Instead, what we're likely to get is a slight improvement overall in consumer prices, in part because of the time of year and in part because of the things that are going up and down. We get a little bit of a break on both headline and core on a month-over-month basis, which pushes the year-over-year numbers down. So that would be relatively good news. But is this the end of what we see as good news? Because, as I mentioned, the tariffs are starting to come on now. And what we have seen for the past year or so is a drop in services prices, our drop in goods prices, and services prices have been rising. Now, services prices might be starting to come down. We're expecting a little bit less in terms of airfares, things like that, a little bit more in terms of goods that tariffs will be on. So we'll watch that for some kind of clues as to what we might get from this month. And I'll come back when we get the March CPI, and we'll see if it's any better.
I was going to say, you have no choice but to come back. So thank you for that, Mike. But is there not some sense that, at least we got from the Beige Book, that there are firms who are preemptively hiking their prices ahead of tariffs?
Well, we have seen that. The question is how many and how much. We know that car prices went up some, but overall, used car prices are expected to fall this month, in part because of seasonal reasons. But people buying things ahead of tariffs is what has pushed up prices, because it's a law of supply and demand. But also, when you put on tariffs, the domestic producers tend to raise prices because they can. That's the whole point of tariffs, is to get them more money. So we'll have to see, and this will show up more in the PPI than CPI, we'll have to see how much of that has flowed through to the consumer. Probably not much this month.
Mike, we look forward to you breaking down the data in a little under 3 hours' time. That is Bloomberg's Michael McKee. Joining us now around the table is Priya Misra, Portfolio Manager at JP Morgan Investment Management. Priya, good morning to you. Thanks so much for joining. Do you have an understanding of how the market would likely react to a CPI print that maybe comes in a little bit hotter? How crucial or not crucial is this data point?
So remember when CPI was the most important number? We waited all month for it.
I don't think it was that long ago.
I know, and I almost think it doesn't matter. Well, partly, to Mike's point, it's a lagging number, so it's before the tariffs have come in. Partly because I think the market has moved from inflation fears, or will that allow the Fed to cut rates? I mean, the Fed has cut 100 basis points, to now growth fears. And so I think if you do get a little bit hotter, I think what it's going to tell us is we're going into this policy uncertainty period with higher inflation. I still think, can inflation be sustained? We're going to be looking at services. Mike talked about that. I'm looking at wages, because it's possible that tariffs are going to create this one-time price shock. Service inflation, it's sort of less impacted by tariffs, but if that's already high, you're looking at a higher inflation number, which means that the Fed really can't offset a lot. And so then we're going to look at how much policy easing is required if we're going to get a combination of, whether it's the DOGE-related, job losses, what is the spillover into the private sector? So we'll be looking at that. Plus, what's the impact of uncertainty? I just think about a consumer, that's thinking about a big purchase, or a company that's thinking about hiring plans, CapEx. With all this uncertainty, I would think the logical action is not to do anything. And that becomes an action. And the longer this lasts, does that have a drag on growth? And then the Fed will have to weigh, so that's why it's a long answer to your question on high inflation, but the Fed will have to weigh that inflation along with that uncertainty growth shock. And what they did in 2019 was look through the price shock. So ultimately, I think they're going to look at the growth side, and if that's weak, I don't think it'll derail any rate cuts. It might just delay it, and so the market might price it more at the end of this year, next year.
I think that's incredibly astute, because we also have heard from a Powell whose language has been, I know we're in a blackout period now, but on Friday he said the costs of being cautious are very low. But it's different than at the end of last year, when they were willing to talk about the inflationary aspect of tariffs to come, and they were willing to kind of forecast ahead of that. Why aren't they willing to give some sort of read-through to what tightening financial conditions might be? Why aren't they willing to kind of forecast more help needed for growth, more cuts to come? Why are they backing off of that?
So, I think they also don't know. I think the key assumption maybe they made, certainly the market made, was a lot of the tariff talk, or, lots of growth negative talk was a negotiating tool. And we would get deals. We wouldn't actually get all of them because deals would be struck. We haven't really seen a lot of that. Now, it's still early days, and maybe deals will be struck and these tariffs don't last. I think that's one assumption that's becoming a little shaky. The other assumption was that there's all this good stuff that's going to offset the bad stuff. We're going to get tax cuts. We're going to get deregulation. Well, we're not really seeing them. And so the growth negative aspect is sort of overshadowing what potentially good stuff could happen. Now, the Fed doesn't know, and they're looking at an economy that's, I would argue, growth side is still okay. I'm getting nervous about that tail risk of a recession picking up. I think the market's starting to price it in. We're nowhere high priced for recession right now in any market. But the Fed is looking at financial conditions. They've tightened, but actually they've only tightened marginally. Now, if you get another 10% drawdown. I don't know what that, magic Powell put is, but at some point those financial conditions will be tight enough. We're not there yet. Then I think you'll hear the Fed starting to say, well, maybe that's another downside risk to growth. We're not there yet, which is why I think the market's very sensitive to negative headlines in terms of either growth. I think inflation less so. Maybe a hot print is slightly negative for risk assets, but we're going to be watching what's happening on the tariff trade war, because now the retaliation is starting, and April 2nd is not that far away. That's like that key date.
It's really not. I mean, I wrote down some of the time codes yesterday of Bloomberg headlines. Crossing at 10 a.m., we got that Trump headline saying he's increasing Canadian steel. By 3 p.m., he said he may back off of it. And then by 4 p.m., they say the 25% tariffs are going on for everybody. I mean, that is some serious fire hose inundation with headlines. What does it mean for a market to condition itself, where it feels like every day you might get a new headline and you might get a new tariff?
I think what that's telling you is the risk premiums should be higher. And that's why you've even seen credit spreads. I mean, widen out. You look at how strong company fundamentals are. Companies are not re-levering, but that explains why spreads have widened. But I would say in all this uncertainty, the one thing we've seen consistently now this year, and it sort of goes back to where we were pre that inflation spike, is the negative correlation between bonds and stocks. It's here. It's every day. Yesterday, you get the positive growth headline, positive headlines for risk assets around the Ukraine deal, these additional tariffs coming off, and you see that immediate reaction in rates. So I would say this is why fixed income, actively managed fixed income, where you can, figure out which sectors might be more impacted by tariffs or DOGE, sort of down, underweight those. So if you can actively manage fixed income, high quality fixed income, this is why we're seeing the flows. And you can see that duration is finally, so owning 5-year rates or 10-year rates is actually finally being a diversifier. So you're getting that income, you're getting 5.5%, let's say, in a high quality fixed income, with that diversification benefit. If we're heading into a recession, you're going to get a lot of price performance for fixed income. So amidst all this, volatility, I think people are saying maybe we should reduce some of our risk assets and go into fixed income, which will give you that ballast to your portfolio, allow you to hold on to risk assets and give you that protection in case, we do get a recession.
Well, but we had gotten really used to post-COVID, this 5 years of really exceptional growth that has powered risk assets. Are you describing a rewiring that needs to happen, that we can't get used to the scenario where stocks always beat bonds so you can ignore fixed income and put all your money into risk?
I think a lot of that is risk-adjusted returns, and those risks were lower, I would say, the last few years. The U.S. was the engine of growth. Well, we're questioning that now. Maybe it's going to be from Europe, maybe it's going to be China. So that risk of that U.S. exceptionalism from a growth fundamental standpoint is a little lower now. And then you've got these risk outcomes. The distribution of outcomes has just widened a lot. We're talking about recession really for the first time since SVB, I would argue. And we're looking at policy levels. We just don't have the ability to get fiscal easing. In fact, I would argue we're probably going to see fiscal consolidation with DOGE, with the House passed spending cuts. So that's actually a downside risk on the fiscal front. And monetary, that's where inflation becomes important. How much can they cut? If inflation is above their target, the Fed is a little constrained. So I think in this wider so to your point, whether stocks will always outperform, well, we'll see. On a risk-adjusted basis, I really struggle to see where that outperformance is going to come in, at least right now.
So we're just waiting for a Trump put or a Powell put, it sounds like. Someone to save this market. Priya, really great to see you. As always, thank you so much for coming in nice and early for us. Priya Misra of JP Morgan Investment Management. Let's now get you some other stories that are trending on the Bloomberg terminal this morning. Rheinmetall is predicting revenue growth by 25 to 30% this year as a German arms manufacturer benefits from surging European defense spending. The CEO says the demand is bringing growth prospects in the coming year that it's never experienced before. Shares have surged more than 1,000% since Russia invaded Ukraine and more than doubled in the past year. Porsche lowered another profitability goal it set at the time of its blockbuster IPO. The manufacturer is now aiming for a return on sales between 15 and 17%. That follows lackluster earnings with weaker sales in China. Porsche will start an extensive rescaling this year, investing in models, software, and batteries that it said will hit the year's results. Meanwhile, in Washington, D.C., House Republicans passed legislation to keep the government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. Speaker Mike Johnson spoke to reporters after the vote.
I believe the Republicans will stick together in the Senate as we have in the House, and I hope they're at least a number of Democrats in the Senate who will do the right thing. If not, this will be on their shoulders, and everybody in America knows that.
And coming up, we're going to be speaking to Flack Global Metals founder and CEO Jeremy Flack. That is coming up next on your brief.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Some breaking lines to bring you from Russia's Interfax reporting that Peskov is speaking, saying that Putin-Trump may hold talks after Jeddah. Again, Putin and Trump may be holding a call after talks in Jeddah. Peskov also speaking on the Ukrainian truce that was agreed, that 30-day truce, saying that they are waiting for details, saying that we have planning to have contacts with Americans in the coming days, and the Kremlin expects the U.S. to inform Russia about the results of the negotiations with Ukraine and Jeddah, again planning a call between Presidents Trump and Putin after those Jeddah conversations. Okay, elsewhere, back to our main story this morning. President Trump's metals tariffs have officially kicked in. The U.S. administration has imposed 25% tariffs on steel and aluminum imports, quote, with no exceptions or exemptions for Canada or any of America's trading partners as of midnight last night. And we have the perfect guest to take us through what it all means. Founder and CEO of Arizona-based steel distributor Flack Global Metals. Pleased to say that Jeremy Flack joins us in studio now. Jeremy, thank you so much for joining. Great to see you this morning, bright and early.
Thank you.
I know you're on Arizona time, so we're especially grateful.
Take it easy on me.
I will do my best. Well, look, it's not me that you have to worry about. It is headline volatility after tariff going forward, going backwards. Just how much clarity do we have at this moment?
Well, we think we have a little more clarity than we did last time around for the first Trump administration. The first Trump administration, there was a 232 tariff imposed, and quickly, within months, it became gutted. So they gave exemptions, and within 12 months after the tariff was announced, pricing was back to where it was before we started.
So is your expectation that that won't happen this time?
Well, the administration's been pretty clear this time that there will be no exemptions. In fact, yesterday Australia was here in the United States lobbying for an exemption, and they were denied the exemption, and the administration came out and said we will not have exemptions, and that's putting a floor under pricing in the United States.
What has pricing looked like? To what degree have we front-run this? Because this was a well-telegraphed date, despite some back and forth on headlines about what % they would actually be. To what degree were markets already anticipating this day?
Pricing started moving about 7 weeks ago in anticipation. Then when he announced it, prices moved up a little bit less than the 25%. But the important thing here is that while prices have moved up, what have they moved up from? I mean, we're dealing with a commodity, and they moved up from very low prices. So steel was about $675 a ton in January, and it's up to about $900 a ton today. But importantly, that $900 a ton as a reference figure is lower than the 5-year historical average for steel. And I can remember in 2008, steel prices were $1,100 a ton. So the idea that we're going to have exceptional demand destruction from the tariffs on steel and aluminum is a little bit misguided and not true.
That's a really interesting point, that we're far below the average. So where do you expect prices to go? Do you expect us to be able to maintain something that looks like an average price even with these tariffs coming on?
Well, it's hard to make predictions. We're in a very high volatility situation now. We trade the derivatives for steel on the Chicago Mercantile Exchange, and the forward market actually appears to be completely disjointed. The forward market is now trading headlines, which for our market is quite unusual. So what we can say is a lot of liquidity has come into the forward markets. Liquidity's dried up a little bit in the physical market because folks were prepared for this, and there's a lot of inventory right now. So the net impact of this, it's just a lot of hype and maybe not a lot of reality.
If we cast forward, and maybe a reality check on this too, because one of the concerns is that now you have Canada who reroutes its trade, that rather than trading with its North American partners, a lot of the metals find its way into the EU, and then the EU has to grapple with this idea of more metals, maybe cheaper metals, and a disruption to them. To what degree do you expect a rerouting of global trade, specifically coming from places like Canada?
It's a whack-a-mole situation, Danny. So imports will find their way here at some price because we're actually steel short in the United States. The point of the tariffs on steel, certainly, and aluminum is to bring production here and to assure a market here for the steel manufacturer and distributors here in the United States. And by and large, every administration back to Clinton, Bush, Obama, Trump 1, Biden, Trump 2, and we've been protecting the steel industry in this country to our benefit as manufacturers. Our company manufactures construction products out of steel. And if we don't have prompt steel rolled to our specifications here in the United States, we'll cease to function. And the last thing we want as a country really is to deindustrialize like what's happening in Europe. So the trades will flow around the world, but we must produce our own steel here, especially you look at the Trump administration's push to build ships. So are we supposed to bring steel from somewhere else to build a ship here? It doesn't make a lot of sense.
How long is this process, though? If that's the destination of the journey we're going on right now, how long is that journey to get that goal that Trump wants?
It's a long journey, and I can't speak to the shipbuilding business, but what we're
I wouldn't ask you to, but in general.
What we're really saying is that there's a long history of protecting the steel industry in this country to our benefit. We have the lowest carbon footprint, highest efficiency, highest quality steel mills in the world in the United States. You can't put an AI or an NVIDIA chip or some kind of a computer program on a coil of steel. And if we don't have it, then we can't make the things that have those technologies in them. It's just a coil of steel. We must make it here. And so the point of this is to continue to protect this market. There are countries that build steel mills expressly to ship steel to the United States. And that's fine, but we have to have competition, but the pricing had gotten to be so bad here that it isn't, if the steel mills don't make money in the United States, then they can't reinvest. And they have been reinvesting at a dramatic rate. There seems to be a misconception that we're not, quote unquote, adding capacity and that it's been a net zero. It's not really true. We've shuttered old, high carbon emitting factories, steel factories in the United States over the last 30 years, and we've replaced them with the most modern factories in the world. And so the idea that it hasn't worked or that the trade protection hasn't been a good thing, I think again, it has been a good thing because we're self-sustaining.
I think, again, some of the concern in the wider business community is just the volatility of these tariffs and the uncertainty of it and whether there will be exemptions to come. Does that volatility in itself have an impact on the ability for industry to ramp up, on the ability to really commit to various plans if you don't know day to day exactly what the tariffs will look like?
Certainly, it has an impact, and what we're seeing now is a lot of caution. Our customers are very cautious, a bit stocked up in advance in anticipation of this. We have some examples in the past where the administration gutted the tariffs, and then the prices fell right afterwards. And so people are nervous, and there's a feeling in the marketplace that this just might be a temporary bubble.
Jeremy, just quickly, if prices do start to rise, who undertakes that burden? Who eats that cost?
Well,
Is it the end consumer?
That's a very interesting question, because I've been doing this for a long time. I've seen steel prices at $200 a ton and at $2,000 a ton. And somehow we continue to make products out of steel in this country. And if you look at the steel intensity in an automobile, it's probably $1,000, $2,000 worth of steel in a car. So we're in a very volatile steel market in the United States. This is the most volatile steel market in the world. And so the supply chains are kind of used to this, Dan.
Right. Okay, Jeremy, so wonderful to have you, and you have to come join us again with an update on what you're seeing in the markets. That is Jeremy Flack, founder and CEO of Flack Global Metals, and you are watching Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Let's get you set up for your trading day on this Wednesday. First, the big one. 2.5 hours time. U.S. CPI will be coming out. We're expecting a 0.3% increase on headline and core month over month. Then we'll get the Bank of Canada's rate decision. That comes at 9:45 a.m. We're also going to get more earnings on deck. Adobe will be reporting after the market close. Futures heading higher this morning on the brink of a correction. That is it for your Bloomberg Brief. Surveillance will take things from here.
drive productivity and improve efficiency, Prudential has made significant investments in data analytics and artificial intelligence. Janella Frias plays a key role in integrating these tools into the company's processes.
We always need people. We're in the people business. But more and more, if we really want to provide the right customer experience, fast access to products, it's about technology. Technology has always been an enabler. Now it's a strategic differentiator.
Give me a sense of AI in Prudential. What are you experimenting with?
A few areas. One is around customer experience. In our individual life business, our underwriting process has gone from about 20 days to minutes. In our group business, we have partnered with a number of different fintechs to really improve customer experience, to bring on board capabilities, things like claims management, where we can process a disability claim faster and help people get to work faster.
How much productivity uplift are you getting and will you get?
We're probably getting 10% at this point, but I think over time that is where the value is, and it will then allow us to take our capacity in the form of people and redirect it to more value-add activities.
In a nutshell, it means turning the menial into meaningful. It can be both a huge saver of time, but it can also provide real insight.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There's obviously a lot of fear out there in the market, and the fear is centered on uncertainty.
So long as we're in this environment where consumers don't know the rules, businesses don't know the rules, you're going to be challenged for a while.
So far, the threat of tariffs has been a blunt instrument.
The size of the tariffs and the speed of them, it really dwarfs anything that we saw last time around. And I think markets are reacting accordingly.
It will take a few months to see how these policies pan out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday following another volatile session on Wall Street, equity futures pushing higher this morning after briefly dropping as much as 10% from all-time highs. But once again waking up to more trade headlines, 25% levies on steel and aluminum going into effect with the threat of much more still to come. The latest moves leading to more downgrades on Wall Street. Goldman cutting its forecast on the S&P to 6,200 from 65, pointing to a, quote, recently reduced GDP forecast, a higher assumed tariff rate, and higher level of uncertainty that is typically associated with a greater equity risk premium. Our next stop for this market, CPI at 8:30 Eastern Time. Another read on U.S. inflation.
The reason why this is so important is because the increasing fear right now is stagflationary-like trends, this idea that you get GDP that gets downgraded, to Goldman Sachs' point, but inflation that is sticky, that is reducing the reaction function of the Federal Reserve, and that is the reason why yesterday you saw markets respond more, at least bond markets, to the JOLTS data than they did the uncertainty of tariffs.
Elevated uncertainty in the last 24 hours. Earlier this morning, the ECB President Christine Lagarde delivered a speech, called it the era of shocks, and had this quote: "The trouble with our times is the future is not what it used to be." How many times did the future change in the last 24 hours?
A lot. We whipsawed back and forth. It was a roller coaster of tariff headlines, and honestly, one that it's very difficult to see. A lot of his advisors signed up for that ride based off some of the reporting, trying to push back and regulate Trump and some of his approaches when it comes to trade, especially when it comes to Canada. The Wall Street Journal editorial board this morning says this: at the end of the day, the two sides did start talking. There's a temporary truce. But who knows which side of the tariff bed Mr. Trump will wake up today? And that's the uncertainty that is bleeding into this market.
If you want clarity, you're not getting it right now, and you certainly didn't get it yesterday on steel and aluminum. We had the tariffs on those metals changing multiple times, Lisa, and this is the confusing part for businesses who sat down with the president yesterday in the business roundtable. When's that clarity going to come, if at all?
What's the goal? I would take it a step further. It's one thing if you don't have clarity about the method. It's another thing if you don't have clarity on the goal. What was the goal of upping the tariffs on Canadian steel and aluminum to 50% from 25%? And simply say that the more that you reciprocate some of the tariffs that we do, the more that we're going to amp the ante here. How much does that achieve a goal that we understand? And without that in mind, the uncertainty is existential because it's unclear whether tariffs are just tariffs for tariff's sake.
The president will constantly take a maximalist approach, which we saw him do yesterday. If the goal was just to have Doug Ford come to Washington, D.C. and meet with Howard Lutnick, I don't think you needed to put out a tweet saying we're going to have 50% now on Canada's steel and aluminum. At the end of the day, though, there was a truce, but you can see the writing on the wall. Regardless of what country it is, regardless of what industry it is, this is going to be the playbook for the Trump 2.0 administration.
Equity futures right now on the S&P positive for now. We'll see if that sticks. We're up by 0.7% on the S&P 500. Coming up on the program through the next 60 minutes, we'll catch up with Max Kentner of HSBC as trade headlines whipsaw markets worldwide. Adam Posen at the Peterson Institute as 25% steel and aluminum tariffs go into effect. And Sheila Kahyaoglu of Jefferies as airlines signal a dire outlook for the consumer. We begin this hour with stocks inching higher, looking to snap a two-day losing streak. Markets whipsawed by tariff headlines, leading to several downgrades for U.S. equities from Goldman, from Citi, and from HSBC. Joining us now from HSBC, Max Kentner. Max, welcome back to the program, sir. The facts have changed. Talk to me about how the outlook might have changed as well.
Yeah, look, I think we're still tactically quite cautious on equities overall, particularly, of course, in the U.S. We've just put out a note this morning. I think this is the kind of time where you need to update your framework, your indicators pretty much on an hourly basis because, like you guys were just discussing, of course, even yesterday, things were changing pretty much 3 times during the day. So when we look at our indicators at the moment, particularly from a systematic perspective, of course, yes, there has been quite a bit of systematic selling, but what we're not yet seeing is this sort of final puke. So when we look, for example, at our momentum and / CTA indicators, they are bearish. They flipped from maximum bullish to bearish, but they're only at sort of medium bearish levels until now. So we need, I think, for us to be comfortable to go back in and to buy the dip, I think we need a bit more sort of a puke moment in equities to really say, right, this is the all clear, now positioning is clear enough, systematics have sold enough. And of course, from a fundamental perspective, what's changed in the outlook, so the stuff that you were alluding to, is, you know, we were all thinking there is some sort of put from the new U.S. administration. With that absent, it is down to the Fed put. But of course, with data, let's say like yesterday, like the JOLTS data, all services, ISMs, or payroll still pretty okay. You know, in a normal environment, that would be really bullish for equities and for risk assets overall. For the current environment, however, it just puts the Fed put even further away. Remember what Powell was saying on Friday. We're in no hurry at all to do anything in rates. So what we would need is the Fed to give some kind of nod to tightening financial conditions, that they're monitoring market developments, something like that. But as they said on Friday, I think we're still quite a bit of way off there.
Max, a lot to unpack there. Let's start with the technical term puke. What does the cathartic puke look like? We had a 10% decline at one point in yesterday's session, so entered correction territory briefly. If it's not that, what is it?
I think what we need to see is broader based. Even on Monday, right, breadth actually wasn't that bad. It wasn't like it was all 500 stocks going down. It was still pretty sort of focused and pretty concentrated in some certain sectors, in the high multiple sectors. I think what you would want to see is sort of the final broad-based puke, where it's not just, you know, tech and the high multiple stuff that gets hammered, but really the broader market, where perhaps even the equal-weighted S&P underperforms the cap-weighted S&P. What you would want to see is that spilling over into credit spreads as well, right, where we haven't really seen a disorderly widening as well, and maybe even spilling over into other equity markets, where then people say, you know what, so far we've been hiding out in European equities, we've been, you know, thinking that this is a completely different story, but now we're really playing US recession fears, and that should spill over into global equity markets. Once we've got that, I think that is then sort of the final puke. And another cue to watch perhaps is the momentum factor. When we look, of course, in US momentum, that momentum factor has been absolutely slaughtered the last 3-4 weeks. any kind of bottoming there, any kind of a sign of a reversal there, I think is another sign where we can start buying the dip.
I think this conversation needs a bit of antacid. And Max, I am curious about whether we're talking about sort of the market equivalent of the economic debate here, of whether we're pricing in stagflation or pricing in something more like a recession. And that was something Julia Emanuel was talking about. What are we pricing in currently? What would you take more seriously right now at a time where there are a lot of anxieties, but there still are people who are hopeful that we could emerge from this?
I think stagflation fears were about a month ago, right? That was basically when we had January CPI, particularly underlying inflation, much higher than a lot of people, including myself, expected, where, you know, super core inflation was really coming in quite a bit hotter. And that really was a month ago. When we look at the last 3 weeks, the amount of selling that we've seen in cyclicals versus defensives, particularly in the US, the amount of decoupling between US cyclical defensives against European cyclical defensives, or really rest of world cyclical against defensive performance, clearly tells us what the market is playing now, in particularly the last week and a half, is increasingly recession fears. So I think we are getting closer to the point where you want to start buying that correction. We're not just quite there yet, because I think, again, it would be different if it was just the high multiple stuff, but we're starting to see that spill over into other parts of the market. It's just not quite there yet where we can really sound the all clear on the systematic positioning unwind being completely over.
This is a complicated story. It's not just about recession and recession fears in the U.S. It's also about relative valuation and the fact that suddenly there is an alternative, and the idea that Europe looks brighter, especially with the likelihood of some sort of fiscal package being passed. How much do you lean into that, and how much do you say what a lot of people have said on this show over the past couple of days, which is, that's looking pretty expensive, that's looking pretty bought, that's already over?
I mean, for one, what is amazing is think if 2 months ago, if at the beginning of January, just before inauguration, if we had said, I think German small and mid caps or European small and mid caps are the, quote, relative safe haven in global equity land, I think you guys would have thrown me out of this room now and would have said, maybe don't come back again. So it is quite funny how things have changed only within a couple of weeks. I do agree with you. It is perhaps the DAX is not the right place maybe anymore. I think it's perhaps in Europe really the small and mid caps that should benefit the most from perhaps, you know, the fiscal package in Germany getting over the line. Also perhaps any potential kind of positive news around Russia, Ukraine. All of that is really particularly beneficial for the smaller and mid caps, but also for other parts of the market. We look at China. I think the China internet, the Aegis tech trade, that still has some room to left. So it's not like we have to throw in the towel on equities entirely, right? It is so far mainly a US story. And I think in Europe, yeah, fine, the higher euro, the stronger euro, I think is starting to get felt in the larger caps, particularly in the German equities, given that they, you know, basically generate only or less than 20% of their revenues outside of or inside of Germany, and about 80% outside of Germany. So the stronger euro will start to weigh on the performance there. But the smaller and mid caps are, I think, really the ones that you want to look at. Also, the banks, right? We could look at European banks, still really good. European insurance, right? So there's a lot of stuff even within Europe, also from a sector perspective, under the hood, that is worth looking at.
Max, an incredible 24 hours for Europe, potentially one step closer to peace on the continent. At the same time, you wake up and you see these retaliatory countermeasures to U.S. tariffs. What narrative do you think will prevail?
Look, I think the narrative clearly for the US is that put from, or that we thought was there from the US administration. Either the strike price is much further away, or maybe that put doesn't even exist because they want to force in the Fed put. So I think that narrative, particularly for US risk assets, and frankly at some point also for globally for risk assets more broadly, will really prevail in the next couple of weeks, because ultimately for a sustained, for a sustained reversal higher, we will need to see some kind of nod from the Fed to say, okay, you know what, we are monitoring financial conditions, we are monitoring market developments. And let's remember that was actually already enough in the December 2018, January 2019 episode. You know, they were starting to cut rates only in July 2019, but in January already had that bullish reversal, because all the Fed had to do is to say, well, financial conditions are, quote, notably tighter than they were in September. That's all they had to do. They only had to say notably tighter. And already markets were saying, that's the Fed put, that's it. So we're not talking QE, we're not talking emergency rate cuts. What I'm talking about is literally just like a verbal nod from the Fed that we need. And that already, I think, from a fundamental perspective, would that change that narrative that we've just been talking about.
Hey, Max, appreciate it. Thanks for the update. Max Kentner there of HSBC on the equity market. The Federal Reserve decision a week today. Later this morning, 8:30 Eastern Time, US CPI. So look out for that. That's your data point of the morning. Let's give you an update on news elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just hours after Donald Trump's 25% tariffs on steel and aluminum imports went into effect, the EU launched countermeasures against new U.S. metal tariffs. The EU plans to impose its own duties on more than $28 billion worth of American goods. The EU will immediately begin consultations with member states. The tariffs are expected to start next month. House Republicans passed a bill to keep the government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. If a shutdown goes ahead, the White House Budget Office would decide which federal workers are furloughed and which essential staff must continue without pay. Elsewhere, Chinese authorities met with Walmart executives to discuss the company's negotiations with suppliers in China over price cuts due to increased U.S. tariffs. The authorities warned that Walmart's demands could fracture the global supply chain, hurt the interests of both U.S. and Chinese companies, and affect American consumers. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this morning. Up next on the program, the president doubles down.
We've been treated very unfairly by Canada. We've been treated very unfairly by Mexico. But we've been treated very unfairly by every country all over the world. The European Union is horrible.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom.
Up next on the program, Adam Posen of the Peterson Institute, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Equities bouncing back by 0.5% on the S&P 500. We have seen some changes, some downgrades. HSBC, spoke to them just moments ago, downgrading US stocks to neutral. Citi doing the same thing. Goldman cutting its S&P 500 forecast, the first big bank to do so. They dropped that from 6,500 to 62. Under Savannah's this morning, we've got a president doubling down.
We've been treated very unfairly by Canada. We've been treated very unfairly by Mexico. But we've been treated very unfairly by every country all over the world. The European Union is horrible.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
So here's the latest this morning. President Trump's 25% tariffs on steel and aluminum going into effect after he walked back a threat to double levies on Canada. Your team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Divya Balji over in Toronto. Tyler, I think we have to take a step back and just think about the last 24 hours. Can you just summarize the tension between the Americans and the Canadians?
Yeah, good morning, John. This really caps off the latest on-again, off-again trade policy for this White House. And we should also mention that in those comments yesterday, President Trump went on to triple down that he is not watching the stock market in response to any of these tariff moves. Now, Commerce Secretary Howard Lutnick, Bloomberg News is reporting, led those negotiations with the Ontario Premier in order to have him drop that 25% electricity tax that was threatened and caused President Trump to say that he was going to up the tariffs on Canada today to 50%. Once those negotiations happened, the U.S. ended up dropping that tariff back down to the original 25% for Canada. Now, importantly, this will hit Canada particularly hard since it's the top exporter of steel and aluminum to the U.S. But, John, the White House confirming that there are no exemptions for any countries to the tariffs today. Domestic steel producers and aluminum producers have largely applauded this move, but we have to keep in mind that this does apply to those other downstream metal products like car bumpers and wires, and we have to be watching manufacturers closely here on whether or not they signal that they could up consumer prices. The auto sector in particular already sounding the alarm that the majority of their supply chains are concentrated in North America, and this could cause some severe disruptions.
Divya, let's bring you into the conversation. What's the status of this relationship right now? Has the president even gotten on the phone with the new PM, Mark Carney?
No, I mean, we definitely haven't heard of them having any conversations yet. I mean, I think if you think about Mark Carney, he does have a whole bunch of things going on, including the fact that there needs to be elections. But, you know, the fact that Trump is just talking about how terrible Canada is to the U.S. and all of these tariffs are still in place clearly shows you that the relationship is fraught in a sense. You know, you have seen a little bit of a better relationship with Ontario's premier, but with Carney itself, I think we are waiting for that conversation to happen, you know, just to see where will this go. Canada still has to add on a few more tariffs or a few more goods into the tariffs in about 2 weeks. Is that going to happen? I think there's still a lot of questions out there.
Divya, I appreciate the update. Alongside Tyler Kendall breaking things down in both DC and in Toronto. To extend the conversation, Adam Posen of the Peterson Institute joins us now. Adam, let's take a step back as well and just think about things. I know this is something you've pondered. The economic consequences of weaponizing uncertainty, what are they?
They're bad, John. The basic idea that President Trump came in with and was demonstrated with the tariff approach towards Canada and EU is that if you're the big bully on the block, you threaten people and you say, you don't know if I'm going to do this or not. And various people have said, oh, see, it's just a negotiating tactic. But it's not like negotiating with the Soviet Union in an arms race where you're dealing government to government with one other actor and they can't afford to risk you're going to do nuclear weapons. In economics, you're dealing with billions of decision makers making hundreds of billions of decisions. So even if you're scaring the Canadian government, which you're not, then all kinds of people, businesses, investors, households react. And what you get instead is just this general miasma of uncertainty we've seen. Now, when I wrote about this last October, warning this was the core of the Trump International Economics Program on migration, on taxes, not just on trade. Some people said I was overdoing it. And I admit, in the forecast you and I have discussed before, I thought it wouldn't go this bad this quickly. But it was clearly the dynamic at work. And when you see the outsized chilling of investment, the outsized chilling of consumer spending, and also the retaliations we're seeing from Canada and Europe, it's clear that this policy is backfiring.
Adam, is the uncertainty worse than the actual tariffs itself? Could the uncertainty push the United States into a recession?
It's a fair question, Anne-Marie, and I think both are really bad. But the uncertainty is the more immediate threat. And I do think the uncertainty could possibly push the U.S. into a recession. I think it's more likely that we'll come out of this with just a slowdown. The reason I'm being unsure is that the uncertainty does hold, and it does affect investment behavior, consumer behavior, the willingness of others to trade with us. But at the same time, there are things fundamentally resilient about the U.S. economy. And so if the uncertainty gets amped up because they do more aggressive actions on migration than deportation, or because the fiscal policy becomes very uncertain, or because they start talking about tariffs, as Kevin Hassett did, as a replacement for income tax, and thereby increasing the uncertainty about working people's incomes. All those channels could get you the recession in the U.S. It's always been if they overdid it on the tariffs, on the migration, on the fiscal policy, it would sow its own demise.
Adam, you've been out front saying that tariffs are inflationary, and a lot of people in markets have agreed with you. There has been a shift, though, or the emphasis is now on the recession potential or some sort of downshift in growth versus the inflation. We get CPI in a little more than 2 hours. How are you viewing this offset of inflation and slower growth, and which is to win out at a time where a lot of people are, frankly, based on market activity, confused?
Lisa, it's right for people to be confused. That's what uncertainty means, right? That there's legitimate reason to be confused. That's as opposed to risk, which shouldn't be confusing. In my view, I think that what's baked in is the inflation. That whether we get stagflation, meaning recessionary forces of the kind you're talking about, along with the inflation, or whether we continue to get growth along with inflation, I think the inflation comes either way. This is not just because of tariffs, although that's a big part of it. What you're seeing is a real income loss for American families, American households, and a real income loss for the vast majority of small businesses that rely on imported goods and imported inputs like Canadian energy or Canadian steel. And so when there's a real income loss, people try to adjust.
Yeah.
They have to. And so part of it is recession, they cut back, but part of it is they raise their prices, they demand higher wages. And the balance of those is affected by the monetary policy. And since we're in a period where the Fed was, as we've discussed previously, in my opinion, too loose, in which the economy had not gotten back down to a stable low level of inflation to the full extent, and in which we're at close to full employment, because we're still at 4% unemployment, that the risks of inflation accelerating are quite high. So I think you're going to get the worst of both worlds. You're going to get inflation either way, and if a recession comes through these policies, it's going to be stagflation, not pulling down prices.
Adam, you're in Washington, D.C. Just quickly, how much consensus among the people who you speak to behind closed doors is there that maybe the uncertainty has gotten away from itself?
Not enough. It's very evident, but there's a lot of pushback. There's a lot of people saying, relating to what Anne-Marie just said, that, well, in the end, we're going to have this wonderful outcome. I'm reminded of Brexit when the UK did something similar to itself, declaring a trade war on itself. And people kept saying, like Boris Johnson, there'll be sunny uplands. Well, investment in the UK has been flat, basically, for 6-7 years. I don't think we're going to get that in the US, but you're going to get something similar. But no, in Washington, there are ideologues, there are wishful thinkers, there are people who have self-interest and denial. That's why I'm glad to have the opportunity to talk with you, because the markets and the people who have money on the line have to make it clear this is a destructive policy.
I was happy to talk to you until you brought up Brexit. This is a Brexit-free zone, Adam Posen. Adam Posen at the Peterson Institute. Adam, it's good to see you, as always. We've tried to avoid that for the last few years, haven't we?
We did, although it's come up in other ways. Brexit.
There's plenty of other alternatives too. Coming up on the programme, Sheila Kahulu of Jefferies, as weakening consumer demand weighs on the airline industry. Some big changes in the past 24 hours. We'll get into them in just a moment. From New York, this is Bloomberg.
is the Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
So this is your bounce following 2 days of losses on the S&P 500. Futures positive by 0.55% on the S&P. On the Nasdaq 100 up by, let's call it 0.7. Yesterday briefly dropping into correction territory, down almost 10% from all-time highs now, down around 9. I said this yesterday, said this a few times over the past week. That record high in the middle of February, it's not even a month ago. Feels like a lifetime ago.
When you take a look at some of the valuation declines that we've seen there since then, 16%, more than that on some of the banks and the bank index. When you take a look at the NASDAQ, the correction there. A question is, what is going to create, to Max Kettner's point, that cathartic moment? I just wonder how much we're looking at some potential for, true recessionary fears coming through. What happens if it is just sort of this grind lower in the face of uncertainty that does not resolve? And that, I think, is something a lot of people are grappling with.
We're heading towards 4 weeks of losses on the S&P, something we haven't done since August of last year, but it's a big difference between now and August. We saw it in the hard data in August. We saw unemployment starting to inflect high. The Federal Reserve started to get nervous about things going into Jackson Hole when Chairman Powell delivered that speech. This isn't about policy. This is about policy uncertainty, and there is a difference between the two. This is about max uncertainty unnerving people.
And paralyzing companies, right? I mean, we've been talking about how companies have pulled back, individuals have pulled back. We saw that from the airlines yesterday, the idea that suddenly, on a dime, all of the appetite to really spend has shifted. There's a question about why. We've heard the same warnings from Walmart. We've heard the same warnings from Best Buy. At what point does this have a longer-term effect that shows up in the hard data? And when you talk about policy uncertainty, how does the Fed respond at a time where prices might be not going down anytime soon?
There's an extra wrinkle in this story. I want to turn to the bond market. So yesterday, the president doubling down on things with one of America's largest trade partners, and the bond market didn't offer comfort. Yields weren't dropping. Yields were all over the place. And I think this is what's really hard about this moment for financial markets, for allocators. The bond market's behaving in a really unpredictable way, day to day, depending on the stimulus. And you can have the same catalyst and you'll respond in different ways from day to day. And I think that's really problematic for a lot of people.
Yesterday it was the JOLTS data, which is actually backward looking, and everybody poured cold water on it before. But the fact that the quits rate, an indicator of just how much mobility individuals think they have, the quits rate went up to a 6-month high. This indicates strength. If this is an otherwise strong market, and you have an inflationary shock or a one-time price adjustment, as Scott Bessent would say, when it comes to tariffs, how much does that trickle in at a time where there are pressures, and we've seen this on Walmart, about how much they can pass along to ultimate consumers?
The 10-year this morning, let's call it 4.28. On our radar this morning, President Donald Trump downplaying recent market turmoil as tariff headlines whipsaw markets.
Markets are going to go up and they're going to go down.
Yeah.
But you know what? We have to rebuild our country. Our country has been stripped of its jobs, of its factories. Some people are going to make great deals by buying stocks and bonds and all the things they're buying. I think we're going to have an economy that's a real economy.
So let's take a beat on this because I think it's important. I think we understand the president's plans, and they've been articulated by Secretary Bessent pretty clearly. We've said this a few times on this program. Lots of government on the border, tariffs, immigration, a lot less government inside the border. Doge, tax cuts. I think we all understand that. So if you want to rebalance the economy from the public sector to the private sector, pull back on government spending, acknowledge there will be some pain, some disruption in the near term, got it, we'll end up in a better place. That's the plan, that's the goal. Let's put that over here. Let's focus on tariffs. I said this moments ago, with tariffs, it's not the policy. I'm prepared to be incredibly open-minded about the consequences, how people respond to it, what's going to happen. Got it. But at the moment, we don't know what the policy actually is. It's the policy uncertainty that's problematic at the moment. If you give a business a headline, 10% tariffs, 15, 25, they'll work with that. As TK would always say, they'll adapt and adjust. If you tell them 1 minute it's 25, the next minute it's 50, then we've got a problem.
Especially because that increase to 50, is this the drug war? Are we responding to fentanyl now? Are we responding to retaliatory tariffs? Does this go into the bucket that we're supposed to learn about on April 2nd? Or is this the bucket that we heard about a couple of weeks ago? These are the types of paradigm uncertainty. It's not just a strategy uncertainty. It is a question of ultimately how you are going about really separating the U.S. economy from the rest of the world. What can Canada give us? Do we want to separate it entirely from our market? If that's the goal, it would be important to understand why that is helpful to the strength of the economy.
It doesn't sound like executives also left the business roundtable yesterday having certainty, understanding from the president exactly what the plan was going to be. You talk about Scott Bessent. He has said, the Treasury Secretary, Wall Street's done great. We're trying to move to Main Street. Well, guess what? When you look at mainstream press this morning, there's headlines like, what does this all mean for your 401k? This is starting to become a problem for the president with some of those individuals that are in his base politically.
If you're waking up this morning, you're waking up to more tariffs. We got the 25% tariffs on steel and aluminum. Also waking up to a response from the EU as well. The European Union retaliating, planning to impose duties on $28.3 billion worth of US goods. They've snapped back almost immediately, and they're set to continue doing the same thing in the next month or so.
April 1st and then the middle of April for a bit more of tariffs in retaliation to what the United States is doing. Something that really stuck out for me from the Europeans talking this morning. The EU is planning to hit beef and poultry from Republican-led states, Nebraska and Kansas, said one of these officials.
Playbook.
Exactly. Also, they're going to look at tariff retaliation to include House Speaker Mike Johnson's state. So that, what do you think when you think Louisiana? That's going to be a lot of agricultural. That's going to be energy. They're going to find other places potentially to send a message to the president. We will hit you where it hurts.
If you're worried about inflation, there could be a piece of good news out there, and it could be coming from Ukraine, accepting a U.S. proposal for a 30-day ceasefire with Russia. In return, the Trump administration will lift the freeze on military aid and intelligence. If this administration can tackle this, if they can do something about the energy story, not just in America, but worldwide, because think about what's happened to the price of energy since this war started, then you've got a much, much better picture for energy, not just in America, but perhaps in Europe too. And then maybe you can paint a better picture for inflation as well.
This is a point that Treasury Secretary Scott Bessent has talked about extensively, that essentially the idea is to bring down energy prices and to generally reset trade. There's going to be a readjustment period or detox period, and then it will be okay. This also is interesting because it shifts the onus for the U.S. to now pressure Russia to really accept this deal. And now the real leverage has to come from how the U.S. goes about doing that when Russia really has not been as much a part of some of the contention in the past couple of days.
We'll bring you another update on that story a little bit later on this morning. Let's talk about some of the stock moves we've seen in the past 24 hours. Weakening consumer demand leading to a sell-off in airline stocks. Delta spooking investors after cutting its profit forecast in half. Sheila Kahlo of Jefferies joins us now for more. Sheila, good morning.
Good morning.
Big changes. What did you see? What you were tracking in the last month or so? What's happened with these airlines?
We have a data series that tracks airline traffic on apps and folks pre-booking. So that data fell off about 10% over the last 3 months. So trailing 3 months, but the 3 weeks really fell off. It hit the lowest cost carriers the most. So back to Anne-Marie's point, it's in the heartland of where we're seeing the demand fall off. But Delta signaled a 50% revenue cut. They guided Q1 7 to 9%, then they cut it to up 3 to 4. So still positive, as Ed Bastian said. We're not in recession territory, but January and February, which is the last time we heard from them about 3 weeks ago, was positive growth. And so that means the last 3 weeks really decelerated. So Q2 is going to be very important because it's about 40% of airline earnings.
As we strip out some of the motivating reasons for why we saw such a deceleration in demand, can you track the fall off in airline ticket purchases to some of the safety issues that were raised?
That was cited by both American and Delta yesterday, but it was across the board, and that's what I think startled so many folks. It was Delta close-in booking, so people book airfares closer to when they're actually going to travel. It was also corporate demand softened. We've seen that in BizJet utilization data as well for February. And then third, it was demand across government, which United has about 4% of ASMs and American has 1.5%. So it was across the board. It was Trump's policies, DOGE really impacting government employees, corporates slowing down, and then, just leisure demand slowing as well.
We heard from Delta that they plan to cut capacity to meet slower demand heading into the summer. What does that indicate to you about just how temporary this is, or if potentially some of the airlines are preparing for this fall off to continue for a longer period of time and hoping to increase prices to compensate for it?
I think domestically in the U.S. market, capacity is already very tight. That was the story of the first half of last year. Capacity grew 6 to 7%, and then we exited the year about flat. And the data, TSA volumes are flat year over year, but so is capacity. So capacity is already fairly tight. So that's a soft comment from Delta to make to cut capacity. We have to see demand come in, and I think the next 4 to 6 weeks is going to be very critical to see how the U.S. consumer is going to react.
Where does the demand come in? I think we were all struck around this table yesterday when a headline dropped that United said 50% drop in government travel. Who fills that void?
It's hard. I mean, it's a small percentage of ASMs, but then Delta also cited corporate demand across the board. Aerospace and defense was, of course, the sector cited, as well as leisure. So it wasn't only one thing, and I think that's what is, more concerning about the reads. But again, it's early, and so that could change. If the S&P goes up for the next 4 weeks, I'm sure people will start booking travel again. So it's all based on market sentiment.
What's more challenging, domestic travel right now or international?
Domestic is more challenging. Domestic has always been because you have low-cost carriers. And so they price down. You see tickets from Spirit, other low-cost carriers for very cheap. International is still very positive. And the good news is A350s and 787s are very slow on the deliveries. So we're not seeing a lot of capacity come into the market. In fact, that market's very constrained.
You suggested it's equity market dependent. I might suggest it's DOGE dependent. If I'm a federal worker this year, I'm not traveling. If I've booked a vacation, I'm cancelling it. If you've got to raise a family at the moment and you're dependent on the federal government for your annual salary, I'd be very, very nervous about the rest of the year. How is that showing up in the numbers already?
It's a small percentage of the market, but I think DOGE in general, the headlines covering defense stocks it's what's scariest. Some of the headlines they put out are not actually the reality of what they're cutting. So again, it's going back to the uncertainty of a big headline and the reality.
Talk to us about that. What are they actually cutting when it comes to defense?
It's interesting to me because I thought they would go after larger, more bureaucratic issues, but instead they're going after IT services contractors, which the 6 public ones we cover comprise about 3 of the largest defense programs. So I thought they would eliminate more waste, but they seem to be cutting very quickly and very abruptly, so without any precision, which I think creates problems as well.
How much of the story is this? And I ask this because yesterday I saw some comments out there, like if government spending was the main pillar of support for the U.S. consumer, then we had a pretty weak consumer, aside from some of the stimulus that was really injected into the government. Can you talk about what we've seen in terms of consumer spending habits leading up to this and then in the aftermath, and just how connected to the federal spending it is versus the overall tone? I know it's hard to parse out, but it kind of gives a sense of where we're coming from.
I think it's the government employees. If you're a government employee, you're probably not traveling. But again, that's such a small percentage of the market. And some of the agencies we're cutting from, they've already had trouble recruiting. And we've just gone back to pre-pandemic levels 6 years later. So I think it's very problematic just cutting abruptly. And I do think the airline cuts go back to consumer sentiment on the overall market, as we've all seen our stock prices have.
What's your favorite name this morning?
I'm going to actually pitch Boeing. I really like Boeing. I think outside the tariff headlines, the macro, we haven't delivered a single plane in 6 years. The skyline is oversold. And I think investors have capitulated on just demand. They think we're going to see demand destruction because the market softened for the last 3 weeks. But I think everybody's still waiting for their plane and is not going to get out of line. So,
Sheila, I appreciate it.
Sure.
It's good to get up to speed with you. Thank you. Sheila Coley there of Jefferies. Equity futures right now, near session highs up by 0.6% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Department of Education is cutting its workforce by roughly half. The department said that it's cutting 1,950 staff positions, including more than 1,300 federal workers. It's the Trump administration's first step in dismantling the agency. Staff at the Fed met with Elon Musk's Doge team in January. A new court filing shows that staff cooperated and discussed access to federal payment systems. The meetings took place 2 weeks before Powell's testimony to the House Financial Services Committee in mid-February, where he said the Fed, quote, had no contact with Doge. Paris Saint-Germain beat Liverpool 4-1 in a penalty shootout to advance to the Champions League quarterfinals. PSG evened up the aggregate score with a goal in the 11th minute and kept Liverpool scoreless for the remainder of the match. They now join Barcelona, Bayern, and Inter Milan in the next round. And that's your brief, John.
Donnarumma, absolute beast. Danny, thank you. More from Danny a little bit later. Up next on the program, President Trump back in the first buddy.
Because he's able to find billions and billions and billions of dollars of fraud and waste and all of the things. I mean, our country is going to be very strong very soon.
Dan Ives of Wedgebush joins us next, live from New York. You're watching Bloomberg TV.
In case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
So here's the bounce. Equity futures up by 0.6% on the S&P 500. In the bond market, just about unchanged. The 10-year 427.98. Under surveillance this morning, President Trump backing the first buddy.
Because he's able to find billions and billions and billions of dollars of fraud and waste and all of the things. I mean, our country is going to be very strong very soon because of a lot of the things that he's done and a lot of the things that I'm doing. And there's no better team, but there's no better for what we're doing. There's nobody like this, and he shouldn't be penalized.
So here's the latest this morning. President Donald Trump expressing confidence in Elon Musk, but investors souring on the CEO's Tesla stock. Shares of the EV maker giving back all of their post-election gains. Tesla bull Dan Ives of Wedbush writing, "We believe this is a moment of truth for Musk and Tesla. If he continues to head down the Doge path 110% and showing no attention to Tesla, then brand damage will become more pervasive." Dan joins us now for more. Dan, welcome to the program, sir. This was not what you thought a number of months ago, so what changed?
Look, I mean, we've talked about autonomous, deregulatory. That was the bull case, and that continues to be, because autonomous is going to be the key for Tesla. But, John, no one, including us, expected that when you look at Trump, Musk would essentially be living in Mar-a-Lago, living at the White House, 110% in Doge. And this has been, I think, clock struck midnight. I mean, this is now at a point where it's a tipping point where Musk needs to focus back on Tesla. And that's why I say it's a moment of truth. We've been here before, but this is, I think, tipped the scales, and we're seeing it in the stock.
You're right to say we've been here before, because we have, Dan. We used to talk about this with regards to SpaceX, that he was leading loads of different companies. It wasn't a problem then. Why is it a problem now? What's happening at Tesla that says to you it's missing its boss?
Well, it's because of brand. Because the last thing that you want is Tesla to become a political symbol, you know, viewed as Doge or Trump or whatever you want to say. And that we've already seen, whether it's demonstrations and some of the concerns and some of the protests that we've seen globally, look, that could all fade. And that's still contained at this point. It's the best car, and in terms of best car selling last year in 2024, Model Y. The issue now is they have the biggest sort of technology innovation ahead when it comes to FSD, unsupervised Austin, a new model coming out in the summer. You know, what I ultimately believe is really the start of this whole robotics and autonomous future. But now you need Musk to lead. It's time to come home and start to focus back on Tesla. And that's been a huge issue here. Investors have given, you know, sort of some flexibility. But now it's hit a tipping point. I think you've seen it in the stock. Frustration's building.
You said it's time to come home, Dan, and we heard from Elon Musk saying that he's going to be with the Doge effort for at least another year, or about another year. Is that enough, or does that make you think that you need to downgrade your outlook?
Yeah, at least I'd be surprised if that happened. In other words, like, my view is that I think he's going to have to see the writing on the wall. We know, look, we've been here, but we've talked about this, whether it was SpaceX, whether it was Twitter. We go back to other issues, 2018, 19. I think he's going to start to get the message. Now, look, it could take some time, but I believe this is when he's going to have to start to balance his time. He could still be focused on Doge. You have to be CEO of Tesla at this point. And look, Trump buying a Tesla, I mean, it's not moving the needle. And to some extent, it actually have a negative impact relative to the political symbol. And I think that's the frustration here, you know, when it comes to Musk and Tesla.
Dan, less than a month ago, you said the best is yet to come. You said you think it's going to be a bet for the ages in terms of Musk on Trump. When it comes to autonomous, it's worth trillions of dollars. That continues to be the golden goose, and it's what they're focused on. You thought his proximity of power was going to unleash this epic demand for Tesla. What happened?
Well, look, I mean, medium and long term, it's that. In other words, autonomous is the future. I believe the federal autonomous roadmap will be there, and that ultimately all of this would actually just be noise relative to what could happen in terms of what that means. That's worth $1 trillion of the story, and that's why I think this is probably the biggest sort of physical AI play out there. But that said, this near-term situation is unsustainable. And I think no one expected that he would dive so into the deep end of the pool when it comes to Doge. That's where he's spending all of his time, always in Mar-a-Lago, always the White House. And I can tell you from Tesla shareholders, it's at a point where white flag's up. He needs to change, needs to balance. Otherwise, everything we talked about, autonomous, bet for the ages, this negative, the brand issues, that then starts to actually taint some of the long-term impact that's our concern here, and that's why, you know, we're really communicating that to Tesla and the board.
Dan, I have to be honest, I don't think I've ever heard you this as unenthusiastic about a U.S. tech stock ever. I mean, next time we see you, you might be wearing a black suit. I'm just wondering, can you look back in your history of calls and ever felt this uncertain about a name that you were quite enthusiastic about just a couple months ago?
Oh, we did it with Tesla during the Twitter situation. We've done it with Tesla. If I go back 2018, 19, sometimes it's tough love, right? I mean, Tesla is probably one of the names we're most bullish on in all of tech. And I continue to believe, you know, tech is way oversold. But you got to speak out, because when I talk to thousands of investors around the world, I need to communicate what I believe Musk needs to do now for that long-term story to play out. And that's what needs to happen. Silence just can't happen. You can't be glass half full. Given the situation, what's happening here with Doge and some of the brand issue and the worry about distractions and where he needs to be focused on his efforts.
Dan, to Lisa's point, you don't sound like a man with a 550 price target on a stock that trades at 230. So Dan, what gets us to 550?
You get through this period, he starts to get more dialed than Tesla, and then, John, we're sitting there in the summer, that sort of golden case is there in terms of autonomous, FSD, unsupervised, and the long-term story. You got to get through this near-term turbulence to get to the gold at the end of the rainbow. Now is the time. It's a moment of truth. Musk needs to step up.
Just to understand your framework, if we get to the summer and nothing's changed, does your view change?
Look, if nothing changes from this on, then obviously brand issues would be a lot bigger, and that's something that could start to taint the story. I believe the longer term story continues to be this is going to be a $2-3 trillion market cap. But he needs to get through this period, because this is not serving anyone well. And I think that's really the message from Tesla shareholders.
Dan Ives of Wedbush. Dan, appreciate it. On Tesla, big drop-off in the past month, that's for sure. Big change for Tesla stock.
Big change for Tesla stock, and a lot of this has to do with the brand destruction and also the time he has spent at the White House. I mean, Dan is right in the sense that he is always by the president's side. You called him the first buddy, and there's a reason why. Laura Trump dubbed him that. He's at the White House, he's at Mar-a-Lago, and he said just to Fox News this week, with great difficulty he has running his companies.
What'd you make of the outrage? The president with Tesla in front of the White House. No one did this with GM and Mary Barra.
It looked exactly like what Joe Biden did, and I was there on the lawn when he took that Hummer for a spin in August of 2021, and everyone was talking about, where's Tesla? Why'd you snub them?
If you have an outrage bucket, fill it with something else.
This is probably not the right one, right?
There are other things you can fill your outrage bucket
Honestly,
with.
what is it? Why can't we cover these stories objectively? If the president does it, President Trump does it, it's bad. President Biden, it's good, it's fine. There was no problem with GM and Mary Barra.
I actually think Trump bought the car, though. I don't think Joe Biden was shelling out to buy that.
You're just giving free marketing to GM. That's the difference.
All right, okay.
Anyway,
Listen.
Up next on the program, Alicia Levine of BNY Wealth, Adam Hodge at Bully Pulpit International, Charles Schwab CEO, Rick Wurster, and Lindley Brown of EY. From New York, the second hour of Bloomberg Surveillance. Up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, No one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, Marcel, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The market is in very much a show-me state, and the only way that you get there is clarity on inflation.
The consumer right now is tightening their belt a little bit.
There's still a good amount of spending and borrowing power.
The U.S. consumer market simply isn't driving the global economy bus.
The data's going to get worse, and inflation's not going to be as strong as they think.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures positive by 0.7%. We've hardly talked about it so far this morning. The main event is 90 minutes from now. It's US CPI. US CPI a little bit later this morning. Really the last major data point going against the Federal Reserve next week. That decision a week today.
And it's taken on renewed importance as people are trying to figure out which they should weigh more, the idea of some recession fear or the idea of stagflation fear. It matters at a time where potentially the Fed could offset some of the uncertainty with more certainty around their policy, but not if their hands are tied by hotter than expected inflation.
We're bouncing back this morning by 0.7% on the S&P 500. We have seen a series of downgrades, though, from Citi, from HSBC, and this morning from Goldman, dropping their price target on the S&P 500 from 6,500 to 62, and pointing to what most people are pointing to, policy uncertainty.
The uncertainty is what's hurting the market. I mean, if Trump comes out with maybe tariffs, but at least you know the direction of travel, that's one thing. But this uncertainty whipsawing within a day, a roller coaster of tariffs when it comes to aluminum. You know what Alcoa had to say? This is going to increase the price of things like beer cans for consumers. And that is the problem you have, especially on a day like CPI.
You're not going to get clarity anytime soon, because in early April, we do this in a much bigger way. The administration is telling you the big one comes in early April. This isn't it.
And it really is going to lead for more of the tit for tat that we're already seeing, where you get responses from, say, Europe or, say, from Canada. Going back to what David Kostin of Goldman Sachs was saying, and I think it's an important point, when you have uncertainty, you have greater implied volatility on a day-to-day basis, and we're seeing that in the VIX. And that alone means that you need to take some of the valuation off some risk assets, because volatility is a cost, and you can't be as reliable, you can't rely as much on returns from those assets. And that, I think, is what people are increasingly trying to game out.
When it comes to April 2nd, a lot of analysts have come on this program and said that's going to be peak uncertainty. But April 2nd, we might just get the announcements, and then it could be 3, 4, 5, 6 months before the tariffs actually come into play, which means we can be dealing with this paralysis and uncertainty for months. This stuck out to me today from the Wall Street Journal. The president's economic advisors have warned him that tariffs could hurt the market and economic growth, but he has largely been undeterred.
2 months ago, what did we call it? The golden age of volatility. And that's what we've seen. over the last few months, that's for sure. Session highs on the S&P 500. We'll see if it sticks. We're higher by 0.75%. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth ahead of fresh U.S. inflation data, Adam Hodge of Bully Pulpit International as new tariffs take effect, and the Charles Schwab CEO, Rick Wurster, following Trump's meeting with business leaders. We begin this hour with stocks looking to snap a two-day losing streak as traders await U.S. CPI at 8:30 Eastern Time. Alicia Levine of BNY Wealth writing, equity market is pricing in the extreme of policy and a worst-case scenario. We think the growth scare, for now, remains a scare and is consistent with a soft patch. Alicia joins us for more. Alicia, good morning.
Good morning.
Good to see you. What would you suggest people do then, given the correction we've seen?
So I think we saw it a little bit yesterday when the S&P hit that kind of down 10% correction mark. You saw buyers come into the market here because for the most part, if there's no recession, a market down 10% tends to have pretty positive returns in the 12-month forward. And so I think that's part of why we saw the market rally towards the end of the day, because it was sort of a magic point in the market. And when markets come down this quickly, it's been so fast. No time to breathe here. You're ripe for a bounce, at least. And so I think that's part of what we saw yesterday.
Can you point to the dominant driver? There are some people out there who are suggesting this is not just about tariffs, this is something else. Because we are seeing big moves in things like Palantir, things that aren't really associated, typically what you'd consider to be associated with tariffs. What do you think of the overall price action?
So I think there's a couple of things going on. I mean, the really interesting observation here is if this were only about tariffs and the impact on growth and inflation, kind of a stagflationary mix that you've been talking about, we wouldn't see Europe outperform, we wouldn't see Mexico outperform, and we wouldn't see Canada outperform. Because in the end, it's the trade deficit that the U.S. has with our trading partners that would make the U.S. more immune to the impact of tariffs than our trade partners. And yet those markets have outperformed. So clearly there's something else going on. It's not simply about fear of tariffs in the cross-asset trade. There is a momentum unwind here. You know, the multiple was high, not terribly high, but high enough to unwind. And as you know, we talk about this all the time, the markets live in the second derivative. So if the U.S. performance or earnings are slightly worse than expected, and Europe is slightly better, that's enough to have Europe outperform in a world for 15 years. It's underperformed, is trading at lower multiples, and seems like a more interesting place to park some capital right now as the U.S. sorts out all of its issues right now as we kind of have a bit of a regime shift in administrations.
Momentum unwind sounds a lot more palatable than just peak uncertainty that isn't going to resolve and that could potentially slow growth in a significant way. How can you tell if it's just a momentum unwind versus something more entrenched that will have real economic consequences down the line?
So I think if this were only about the fear of a growth slowdown, you wouldn't see the rest of the world doing so well, because as you know, when the U.S. catches a cold, the rest of the world has the flu. So what you're seeing it in the cross-asset trade telling you this is a bit of valuation unwind, perhaps the semis and the tech trade. DeepSeek, I think, was a large break, and that's the beginning, really, of where you saw all of this really start coming undone. That was really early January. It was in mid-February with the rest of the market. Those stocks have really been on a slow leak downward since the DeepSeek announcement. So this is more than just a growth scare. And on the other side, like on the bond market, yes, the bond market is priced in more of a slowdown with 3.5 cuts expected this year, but you're not seeing the 2-year collapse. So there's something more going on here, right? It's a soft patch, it's a slowdown, and there's some reversion to the mean in other equity markets. We have our clients say to me, you know, for the last few years, why are we diversified? Why do we own bonds? Why do we own the rest of the world? Why am I just not piled into the U.S. equities? And we say, there'll be a day where you'll recognize the power of diversification to smooth out your returns. And we are in that day.
I love this. You're calling up your clients and saying, guess what? It's now. So thank you very much. You're welcome. And here's your returns. There's a question, though, that we heard from David Kostin of Goldman Sachs, which is the degree of uncertainty requires a higher risk premium just naturally. If you don't have the same kind of risk-adjusted return, then you have to account for that. How do you weigh that in?
So I think that's right. So, you know, we think that there's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more, right? Because what we've known is that the wealth effect, you know, the $50 trillion that households have accumulated in the last 5 years since the beginning of COVID has really helped cushion spending. If you take an axe to that, meaning the market sells off, then do you create a negative wealth effect and do you dent the consumer? That's really the question here. So, yes, there is some risk premium that you have to think about. Again, we get at this through the diversification. Bonds are really getting to work this year as ballast to portfolios. But I think the observation is correct. Earnings probably have to come down, and the multiple has to come down. Even with earnings estimates coming down, the multiple now has come down from 22 times forward to 20 times. So that's already looking better. You're getting to a place where it's more interesting to put your toe back into U.S. assets. In the end, if you're going to bet on growth for the next few years, is it European growth? Or is it U.S. growth? And that's the question we ask ourselves every day.
So you don't think U.S. exceptionalism is dead?
I don't think it's dead. I think it's taking the pause that refreshes. The question is, how long is the pause? This concept of short-term pain for long-term gain. I like to say, well, the long-term is made up of a lot of short-terms, and none of this is linear. So the longer this goes on with tariffs here, tariffs there, well, we're going to take it back, that can have its own negative feedback loop. For now, we think the scare is precisely that, but are open to the thought that it might unwind further.
There's a line in your notes that I love. Market is trying to force a policy response from the Fed or the White House. Do you think they do it?
So I think you're starting to see it a little bit on the Fed side. I'm just going to say that, right? We've got a week from today. The White House is trying to signal, and I think they're using the market to signal that they're serious, and that's also a negotiating tactic.
Do you think this White House is trying to engineer a Fed cut?
I think they're trying to get the 10-year down. I'm taking the words of the Treasury Secretary very seriously. He said it on your program, February 6th. We're focused on the 10-year. That was the signal to the market. I take it very seriously. I think the whole market does.
He said it repeatedly. I want to finish on this. We mentioned US CPI. Haven't talked about it again. How relevant is that data point?
Oh,
30.
Terribly relevant. Terribly relevant, because it either reaffirms the concerns about a stagflation rate or it doesn't. And so I think you're going to see volatility around it. If it comes in even slightly better than expected on the 100th decimal point, market could have a massive rally here.
Alicia,
look at the put buying. The put buying is off the charts.
Stretched. It's a word I've heard a lot in the last 24 hours. Alicia Levine there of BNY Wealth. Look out for US CPI, 1 hour and 20 minutes from now. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Another downgrade to U.S. stocks. Goldman has cut his S&P 500 year-end target to 6,200 from 6,500 and said that the Magnificent Seven have become the Maleficent Seven. The bank cited lower GDP growth, higher tariff rates, and a higher level of uncertainty. Goldman also lifted its view on European earnings. Ukraine has accepted a U.S. proposal for a 30-day truce with Russia in exchange for aid and intelligence. That followed 8 hours of talks in Saudi Arabia on Tuesday. The deal includes prisoner swaps and Ukraine mineral development. The U.S. will now seek agreement from Russia's President Vladimir Putin. Elsewhere, Uber has terminated its deal to acquire Delivery Hero's Food Panda business in Taiwan after the island's antitrust regulator rejected it in December. Uber is required to pay a termination fee estimated to be about $250 million and will not pursue an appeal. That's your Bloomberg Brief. John.
Danny, thank you. More from Danny later on this hour. Up next on the program, doubling down on tariffs.
The president is unwavering in his commitment to restore American manufacturing and global dominance, and I think he doubled down on that with his new statement and the tariffs that will be implemented on steel and aluminum.
Following through on those tariffs overnight, 25% on steel and aluminum. Reaction from Adam Hodge of Bully Pulpit International from New York City. Good morning.
is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Tariffs go on, and the sun still comes up in the morning. The world doesn't end. What a beautiful morning here in New York City. Good morning to you all. Equity futures right now on the S&P 500, positive by 0.8%. Under surveillance this morning, doubling down on tariffs.
The president is unwavering in his commitment to restore American manufacturing and global dominance, and I think he doubled down on that with his new statement and the tariffs that will be implemented on steel and aluminum.
So here's the latest this morning. President Trump's 25% tariffs on steel and aluminum taking effect, and the EU is fighting back.
The U.S. administration has opted to pursue a harmful course of unjustified tariffs, leaving us with no choice but to respond, and that's exactly what we are doing.
Joining us now from the nation's capital, Bloomberg's Tyler Kendall from Washington, D.C. Tyler, welcome back. How does this set us up for April 2nd going into next month?
Exactly, John. This White House has often brushed aside retaliation, saying that ultimately it will just get factored into those April 2nd reciprocal tariff calculations. We're going to have to see, though, how long that defense lasts, because while we are still waiting on that final list from the European Union, we are expecting up to $28 billion worth of U.S. goods to be tariffed. And importantly, a senior EU official telling Bloomberg News that the EU is going to target some politically sensitive items in some Republican states like soybeans in Louisiana. Of course, that's home to House Speaker Mike Johnson. It continues actually a recent trend that we've seen, such as from China, for example, this week, announcing that they too are going to retaliate with tariffs against U.S. agricultural products. And if the pile-on keeps coming for U.S. ag, that really could prove to be a pressure point for Republicans in Congress who have long been queasy about the potential impacts there could be for farmers. For example, just quickly, one statistic I pulled, the U.S. agriculture industry lost $26 billion between 2018 and 2019 during the height of President Trump's tariffs under his first term. At the time, the USDA gave payouts to farmers, but this time that might be a little more politically difficult, considering that this U.S. government has spoken a lot about pulling back on government spending. So we'll have to see how negotiations go from here. John, one EU member state will be at the White House today. President Trump is set to meet with the leader of Ireland.
And they have a massive trade deficit when it comes to the United States, actually the biggest when it comes to the EU. So I'm sure we'll hear about that with President Trump. But when it comes to this week, what can we expect on the trade front before April 2nd? Because we do know that Canada is sending some officials to Washington.
Right, and we're going to have to see where negotiations go from here, particularly as the rhetoric with Canada continues to heighten. Here we saw those on-again, off-again plans just yesterday, with President Trump taking to Truth Social to threaten that today's tariffs could have hit up to 50%. But this White House really doubling down that this is about a long-term impact here, that they want to sustain longer-term growth, and they appear to be asking consumers as well as investors to remain patient. But it has spurred some recent reporting from Bloomberg News indicating that this is pushing the White House and Congress to try to get President Trump's tax agenda off the ground a little quicker, try to get some more cash into consumers' pockets as quick as possible as they try to counteract what has been this response to their tariff plans. That means setting up later this week, when we are talking about the negotiations on the tariff front, whether or not any exemptions could come out, we also are going to see side-by-side negotiations as they try to push Republicans on Capitol Hill to get moving on implementing that broader fiscal agenda.
Tyler Kendall with the latest down in Washington, D.C. To build on that conversation, joining us now is Adam Hodge of Bully Pulpit International. Adam, welcome back to the program, sir. I want you to help us understand this. The president says he's focused on the long game, wants to get away from short-termism. He doesn't have to run for election again. There are members of Congress that will have to do that in the next 18 months or so when they face down the midterms and have to start campaigning. What is Congress going to do between now and then?
I think there are a couple big things on the horizon, including the tax bill that you guys have talked about. But I think the point that you've already seen what Democrats have tried to do is make the Republicans in the House own this. Like just yesterday, on the budget bill, they put together one of the amendments that would have forced all the Republicans to take a vote on the wisdom of the tariffs. That is really making the pain acute for all the members of Congress. And I think it's something that you're going to see Democrats try to do to force that issue onto the agenda for the midterms over the next few months. I think the uncertainty in the markets, though, is the thing that I think is driving a lot of the agita in Washington. And so we're going to see how much that tail wags the dog over the next few months.
Adam, when it comes to the Democratic pushback, are they struggling because Biden did keep some of Trump's tariffs on when he was in office?
I think there's a really key distinction there. The tariffs that we put in place during the Biden administration were coupled with huge investments to try to increase American competitiveness. And what you've seen so far from DOGE and the Trump administration is a pullback of a lot of that investment. And so it's created uncertainty for folks in, certainly on the infrastructure side, folks in the clean energy space, people who were counting on major investments in batteries and with a lot of foreign partners investing in that space as well. So I think that is clearly where Democrats, I think, have to try to find a way to articulate a smarter message that it is a yes and proposition. It is, yes, we can be strategic about the tariffs, but we also have to couple that with smart investments that power economic growth. The pullback is really what I think Democrats have an opportunity to harp on over the next few months.
From a sequencing perspective, you worked at USTR under the Biden administration. When Trump says April 2nd, we're going to get tariffs, how do you read that? Do we actually get tariffs, or is there going to be months of public commentary that everyone needs to basically listen to before they come into play?
Anne-Marie, you're absolutely right. I think there will be an initial announcement that we're going to be a process, and then folks will have a chance to weigh in, public comment, and then at some point down the road, you're going to get an announcement on tariffs. But that uncertainty really, again, is the thing that weighs on businesses and weighs on the markets. But I think the steel and aluminum trade is particularly important because you've seen companies and businesses try to get around it, right? I did a little bit of homework for you guys. The Commerce Department in January said that steel imports increased 43.5% in January. So you've already seen businesses try to get ahead of what they think the tariffs could be. And I think over the course of the next few months, you're going to see even more of that as they try to get ahead of whatever uncertainty could come from the Trump administration.
There's a real challenge right now, Adam, for the Democrats, especially after the continuing resolution was passed by House Republicans, where they have to decide whether or not they are going to be the obstacle that potentially leads to a government shutdown next week if they don't allow it to get through the Senate. How do they tackle that in a way that doesn't shut down the government?
Well, I think it's important to remember the Republicans have control of the House, the Senate, and the White House. They control the government, right? So this idea that Democrats are somehow responsible for shutting down the government, I think just doesn't really pass the smell test. And you've already seen in some polling that 20% margin, people are more likely to blame Republicans for a shutdown than Democrats. I think what you've seen the Democrats also focus on are the really painful cuts that the Republicans have put in the bill. Things that are overwhelmingly popular, things like nutrition assistance, things like clean water programs, things like veterans benefits. That is, I think, where you've seen the Democrats try to focus the agenda and focus the conversation on what those cuts mean to everybody. But I think the bottom line here is that all of the Republican budget plan locks in some of the DOGE process, which has so poisoned the well in Denver with Democrats and in Washington. And so I think you're going to see a really united front for Democrats. And if the government shuts down, it wouldn't surprise me. And I think Republicans will end up shouldering most of the blame on that issue.
I guess what I'm getting at, Peggy Noonan wrote an op-ed in the Wall Street Journal a couple days ago where she was saying that for a robust democracy, it's important to have strong parties on both sides. And what she's worried about is she's not seeing it at all from the Democrats, and that she's concerned that they're not really pulling it together to present an opposing message. And instead, there's sort of a lack of a leader, and there's a lack of, well, certain parts of this make sense, but these are the parts of the methods that we don't agree with. Are you seeing any kind of coalescing around that type of message from the opposite party at a time where people are concerned about some of what you just put out there?
Lisa, I think that's a really smart point. And I think the thing to keep in mind is like this budget fight this week is just a preview for the main event later this year on the tax cuts. And I think that is where Democrats have already clearly honed a message around Medicaid cuts and the potential tax cuts for billionaires and the wealthy and corporations. That they feel is a very strong argument for the midterms and throughout the next couple months. And it really coalesces around two very simple ideas: Medicaid cuts and tax cuts. That is something that I think they feel very strongly about, a strong contrast with President Trump and the Republicans on the Hill. That is where I think they can speak to working class voters. And that the key, though, is to very, very disciplined and focused on those issues. That's going to be the whole ball game. And so we're going to see that play out over the next few months. And the tariffs will be part of the backdrop. But I think that the real key for this year is the budget fight.
Adam, can you give us the Democratic perspective on how they're managing things right now with regards to Doge? What do you think about the messaging regarding that? Do you think they're doing the right thing?
I mean, just look at the real dent in Elon Musk's popularity. Right? I mean, think about the dent in support for President Trump's economic policies. Those are all down from the beginning of the year. So there's been some progress, but I think, again, nobody in Democrats have to be careful here. You don't want to root for failure. Nobody wants the U.S. economy to go into a recession. That's bad for Democrats. It's bad for Republicans. It's bad for the global economy. So you have to focus on what are the key issues that resonate with working people, and what's your plan? What's your ideas?
Well, one key issue, just to jump in, Adam, because we're against the clock, forgive me. One key issue might be just to agree that sending thousands of dollars to put on dance classes in Wuhan, China might not be a good use of taxpayer money. Start there and then say, you know, we'll do things better.
Well, but I think what you've actually heard Democrats focus on are the cuts to nuclear bomb specialists or air traffic controllers or veterans. Like, those are a much more politically saleable point that Democrats can focus on. There's no question there's waste and fraud and abuse in the government. The question is, are you have a strategic approach to really shrinking the size of government? And so far, what you've not seen any strategic process so far.
Adam, appreciate your time, sir. As always,
Always good to be with you.
Your opinion. Thank you very much. Adam Hodge there of Bully Pulpit International with the Democratic perspective on a range of initiatives down in Washington, D.C.
A question of if your enemy is making a mistake, do you just let them, do you stand back, or do you present some sort of counter message at a time where that might not be enough?
Equities right now, session highs up by 0.8% on the S&P. Up next, we'll catch up with the Charles Schwab CEO, Rick Wurster from New York City. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Two sessions into the week, we're heading towards 4 weeks of losses on the S&P, something we haven't done since last August. Equity futures at the moment just about positive by 0.8%. On the Nasdaq 100 up by 1 full percentage point. Later on this morning, 1 hour from now, 8:30 Eastern Time, US CPI. With 2 hours until that cash open, let's get you some morning movers. We can do that with Yahara Hackett. Hey, Yahara.
Hi, John. We start with Intel getting a pop here in the pre-market, up nearly 8% after Reuters reported that TSMC has approached NVIDIA, AMD, and Broadcom about a joint venture to operate Intel's foundries. Under the arrangement, TSMC would own no more than 50% of the business. And the reason that is important is it aligns with U.S. interests to revitalize Intel without handing over full ownership to a foreign entity. Next up, we have Walmart. Those shares are now up slightly, pairing their losses from earlier after the retailer got blowback from China for reportedly asking suppliers in the country to reduce prices to offset the cost of tariffs. That way, Americans would not have to pay more for their products coming in from China. So in response, Chinese authorities summoned Walmart executives saying that is not okay. And I know you'll have more details on that a little bit later. And we end on a high note with Groupon shares soaring here, up 20%. They give an outlook that beat analyst estimates. But what I find interesting is what it says about the consumer. This is an online coupon company focusing on services and experiences. So at a time when the consumer seems to be on shaky ground, Groupon may stand to benefit. John?
Yahara, thank you. That name up by 20% in the pre-market. On our radar this morning, President Donald Trump downplaying the recent market sell-off, saying he does not foresee the U.S. going into recession.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
Everybody's trying to get him on this question. What do you think of the market action? Do you think we face a recession? On the markets, he's not biting. Stocks go up, stocks go down. He is not interested right now at all.
And the message is being heard loud and clear that to the extent that in the first term he was regulated by stocks going down, this time around, at least they're going to have to go down a whole lot more to get his attention. And I think that's one reason why people are saying likely this uncertainty is the new normalcy. And that's something a lot of people are trying to work into their analyses.
If you look at what this administration wants to see go down, it's rates and it's energy. And on that front, they're actually doing a pretty good job. The issue with the stock market, I think, really is it's going to start to bite him when it keeps coming up in places like USA Today, front page, what do you do with your 401k money? This is going to hit his MAGA base, and that's really the problem.
Still got to figure out the consequences of all these tariffs as well. It's very difficult to understand how the costs will be distributed, how certain countries will respond. Here's an example of that. Chinese authorities summoning Walmart executives after the company reportedly asked suppliers for price cuts to offset tariff costs. A social media post from Chinese state media warning the demands risk fracturing the global supply chain. So the administration says the exporters will eat it. Walmart tries to get the exporters to eat it, China steps in?
They slap their hands. They say, really, you're going to have your Sam's Club and really drum up a lot of business here in China, and you're going to make all these products. Well, we can play ball too. And this highlights how it's going to be really difficult for companies simply to say to the countries that are getting tariffed by the U.S., okay, you eat this. And they're like, no, thanks. Here, take it back. So then it goes back to this question of how much can they raise prices for consumers that have already demonstrated a general weakening trend? And they're going to have to deal with that.
Clearly, this shows that Walmart is struggling potentially when it comes to tariffs, and they're going to have to pass it on to consumers. So they thought maybe we could get China to take on some of that. I wonder how much this is the Chinese officials getting a message to Washington via Arkansas and saying, we're going to call in your CEOs and we are not doing this. This is your president. You guys handle it.
It's the red state play that apparently the EU is going to play the same playbook in the next month or so.
Exactly. They're going after states that have agriculture, that have energy. Louisiana, they deliberately are talking about going after the Speaker of the House's state to get a message to Donald Trump about these tariffs.
Let's talk about the latest in Congress. House Republicans passing legislation to keep the U.S. government open past this weekend's shutdown deadline. The bill will likely need support from at least 8 Democrats in the Senate to become law.
As Jake Sherman says this morning in Punch Bowl, 8 Democrats are going to have to walk that plank. They had this lunch yesterday, and the prevailing belief, he says, after this meeting was that a shutdown would be lose-lose situation for Democrats. They don't want to be seen as they're signing up for Trump's continuing resolution to keep the government open, but is it potentially even worse to be the party that then shuts down the government, especially as you're trying to go after DOJ for what they say causing havoc across agencies?
Given the headlines we've got elsewhere, I don't even want to talk about the potential of a government shutdown. Equities right now, session highs up by 0.9%. Let's turn to investor sentiment. The team at Charles Schwab writing, with 44 million client accounts, we have our pulse on how America's investors feel about markets right now. We've seen increased engagement and outreach from retail and institutional clients. I'm pleased to say that joining us around the table here in New York, Rick Wurster, the President and CEO of Charles Schwab. Rick, it's good to see you, sir.
Jonathan, thanks for having me in.
Approaching 100 days in the job, have you slept?
It's been a busy period. We've been actively supporting our clients and helping them get to where they need to be in their financial life, so probably not as much sleep as I would like.
I'm sure you're probably not going to catch up on sleep anytime soon, given the headlines we've got elsewhere. Looking at those 44 million client accounts, just help us understand what activities look like, how they're responding to all of this incoming information.
Our clients are actively engaged. Last year, we did about 6 million trades a day on average. In January, we did 7 million. We're doing even more the last 6 weeks. So our clients are engaged. We're not seeing any signs of significant nervousness. In fact, we've seen our margin levels over the last month stay relatively flat. Those with margin have been leaning into equities the last week. You know, I went and visited 5 of our retail branches in North Carolina yesterday, and I walked into our Raleigh branch and met Gloria, who's at our front desk, and I asked her, Gloria, what are clients saying when they come in our doors? Are they nervous? And she said, you know, we've had a couple that are nervous, but more than anything, they're bringing in checks, and they want to get more money into the market. So I thought that was a good sign.
This is fascinating, and it really skews with some of what we're hearing from Wall Street analysts who are saying we're just looking for the right levels to buy the dip. And it sounds like retail investors have been conditioned in the same way. At what point are you going to get worried that maybe they're being conditioned in the wrong way, say, if there isn't that bounce that we've become used to?
Well, in the 70s, Chuck wrote our investing principles, and they're all about taking a long-term view of markets, being diversified, having a plan and sticking with that plan. And I think when markets go up, when markets go down, those are the principles we come back to. It's hard to have a view on short-term what's going to happen on markets, but those investing principles we think work. And you're seeing it this year where a diversified portfolio, European stocks are doing well, gold's doing well. There's assets that are performing well, so our clients that have taken that advice are hanging in there.
So retail investors are often painted with a brush where they buy Bitcoin and Tesla and AMC and GameStop, and then they hold their breath and keep buying when things go down. What is the picture of the retail client of Charles Schwab that you're going after?
Well, we see 7 million plus trades a day. We see more than 2 times the trades of any other retail brokerage. So we do feel like we have a pulse on how retail investors trade. And I think they trade very thoughtfully. We've got a range of investors, some of who are buying Tesla, who have been invested in Bitcoin and made a lot of money doing so. But we also have a lot of investors that play for the long term. But I think our investors are really thoughtful. They're engaged. They listen to your show. They listen to Lizanne and Jeff Kleintop and our thoughtful analysts. They're trying to make the right long-term decision for them and their financial plan.
I'm getting the sense from you that your investors are not concerned about the uncertainty emanating from Washington, D.C.
I think, again, we try to coach our investors to take a long-term view. I'm sure we have clients that are nervous about whatever the policy of the day may be or the news flow of the day. But in large part, one of the great things about Schwab is we have a lot of different ways to engage clients. We've spoken with over 600,000 clients in the last week. We're able to remind them that they have a plan, that these are the times to stick to their plan, and we try to remove them from the news cycle.
So this is talking to you as a market participant. Let's talk to you as a business leader. You've got to run a company. Right. We're hearing from a lot of companies right now that they're just hitting pause and they're waiting to get clarity on policy. I imagine you're not hitting pause. Can you walk us through what your plan looks like through the next several years?
We're not hitting pause at all. 2025 is a liftoff year for our company. We've spent the last couple of years integrating Ameritrade into Schwab, and now we have the benefit of having the best of everything that Schwab has and the best of everything Ameritrade has for our clients. So the future is all about growth, and we are seeing our growth accelerating through the first quarter. We've seen significant levels of client engagement. So it's for us, from a business standpoint, we are thriving.
So you're not cutting down on travel and forcing everyone to come back to the office and saying, guys, it's time to tighten the ship?
We've not taken any of those actions.
Okay. The reason why we ask is we're wondering how much this is trickling out, although it could be a somewhat counter-cyclical business. As you go forward, when you are expanding, who are you going after at a time where a lot of the big private asset firms are trying to broaden out into private markets for retail clients, and that's the increasing holy grail for a lot of the big banks as well? Who are you going after? Who's your competitor?
Well, in terms of who we're working with, we work with clients across all age and wealth spectrums and advisors of all sizes. We have 1 out of every 6 American households with more than $20 million in our country works with Charles Schwab. And at the same time, we're crushing it with young investors. 60% of our new investors last year were under the age of 40, and a third were under the age of 30. So we are really thriving across age and wealth spectrums. There is a lot of demand for alternative assets, and we're working with great firms like KKR and others that are bringing their capabilities to the retail investor. And I think that's a great thing. Historically, that's been for institutions only, and now we can bring it to our retail clients.
Are other business leaders who you talk to as confident and as excited as you are?
Well, their business has their own dynamics. For us, we're in a liftoff here. We're doing well.
The reason why I'm asking is because we've been talking about uncertainty, and we're seeing it in the data, whether it's small business confidence, whether it's business confidence more broadly. Are you saying you just don't see it, or are you saying that your business is somewhat immune to it?
We feel like we have an all-weather business model. The news flow, for us, that drives activity and engagement, and it brings investors into the market. And we've had 7-8 million trades a day, which is a lot for our business and drives our economics. So, the market engagement is a good thing for us. At the end of the day, what's most important to us, though, is that our clients are doing well. And that's where we put our energy into making sure we can help them in the channel of their choice get to where they want to be in their financial life. That's what drives us. When our clients do well, we do well.
Rick, what's it like working with the president? Because you are advising them on this off-spin of this Trump-linked Truth-Fi associated with Trump media.
Well, we've worked with administrations and regulators for 50 years, and we've tried to work with clients across all aisles. We are supportive of our country. We are Americans. We support 44 million American client accounts, and we want investors of all types to do well.
Well, the financial services industry might have a new regulator, and this is a name we've got for you. According to a person familiar with the matter, the Trump administration will nominate Federal Reserve Governor Mickey Bowman as Vice Chair for Supervision as soon as today. You will recall that Michael Barr, of course, resigned earlier on this year as the Fed Vice Chair for Supervision. Mickey Bowman, of course, nominated by President Trump in his first term to become a governor of the Federal Reserve. A lot of people not seeing this as a surprise, I imagine, this morning. This was a name we had in the hat, not just for this role, but also for the Fed Chair role that might open up further down the road.
Right, and this is someone that Trump administration has looked kindly on, first people to put her there in the chair. So this really isn't a surprise, but it is interesting. We are getting some clarity as we keep talking about uncertainty coming out of Washington. This is one place where we do have a name and some clarification.
It also means that she's not going to be nominated to be potentially Fed chair, which opens up the seat to potentially somebody else who seems to maybe want to be Fed chair.
Rick, a final word on regulation. Have you got everything you want?
I think Governor Bowman's going to be a great choice. I've met with her personally. I think she's a very thoughtful person. It's going to be great for the great for supervision.
I imagine a lot of people might agree with you. Rick, it's good to see you, sir. Thanks for breaking things down for us. Appreciate the update.
Thanks for having me on.
And thanks for being a good friend of this program over the years too. We appreciate it. Rick Wurster there, the Charles Schwab CEO. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Houthi militant group in Yemen said that it would resume attacks on Israeli ships for the first time in about 2 months, demanding the country end a ban on aid entering Gaza. It will likely deter container ships and tankers from sailing through the Suez Canal and southern Red Sea and may lead to a rise in global freight rates. Greenland voters unexpectedly picked a party that backs a slower approach to independence from Denmark. The vote took place in the shadow of President Trump's expressed desire to take over the island. Both popular parties campaigned on independence from Denmark and distancing themselves from Trump. Porsche shares are trading lower in the German trade by 4.7%. It cut its medium-term profit target. Porsche is struggling with declining sales in China and lower demand for EVs in Europe. Porsche will start an extensive rescaling this year, investing in models, software, and batteries, which will impact this year's financial results. That's your Bloomberg Brief, John.
Danny, thank you. More from Danny in the next hour, about 30 minutes away. Up next on the program, a tremendously positive impact.
Hundreds of billions of dollars is being invested. That wouldn't have happened if I didn't win the election, number one. And I think, number two, the tariffs are having a tremendously positive impact.
The president sitting down with the Business Roundtable. We'll get a view on that with Lindley Brown of EY. She joins us next from New York. This is Bloomberg.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Bloomberg Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equity futures on the S&P 500 up by 0.8% on the S&P. We've got more tariffs, 25% on steel and aluminum. Under surveillance this morning, a tremendously positive impact.
Hundreds of billions of dollars is being invested. That wouldn't have happened if I didn't win the election, number one. And I think, number two, the tariffs are having a tremendously positive impact. We have car companies that are not building in Mexico now. They're building in the United States. They don't want to pay 25% or whatever it may be. It may go up higher. Maybe go up higher. Look, the higher it goes, the more likely it is they're going to build.
So here's the latest this morning. President Donald Trump highlighting the positive impact of his tariffs just as Kohl's and Dick's join a list of companies raising concerns about the health of the U.S. consumer. Target, Best Buy, Macy's, all warning they may have to raise prices to deal with the levies. Lindley Brown of EY joins us now for more. Lindley, welcome to the program. The number one question that market participants have at the moment, when will we get clarity on this situation? When can we move beyond peak uncertainty? When do you think we can?
That is such a great question. I mean, I think the hope is maybe early April when we get the administration reports about, unfair reciprocal sort of trade acts. I think maybe early April we get some clarity on the roadmap and maybe less of a ping pong match.
You write something very interesting in your note, which is that history tells us that potentially, besides China, the tariffs might only be in place for a few weeks. Do you take Trump 2.0 as in full-on negotiating mode when it comes to most trading partners besides Beijing?
Yeah, I certainly do. I mean, we had full-blown Mexico and Canadian tariffs of 25% and then 10% on Canadian energy imports for 2 days before we had the reprieve under USMCA. So I certainly do see this as a negotiating tactic to change behavior.
So if you're sitting in the C-suite, why would you make any decisions right now? Which sectors is this going to hurt the most?
Yeah, I think that is probably what we're seeing number one across our clients is from, depending on a sector perspective, like do you wait and see? I mean, industrial products for one, for example, I saw something this morning for, we're not going to make that move in Mexico, right, for a big washing machine plant, right? We're just going to kind of stay put for a while. We're going to continue what we're doing in China. I think, we saw the tech industry deal with this, right? In the first Trump administration, we saw retailers, consumer products sort of deal with this in the first Trump administration. For most of those companies that have, manufacturing in the North American trading bloc, there is considerable amount of uncertainty. And then, from a life science element, when you think about the importance on the transatlantic trade, that is a big element of ambiguity, uncertainty that really does stymie activity.
Lindley, this is probably a stupid question, but as I was doing my taxes recently, I was thinking to myself, how do you even begin to account for all of the changes in tariff policies in real time as they come down while trying to reanalyze supply chains?
I think that is not a stupid question. I mean, it's real life, right? I mean, the questions that we got, I think that are really indicative of this are, certain companies that maybe this is relatively new to them, particularly if they've had, free trade agreement benefits. The question was, well, gosh, I imported something within the 2 days that the tariffs were in place. Do I have to pay them? Yeah, you've actually already incurred that liability, so you will be paying them. It's sort of unlucky. Well, then how do I model that on a go-forward basis? What will my continued detriment be? That's when you put in sort of a range, right? Worst case scenario, best case scenario, and you hope for somewhere maybe in between.
Lindley, are companies just canceling travel as they try to figure out what's going on among employees and say, get back to your desks, crunch numbers, prepare for headlines, and batten down the hatches?
That's a great question. I mean, I think even within the firm, right, the tariff impact is relatively siloed. So many companies have developed these cross-functional task force, which I think is wonderful, to kind of deal with what are the impacts across the institution. But I think from even like the number crunching piece, you can number crunch what happens today, but no one knows what's going to happen tomorrow. I mean, I don't know that when we went to sleep last night and we woke up this morning that we were going to be looking at a, potential retaliation, from the EU. That's new. Like probably people might not have had that in their forecasts when they put their head on the pillow last night, and now they do.
Well, do people have this in their forecast? Reuters this morning is reporting about Canada having retaliation as well. How difficult is the tit for tit to model out?
I think that's a really great question. You can get pretty deep in that. I think a country by country modeling out on an overall aggregate tariff basis, that's algebra. But when you think about a product by product, that gets pretty hairy because you've got different tariff amounts on different types of products, even sometimes within that same subsection or subchapter of what that product is. I think you could drive yourself crazy trying to get as exact as possible. But on the tit for tat piece, I think most companies have developed modeling scenarios that allow for that lever to be sort of flexed. Is it going to be 25? Is it going to be 50? What it doesn't allow for is sort of that sensitivity within product levels and across jurisdictions. That's more complex.
Who does their taxes in the middle of the March? Who does that, Bramo?
I'm just saying,
Mid-March.
okay, come on. Really, that's your only takeaway? This was actually incredibly...
kind of guy.
Okay. I was about to say, are you actually scolding me for doing it too late? Come on, be realistic.
Brown of white. No, I'm saying this is early. Mid-March.
Yeah, it's pretty good.
Wait until at least the first week of April.
I like how I was going to pretend like I had done it a long time ago, and now you actually gave me a pass to push it back. So
also,
yeah,
I'm just shocked. I'm just shocked you do them yourself.
Oh, whatever. It's not a big
something you have to outsource.
Why?
It's just easier.
No, it depends how complicated your taxes are. How complicated are yours? What kind of deductions are you getting? What do you want to tell us this morning?
It's easier to
Pretty straightforward here,
We have enough drama. Come on. We've got enough to talk about.
Guests. I hope I did, Lindley. Thank you. Thank you so much. Later on this morning, moving on quickly from that, 8:30 Eastern Time, CPI, big event, big data point. Federal Reserve is a week today. Now, if you have any downside surprises in the economy, tariff uncertainty starts to weigh on growth. Obviously, you're going to see if the Federal Reserve responds to that. The ability for the Federal Reserve to respond to that could come down to what inflation looks like going into that meeting, and we get that inflation report in the next hour.
What's fascinating to me is what Alicia Levine pointed out, that actually if you get a downside surprise when it comes to inflation, you could get a huge rally in equities and in bonds because it basically opens up the Fed to potentially get some sort of reprieve and be able to cut in the face of weakness.
I'm actually interested in PPI tomorrow because that's, of course, the potential inflation we're seeing on these companies and these products. Lindley talked about something very interesting there. This matter of uncertainty, potentially things could be 2-3 weeks and the tariffs come off. You still pay the tariff. Once that EO is signed, the computers change the border when it comes to collecting the tariff. So how do you model that? How do you pay for it? That could potentially be passed on the consumer immediately.
It's super complicated. I think we know that going into it, but seeing how companies and seeing how countries are responding to this in unpredictable ways, I think Walmart's a great example of that. Walmart says we're going to pressure the exporters, China steps in.
Yeah.
Then the United States is going to pressure Walmart. You're stuck between a rock and a hard place.
So good luck, have fun, call EY.
That's the environment right now. Is that the plug? That's the promo.
Well, I don't know. What do you do with
that?
They
pay us for that. I don't know. Craig Johnson of Piper Sandler joining us shortly. Flexport CEO Ryan Peterson, Mohammed Al-Erin of Queen's College, Cambridge, Andrew Holmhorst of Citi, and a whole lot more up next.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture. It's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There's obviously a lot of fear out there in the market, and the fear is centered on uncertainty.
So long as we're in this environment where consumers don't know the rules, businesses don't know the rules, you're going to be challenged for a while.
So far, the threat of tariffs has been a blunt instrument.
The size of the tariffs and the speed of them, it really dwarfs anything that we saw last time around. And I think markets are reacting accordingly.
It will take a few months to see how these policies pan out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Waking up to new tariffs in the United States of America with the promise of more to come. 25% tariffs on steel and aluminum. And according to the White House, we're still waiting for the big one. The big one comes in early April, reciprocal tariffs. This morning, we're focused on the data. 30 minutes away, the data point of the morning, CPI in the United States, a week away from the Federal Reserve.
Which raises the question, how high is the bar for the Fed to signal that they are open to cutting rates in the face of potential weakness that we see bleeding into the soft data, perhaps into the hard data? Alicia Levine of BNY Mellon was on earlier, and she said that if you get the whiff of disinflation that people were talking about earlier, even if it's backward looking, it will unleash a rally in bonds that opens the door to the Fed coming out and being supportive to the idea of a Fed put.
This is what we need. And we'll talk about why. What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to. The Federal Reserve would be in a position, if they needed to, if the data got worse, to respond to cut interest rates. Because at the moment, you're not seeing anything like that from the administration. We came into 2025 talking about the Trump put. At the moment, I think everyone's asking the same question. What Trump put?
Well, according to Donald Trump, he's not really looking at equity markets, and he says they go up, they go down. It's a great buying opportunity for a lot of people. What they're focused on is bringing rates down, energy down, which they have managed to do. Which why I think today is so important, though, is because he ran on inflation, bringing prices down. What did we hear of Bank of America Institute yesterday? grocery prices are going up. Well, if you have tariffs on some of your main trading partners, grocery prices may go up even more.
What have we heard from the retailers? The retailers have come out with some pretty tepid outlooks for 2025. They've got no clarity, no visibility whatsoever, but they have warned they might have to push up prices. They might have to pass this on.
And if you look at the internals of the NFIB Small Business Survey yesterday, what you found was that the largest share in nearly a year of these businesses said that they plan to raise prices in the upcoming months as a result of some of the policy shifts. Again, it sort of raises the question of what the Fed will be looking at and how high that bar is for them to respond at a time when a lot of people seem to be predicting much slower growth.
Small business confidence at a 4-month low. It's hard enough working out what these tariffs will mean for the economy here in the United States. Working out how other countries will respond isn't straightforward either. And we've seen that from Europe and Canada in the last 24 hours.
Canada this morning, according to Reuters, is saying they're going to respond to the 25% aluminum tariffs and steel tariffs. Europe also suspending some of the tariffs they had on goods like whiskey and bourbon, motorcycles, and then they're going to meet collectively in mid-April. We can get even another response, although it does seem that they are also offering up a path for negotiation. What I find so striking about what Europe is doing is, Jonathan, you mentioned taking a playbook from China. They're going after red states.
Well, it took 5 weeks, but Wall Street took a look at all of this, and last week started to make their downgrades. And this week it's accelerating, and we got that from Goldman Sachs. And it wasn't just the tariffs. It was the idea that we're talking about which ones, the retaliations, what the goal is. And the fact is that if you have that kind of uncertainty, you need a higher risk premium on your assets.
It's not just the market, it's the economy too. The downgrades on both. HSBC downgrading US stocks, Citi doing the same things. Lisa just mentioned Goldman. Goldman have done it on the economy as well. That call on the S&P is built on the call from the economics team, cutting the growth outlook. Morgan Stanley, Mike Gapen, downgraded growth, upgraded inflation. Deutsche Bank warned about the same thing. Considerable downside risks amounting. We'll get more data through the week.
And Julian Emanuel pointed out that right now he sees the market pricing in more of a stagflation type of environment, which has a downside on stocks of about 10%. They're not taking the recession calls fully seriously yet. Should those come into play, you have a much bigger potential downdraft.
Equities doing better this morning, though, up by 0.75% on the S&P 500, snapping back after 2 days of losses on the benchmark in America. Coming up on the program, we'll catch up with Craig Johnson of Piper Sandler as a new round of tariffs takes hold. We'll speak to Ryan Peterson of Flexport on how the levies will impact supply chains, and we'll speak to the brilliant Mohammed Al-Erin of Queen's College, Cambridge, reacting to the latest read on inflation. We begin this hour with stocks rising as President Trump downplays the risk of recession. Craig Johnson of Piper Sandler writing, another round of distribution pushes the stock market into a deeper short-term oversold condition, from which a meaningful rally of 3 to 5% can occur soon. Investors should be very selective. Craig joins us now for more. Craig, welcome to the program, sir. Thanks for giving us some time. Let's talk about that so-called technical damage. How much damage have we done?
We've done a lot of damage. And again, thanks for having me on the show. But we've done a lot of damage over the last 19 to 20 days. We have seen the S&P pull back over close to 10%. And if you break below the surface of this market, you start to see that you've got a lot of stocks that are off more than 20%. In fact, if you look at a market cap range between 20 and 80 billion, you've got nearly a third of the stocks that are now 20% off of their 2024 highs. So the damage has been swift. It has been pretty broad. And at this point in time, this market is setting itself up, though, for a pretty good relief rally. Could be 3 to 5% back toward the 200-day moving average on the S&P 500. But clearly, the conditions are ripe for at least a relief rally. And again, I'll say that at minimum, a relief rally, maybe even a little bit more.
Craig, before we talk about single names and what you're screening for at the moment, can we just say at the index level, we spent a lot of time above the 200-day moving average. Where do you find support now?
Well, support right now could be as low as 5,400 when you're looking at the S&P 500. But again, the relief rally is setting itself up, and there's been a long upward trending price channel that's been intact coming off of those 22 lows. And that price channel was violated just a few days ago. Got to keep in mind, though, from a technical perspective, that sometimes you break that level, as long as we're not going to break it for 3, 4, 5 days, and you see a snapback through that, sometimes the computers kick in and say, hey, now is the time to buy. There's been a lot of investors out there that were waiting for a pullback through much of 2024, never got it. Now you got a 10% pullback. I think they're going to start looking at that as a little bit of a potential buying opportunity for select names. And to that point, when you look at what happened yesterday, we saw our mother's favorite index, the Dow. It was down meaningfully yesterday. But when you started looking at small, mid-cap growth names, things like AppLovin, stocks like that, they were actually up materially yesterday in what looked like a pretty heavy tape. So again, I think there's some select opportunities out there that investors are looking for.
Just to build on what you're talking about in John's question, do you still have that year-end target of 6,600 if you do break below that level for a longer period of time, or say there isn't a broader participation outside of those select opportunities that you see?
Yeah, we're sticking with our 6,600. We established that target back in November of 2024. Certainly, we don't think that 2025 was going to be a great year to begin with. Typically, the third year of most bull markets, you only get an average return of about 5.2%. And that was sort of in our thinking as we were thinking about 2025. So we sort of laid out a kind of high single digits price target when we established that. Yes, now it's certainly higher than where we are now. It's about 12 to 13-ish% from where we are now. But again, I think that's a reasonable objective. I'm not in the camp right now that we're going to see stagflation or a recession at this point in time. Need to see more evidence of that. And again, I'm not the economist. I'm the chart guy. And as I come back and I look at all the charts, there's a lot of stocks that are pulling back to sort of identifiable support levels that I think investors are going to probably want to step up to.
So let's talk about some of those. I'm looking right now, and you have a range of different sectors represented, whether it's financials and Morgan Stanley or it's tech and Oracle. What kind of technical levels are you looking for? Or is there something fundamental that's happening that's giving you some optimism?
Well, I take the sort of stance that a lot of the fundamentals are going to get priced in through price itself. And so when we come back and you look at something like a Morgan Stanley, and let me just step back and say where we think investors should be right now is they should be overweight tech, just not the Mag 7, because we think the Mag 7 is going to be the Lag 7 in 2025. We also think they should be overweight financials, and they should also be overweight some of the services companies. And one of the names that we did call out was Morgan Stanley. And if you step back, not look at a daily chart, but step back and look at a monthly chart, you can see stocks like Morgan Stanley have corrected materially, but you're back to long-term sort of support levels. And that's where these kind of stocks can find their footing, whether it's Oracle on the tech side, whether it's Morgan Stanley, or some of those kind of names. But that's what we're looking for, and that's what a lot of our investors are asking us for. Craig, find me stocks that have pulled back the material support that still look constructive.
Good to catch up, Craig. As always, appreciate your time, sir. Craig Johnson there of Piper Sandler on some of the technical damage we've seen over the past week. Finished on financials there. Banks have had a really tough ride of it through 2025 so far on a handful of names over the last week or so. We talked about wiping out all of the gains post-election on the KBW Bank Index since early November. A lot of that's come from some big names, Lisa, and it goes beyond the traditional banks. It goes to the Apollos, the asset managers as well.
And you could argue it's the ones that were the highest flying in the wake of the election are getting now the most beaten up. And it goes to this point that we were talking about earlier, how much of what we're seeing is simply a momentum unwind versus some fundamental shift in overall trajectory of the economy. Right now, it seems like people are looking for gains. Let's see how much those dollars can take hold, because we are hearing from a number of retail investors that that is the case this year.
Bank of America so far this year, down about 10%. JP Morgan's down about 4%. Deutsche Bank, up about 25%.
Well, yeah, if you take a look at the European
Europe
banks,
versus the
absolutely
US,
flying.
it's absolutely mental. They're the year-to-date moves at the moment, as you can see. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Trump administration is set to nominate Fed Governor Michelle Bowman as the next vice chair for supervision. A person familiar told Bloomberg that the announcement could come as soon as today. Previous vice chair for supervision, Michael Barr, resigned from the role last month. Elsewhere, Canada is suspending plans to add a 25% surcharge on electricity exported to Minnesota, Michigan, and New York. Following that suspension, President Trump dialed back his threats to double tariffs to 50% on Canadian steel and aluminum. Ontario's Premier Doug Ford and U.S. Commerce Secretary announced a meeting tomorrow. Elon Musk is appealing to have his $56 billion pay package restored. The Tesla CEO is claiming a lower court made multiple legal errors in rescinding his 2018 compensation package. Last year, a judge revoked the pay package, ruling it was unfair because the company's directors were beholden to Musk at the time. And that's your brief. John.
Danny, thank you. Appreciate it. Thank you so much. Up next on the programme, the Morning Calls. Plus, we'll speak to Ryan Pedersen of Flexport as shippers brace for tariffs, then more tariffs, then maybe lower tariffs, and then higher tariffs, and then who knows? From New York City this morning, good morning. US CPI, 18 minutes away.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
16 minutes from now, inflation data in America, US CPI just around the corner. The scores going into it look like this. We're off the back of 2 days of losses on the S&P, set to snap that if we hold on to these gains, and we'll see. We're up by 0.75% on the S&P, on the Nasdaq 100 up by 0.9%. The scores in the bond market shaping up as follows: 2-year, 10-year, 30-year, yields higher by 3 basis points. The 2-year pushing 4%, the 10-year up 2 basis points to 4.30. We are in the quiet period for the Federal Reserve, but the chairman had the final word going into the weekend, and he said we're not in a hurry. But would it give him some space if we got a downside surprise on CPI, just to change the tone a little bit at the Federal Reserve meeting a week today?
That seems to be what the market is expecting, that the market will dictate and the data will dictate how quickly and how long the Fed can wait before responding. The difficulty with this is it's backward looking. And not only that, but when we look at some of the surveys that show fast moving trends, it shows that companies are planning to raise prices at a rapid pace. And that is potentially problematic at a time where the Fed has a dual mandate and has inflation that is hotter than that 2% goal.
Christine Lagarde, the ECB president, was speaking earlier on this morning at what they call the ECB Watchers Conference. It's a get-together for all the economists who follow the ECB. There's a lot of them. They do this in Frankfurt every year. I've been. It's very boring, but you do hear from the ECB president, and they talked about the era of shocks. And it is an era of shocks. And she talked about the difficulty of maintaining stability in a moment like this one. And I do have some sympathy for them. They don't know what the policies are going to be. They don't know how they will change from day to day. They don't know how other countries will respond. So you can't offer forward guidance in that environment. It's very difficult to do that.
And it's difficult to act with the word that she used, agility, if what you're trying to move is a massive train. And frankly, each of the calibrations to policy take time to come through. Again, it's a mismatch of time frames. If you can slap tariffs on, take them off, put them back on. How do you respond to a potential growth shock that may or may not come through if you're someone who's working on a 6 to 12 to 2 year time horizon?
The multiple you're willing to offer on stocks obviously shifts, right? Which is kind of the point that Goldman were making earlier on this morning, the point that you were making too.
The idea that if you have higher volatility, that means that the risk reward changes because the risk goes up. So the reward might not be, it has to be even greater for you to get in.
Equities up this morning by 0.8%. The data just moments away. Let's get you some morning calls. First up, Jefferies downgrading PepsiCo to hold, saying the stock's current price offers limited upside. That stock is moving to the downside. We're lower by 1.3%. Your second call from UBS lowering its price target on Coles to $5. The firm's seeing a challenging consumer environment that's likely to persist. Only just positive there by 0.2. And finally, Morgan Stanley lowering its price target on Apple to $2.52, expecting a flatter upgrade cycle and bracing for the impact of China tariffs. The stock is just about unchanged. That really is one to watch. Let's stick with tariffs. Global supply chains bracing for the impacts of President Trump's levies. Ryan Pedersen of Flexport writing, if imports become more expensive and unreliable, it could indirectly boost U.S. manufacturing. But if U.S. exports become too costly, U.S. manufacturers will struggle to compete globally. Ryan joins us now for more. Ryan, it's good to catch up with you, sir. It's been a number of months since we last spoke to you. Just walk me through your thoughts on the latest changes, and they change often.
I think that's the hardest part for supply chains. Sort of need some certainty. They take a long time to set up and to plan. And so if you're in a position where you don't know what's going to happen next week, next month, it's a bit of a paralysis that can set in. I mean, companies, everybody, it's very clear that the administration and also the prior administration has been very clear that trade with China is going to be faced with higher duties. What's less clear is whether that's going to be true for Vietnam, Malaysia, India, and many other trading partners. We have to sit and wait and see. But if they're putting tariffs on Canada, you can expect there's really no safe haven out there for tariffs other than manufacturing right here in the United States.
Ram, we've seen some evidence, just looking at the trade data, of some front-loading in activity to start 2025. You seen the same thing in your business?
We saw a lot of that at the end of last year. Yeah, once we, even under the Biden administration, when they put in higher tariffs on steel and aluminum, there was a big push. If you could move the goods in beforehand, you did. We have seen quite a bit of that. Although at this point, April 1st is the deadline for the Treasury Secretary to present a report to the president on unfair trade practices by China, and that's when we would expect more tariffs to come out. Well, April 1st is around the corner. It's a little too late to get at this point to keep front loading before that happens.
Given what you saw during the pandemic when it comes to supply chain and logistics, do you think companies are more prepared now than they were, say, in Trump 1.0?
Well, on some level, the executive leadership teams of companies has a lot more experience dealing with logistics and tariffs, and they're more in the weeds than they were a few years ago. They sort of just took this for granted, didn't pay a lot of attention to the logistics department, transportation department of their company. Now those, our customers, which are these transportation departments, logistics departments, as one of the largest freight providers in the world, we work with these people every day. They're under the hot seat. They're talking to their leadership all the time. The CFO is breathing down their neck trying to understand it. So in that sense, yes, but not a lot has changed. The ports they don't have a higher throughput than they did 5 years ago, about the same. There aren't larger safety stocks of inventory for the most part. So I don't think we're a lot more prepared than we were in the past.
The president continues to say, and he said this last night at the Business Roundtable, that you need the tariffs to bring manufacturing home. When it comes to supply chains, do you see any evidence that that's happening right now?
Yes, I mean there's a lot of manufacturing happening in the United States, and it's reindustrializing relatively quickly. It's too fast? It's too soon to say, oh, it's happened, as a result of Trump administration. But there's a lot of tailwinds for manufacturing in the United States. In addition to, you have the carrot and the stick. I mean, the stick is tariffs. It's going to be more expensive to import from other places. The carrot is going to have to be things around deregulation and making it easier to manufacture. And on top of that, I think there's some tailwinds with robotics that may make things, pretty exciting actually, and make it less about cheap labor. But those are going to take many years to play out, so it's a little too early to say.
You made a point, Ryan, in your notes, and this is something that John alluded to, that on one hand, it could increase domestic production, but it could decrease the ability for those manufacturers to export some of those goods if you have a more complicated trade mechanism. How much are you seeing exports from the United States dropping off, if at all?
Well, that's been a long-term secular decline. So if you look at the containers entering, and we're in the container shipping business, so we help companies move goods by ocean freight, by air freight too. But look at the containers. If you went back 20 years, for every 10 containers we imported, it was about 8 of exported goods. We're down to about 2. So most of the containers, you see a container ship leaving the United States, 8 out of 10 of those are empty. So I don't think we have a problem of too much exports. That'll be a long time before that's the case. They are, one of the rules in the U.S. Trade Representative Office has asked for comment. So you have until March 24th if you're an American business to submit your comments on this. But they have a new proposed ruling that would require American exports to travel on American-made ships, that 15% of exports would have to go on a U.S.-made ship within 7 years under this proposed rule. Well, the reality is there's not a lot of American-made ships. We're making about 20 a year total, and that counts oil tankers. That's not just container ships. So you just don't have enough ships that would be kind of a pretty disastrous policy in my view, because we're trying to promote, or the government's trying to promote American manufacturing, and if you're limiting the exports as a function of how many and how large are the American-made ships, that's going to really hurt American manufacturers. So hopefully that doesn't pass. It doesn't get put through as an executive order. They're asking for comment right now.
Ryan, one thing that we keep hearing from a lot of analysts, that companies can deal with tariffs. They just need to know what they are, and then they can plan for them. Is that your takeaway too? Is that your comment during the comment period to the administration?
That's one of them. I mean, the reality is no one cares what I think about tariffs. Like I'm very anti-tariff. It hurts our customers. It's not good for business. I think I believe I'm a big believer in free trade and human freedom. Let you trade with whoever you want to trade with around the world. But there's plenty of good arguments for it as well. That's fine. My point of view is exactly what you say, is like, well, just get it done with quickly so we can all get back to planning and set up our supply chains, according to the policies. But when it's changing constantly, it's much harder to figure out what you should be doing.
Ryan, just on that premise, you think you should be able to trade with anyone around the world, even if they're not playing by the same rules?
Well, in a pure, the purest form of it, sure. But obviously, I don't believe that we should trade with America's adversaries in North Korea and other folks who are, committing all kinds of rights abuses or whatever else. So we need some rules. I also think that reciprocal tariffs is relatively reasonable policy, frankly. Like if a country has really high tariffs on American-made stuff, and we have free trade on our side, that's not very good negotiation. So I don't think we live in this black and white world where it's that simple. But at its extreme, yeah, I'm a free trader.
Ryan, appreciate it. Appreciate your stance. Ryan Pedersen there at Flexport. You said China without saying China. Right.
I did, yeah.
Because that's the wrinkle in the story, and I'm with you. When we had Trump Volume 1 in the first term, Larry Kudlow, the then NEC director, would come on the program and he'd talk about reciprocity and the lack of reciprocity. And I think the argument resonated with a lot of people. In fact, their push when it came to China basically united Washington, D.C. at a time when Washington was very divided. It was the one issue that most people agreed on. It just feels like the goalposts have shifted in a second term in quite a marked way. We're talking about a whole host of things beyond just reciprocity.
Right, but when it comes to these tariffs that some have been put on and taken back, the ones that continue to stay, the ones that are steadfast, are China. And this potentially, what I hear, is just the opening salvo when it comes to this 20% on China. And the interesting point is, in Washington, D.C. now, following Trump Volume 1, it would be hard-pressed to find anyone who's anti-going after China. Remember, those are the tariffs that Biden kept in place because national security concerns outweighed the economy.
Coming up in just a moment, it's 5 minutes away. US CPI, breaking inflation data in America. Look out for that in just a moment. Breaking things down, fantastic lineup for you. David Kelly of JP Morgan, Mohammed Al-Erin of Queen's College, Cambridge, Andrew Hollenhorst of Citi, all here to react. And later, we'll catch up with David Rubenstein from New York City. The data drops next. Futures near session highs. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The economic data is 25 seconds away. Going into CPI, your scores look like this on the S&P 500. Equity futures near session highs, up by 0.8% on the S&P, following 2 days of losses. On the Nasdaq 100, up by 1 full percentage point. In the bond market, 2-year, 10-year, 30-year. Your 2-year, 398, yields up 4 basis points. Your 10-year up 3 to 430. With your economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we come in with a little bit better news than everybody was expecting, with CPI on a month-over-month basis just up 0.2%, and the core is up just 0.2%. That pushes the year-over-year CPI down to 2.8%, and the core down to 3.1%, suggesting that the Fed could start making a case for additional rate cuts if they wanted to, and they may have to, given what's going on in Washington. We'll get the breakdown for you later this morning.
Mike McKee, thank you, sir. This is a very important data point for the Federal Reserve going into that meeting a week today. The equity response is obvious, like a rocket. Equity futures up by 1.6% on the S&P 500, higher across the board. Check out the Russell. The small caps up by 2 full percentage points. In the bond market, yields lower. They were higher. We're down 3 basis points at the front end. The 2-year, 391. Push it through the FX market. We unlock 109 on euro dollar very briefly. The euro at the moment erasing losses on the morning so far, 109.16. It's a downside surprise on CPI.
The reaction in stocks is bigger right now than what I'm observing in bonds, which is telling. It's that maybe stocks are looking for where the Fed reaction or where the policy response might be. Right now, the hope is leaning more to the Fed than maybe to Washington, D.C.
Joining us now is David Kelly of JP Morgan Asset Management. David, that's some good news going into next week. How much comfort will this bring the Federal Reserve?
Only a little. I mean, if you look at the numbers today, just scanning them, we saw a 4% decline in airline fares, which is probably, that reflects some of the things that the airlines are saying to us about some weakening in demand. But I really think that the Federal Reserve is in a very difficult position here. Until we have some clarity on tariffs, they don't know how much of an inflation kick we're going to get from tariffs this year. And until we've got some clarity on the budget, they don't know how much fiscal stimulus is going to be kicked in next year. So I still think they'll probably wait and see next week. This economy is beginning to look like it needs or will, justifies a rate cut. And I do think we'll probably end up with more than one rate cut this year. I think we may end up with a sequence of rate cuts. But I think it's just too early for the Federal Reserve to make a decision, given the uncertainty about policy.
What's fascinating to me is the reaction in markets, David, the idea that you're seeing a bigger reaction right now in equities than you are in bonds, this idea that maybe the Fed could come back into play and support valuations even amid policy uncertainty. Do you buy that? Is that something that you think is a correct thesis?
Well, I think that there's some other things on the bond market's mind here. I mean, one of them is that if you look at the numbers that the CBO put out yesterday on the budget deficit so far this year, it looks like we're going to crack $2 trillion this year. I mean, we've got a massive budget deficit. And the weaker the economy gets, the more likely it is that we're going to see even more fiscal stimulus kick in next year. So we've got a deteriorating fiscal situation here, and slower economic growth and tariffs will only make it worse. So that may be supporting real yields here, even if inflation backs off a bit on weakening economic growth next year. So I think there's more than just inflation and the Fed on the bond market's mind.
Which is also a part of the reason why the Fed might have a hard time just embracing this data and then signaling next week that they plan to cut rates sooner than maybe they expected. David, what do they need to see to have confidence in the forward trajectory, given that this is backward moving and we have policy that is pushing companies to act in real time?
Yeah, I think the most important thing would be a sort of a final story on tariffs for this year and for the next few years. We know, obviously, as an economist, I believe that zero tariffs are the correct policy. I think that's a fairly traditional conservative perspective. But some clarity on that is vital for them to figure out, how's the economy going to evolve? I mean, what the Fed has said very clearly 2 days after the election, Jay Powell said, we're not going to assume, we're not going to guess, and we're not going to speculate. But they'd have to assume, guess, and speculate if they move policy right now. And that's what they're trying to avoid. So that the administration and Congress really need to figure out what the policy playing field is going to be over the next few years. Then the Federal Reserve can try to make some decisions.
David Kelly of JP Morgan Asset Management. David, thank you. The Federal Reserve meeting a week away. David really painted a picture of what a tricky position this Federal Reserve is going to be in a week from today. It could have been trickier without a data point like the one we just got.
At least they don't have runaway inflation, or the idea that coming into a potential inflationary shock, albeit a one-time price adjustment, there is some sense of disinflation. That said, the fact that if you do have a weakening economy, that could lead to more fiscal stimulus makes it very complicated for bond investors, let alone just the Fed.
If you are just joining us, welcome to the program. Moments ago, a small downside surprise on CPI. Headline month over month, 0.2%. The estimate, 0.3%. Stripping out food and energy, 0.2%. The estimate, 0.3%. To discuss this and a whole lot more, joining us now is Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, welcome back to the program, sir. Good to catch up with you. Important data point. How does this change things, if at all?
So if you talk to economists, they'll tell you looking back, it's good news. Looking forward, there's very little information content because of what David just said, what we've been discussing all day, is we don't know what the pass-through of expected and actual tariffs will be. So that's why the economists are. For those in the market, having been disappointed on the Trump put, this is better news on the Fed put. And I think that's why you're getting such a strong reaction on the equity side.
There's been so much confusion, Mohammed, about tariffs in the past 24 hours or so. You wear several hats, one of which is you've been a business leader for many, many years. And I think you made the important distinction when we had the boom of inflation. You made the point that this was not going to be transitory because of what you saw at the corporate level, how companies were acting and how they were responding. Given the threat of higher tariffs still to come, what do you see now from companies? And what does it indicate to you about what data might look like in months and quarters to come?
So two things are obvious to me, John. One is that companies have gone into a wait-and-see attitude, and understandably so, especially if you're a multinational. You need clarity. So you're postponing decisions because you don't want to make a decision that ends up being a big mistake because the world has changed on you. So we are seeing business activity slow down. The second thing we're seeing is people are much more ready to pull the trigger on price increases than they were in 2021, 2022. So if these tariffs stick, and if we get more tit-for-tat trade issues and things like that, then the pass-through to prices will be quick. And it will come at a time when demand is softening. So then you bring the third issue, which is the consumer. The consumer is hesitant already. I take seriously what you've been saying, all of you saying about what's happening to airlines, what you're hearing from different retailers. There's been risk aversion, clarity on the sense of the household. So put all that together, John, it is a wait-and-see economy that cannot absorb much of a price hit.
Is it an economy that could potentially enter a recession this year, Mohammed?
My probability is 25 to 30%. It was 10% at the beginning of the year, so there's been quite a big change. Why isn't it higher? Because there's a lot good happening in the U.S. economy as well. But if we get a prolongation of policy uncertainty, then that probability will go up.
There's a question about the response from central banks globally, Mohammed, if you do have this environment where inflationary pressures are going to be stickier at the same time that you have slowing growth. Christine Lagarde called it an era of shock and saying that maintaining stability in a new era will be a formidable task. If the central banks around the world had to choose, what's worse? Allowing inflation to be a little bit hotter but trying to help growth, or suppressing inflation at the risk of not rescuing growth and allowing it to continue to plummet?
So for both Europe and the US, it is the former. These economies can get to stall speed pretty quickly. We don't want that because the damage that creates is significant. So tolerating slightly higher inflation would be the better choice, the way you framed it. But Lisa, remember, these are central banks that made a huge mistake. And they may be much more sensitive to inflation than we would be, given the mistakes they made.
The idea of transitory and not maybe responding to it in the way that maybe they should have. I'm just wondering if, let's say they did take what you just said seriously, and they did say, look, we're going to have to just tolerate higher inflation for longer, and we really need to address slower growth. How many times would you expect them to have to cut this year in order to offset some of the uncertainty and, frankly, the consumer demand destruction that we're seeing in real time?
So to be clear, if 2% was really the operative inflation target, we wouldn't be speculating on how many cuts. We would be speculating on the timing of the hike, because the data has stalled for quite a long time. But because most people believe that 2% is a medium-term to long-term target, there is speculation on how many cuts. I'm in the one camp. I think, given what we know today, we get one. Now, if the tariff tensions persist and tit for tat get worse, I mean, at some point yesterday with Canada, we were near tipping points. And that would have forced the Fed to revisit what it's thinking right now about rate cuts. So it really depends where this trade war goes, Lisa.
Mohammed, I want to revisit one of your best calls. You are probably one of the best risk managers that I know, that's for sure. I want to talk about February 19th. February 19th, all-time highs. And not the February 19th all-time high of 2025. The February 19th all-time high of 2020. And I remember you came out around that time and you said, don't buy this. Now, the equity market has corrected in 2025 10% from the all-time highs of February 19th, and it's quite a parallel to think about those two dates. Mohammed, what would your approach be to markets now and equity specifically?
So I'm asked this all the time, John. I was asked it this morning by someone here in the college. Is it time to buy? It's very tempting to buy because with 10% off on the S&P, with 13 to 14% off on the NASDAQ, I respond very simply. What mistake can you not afford to make? You know, most mistakes in the investment world are forgivable over time. And that's the great thing about the investment world. If you bet on something that defaults, that's a different issue. So investors need to understand how much tolerance do they have for short-term mistakes and how much tolerance do they have for volatility, because the probability of both these things has gotten a lot higher than it was at the beginning of the year.
Mohammed, appreciate your time. You're one of the best. Thanks for catching up with us. A good friend of this program, a good friend of ours, Mohammed Al-Erin of Queen's College, Cambridge, on some of the latest market moves and the latest economic data. If you are just joining us 11 minutes ago, CPI just dropped in America. Michael McKee is back with us for more. Mike, second read of things, what jumps out?
Well, obviously, and this was mentioned, airline fares were the biggest drop, over 4%, and at the same time, used rental cars rather fell. So it looks like travel cut back somewhat during the month, and we saw that reflected in the airlines yesterday in what they were saying. Eggs were up 10%, still rising during the month of February. That contributes a lot to a 2% rise in food. Coffee also up. Bacon was down, the one good part there. We were looking through these numbers to see if there was any kind of pull forward on tariffs, and it doesn't look like it at this point. That people were trying to bring in a lot of stuff, and that caused the price to go up. Toy prices actually went down on the month, and that suggests that we got to wait till maybe tomorrow's PPI to see any kind of effects like that.
Mike McKee on the latest economic data. If you are just tuning in, small downside surprise relative to expectations. Equities off like a rocket after that print. As often happens, though, sometimes these moves don't stick. Those moves fade. Still positive in near session highs on the S&P relative to where we were before the print. We're higher by about 1.1% on the S&P 500, up by 1.4 on the Nasdaq. Yields were a little bit lower off the back of this story, now higher by 3 basis points on a 10-year to 431, and at the front end of the curve as well. We're back to about 397. Joining us around the table, I'm pleased to say, Andrew Honhorst of Citi. Andrew, good to see you, sir.
Good to see you.
When you walked into the studio, Lisa asked you a question. It was the title of your recent note. Is the Fed still in a good place? So let's ask you that question. We've got an update, got some data. Is the Fed still in a good place?
I'm not sure that they are, John. I don't know that they're going to recognize that at the upcoming FOMC meeting. It may be more of a wait-and-see meeting. But if you think about where they are, they've had policy at a restrictive setting because they've been trying to wring the last few basis points out of too high inflation. And you can do that as long as growth is resilient. But now we have some questions about whether growth is resilient. So I think they will be reducing policy rates. You would at least want to get back to neutral.
If I was on an investor committee right now, I'd want to be speaking to the economist and then the person who was managing rates, because I don't want to know why yields are up off the back of a downside surprise on CPI. Can you figure that out for us? How does that make sense? What's the overarching fear here that's dominating things, that's really in the driving seat? Because it doesn't seem to be this data point.
Yeah, I think we really are looking to the growth data. On the inflation side, I think is that weakness that we're seeing in inflation this morning, if it's in airfares, if it's in some of these more transitory, to use a term, if it's in some of these more volatile categories, that's less relevant. What we're really looking through to is what's PPI going to be tomorrow? What's PCE going to be at the end of this month? Where are shelter prices running? Where's that underlying trend in inflation? You really want that under control because we do have these upside risks from tariffs.
You know, Mohamed El-Erian keyed on a point that I think is really important. He's saying that probably this Federal Reserve and frankly the ECB should prioritize addressing growth concerns, even at the expense of pushing out the timeline for when inflation will get back down to 2%. And it seems like on some level, the Fed had been doing that and then got burned with transitory. So there's this question of, are they going to do something different this time and remain on hold for longer, not addressing growth concerns because inflation is sticky and has been?
So I think they're trying to develop a framework around this, around what would be a so-called one-time price effect that you could look through, a price level movement that you could look through. And if you see underlying inflation in things like shelter and other categories that won't be affected by tariffs, if those are staying cooler and you see inflation expectations that stay anchored, then you can be cutting even if you're technically above target in terms of core because you had this one-time price level effect. And I think that was the mistake that they made in the earlier inflation episode because we actually saw inflation across categories and we were still calling it transitory.
So this is actually really important, and it goes to this idea of, do they adopt a 2-point-something kind of framework of inflation that they will accept, and talk about the importance of avoiding a long-term stalling out that could be potentially much more pernicious for the economy. Is that what you think they're going to have to do to explain some of their actions in a non-political way and in a completely politically fraught moment?
Yeah, I don't know if they're formally going to adopt that as a framework, but I think this kind of intellectual development of this idea that, yeah, you can have some months where you're running at 2.5% inflation, slightly above the target if you think it's a one-time movement above the target. That's important.
So you have come out, and you came out last year, and you said the economy is going to weaken a lot more than people expect, and you expected the Fed to be cutting pretty aggressively. Have you seen anything in the data so far that highlights that view, that it has been a very weakening economy going into this period of uncertainty, regardless of the tariffs, kind of Neil Dutta's point?
We saw a lot of resilience over 2024, but we also saw signs that things were maybe not as healthy as they looked. Some of the things in the labor market with a low hiring rate, delinquency rates that were rising for consumers. So we knew that underlying softness was there and might get triggered at some point. And now as we're coming into 2025, remember, this is data that's really before we had a big concern over tariffs, and we're seeing consumers that pulled back in January. We have all the anecdotes from the retailers and the airlines. So it does look like that weakness was catching up with the economy, and that was before we were hit with any kind of new shocks.
So make us a forecast. FOMC's got to put out the SCP next week. How tough is that going to be?
Very difficult. I don't think that they want to surprise the market hawkishly here, and the market's pricing a little more than 3 rate cuts in for this year. So I think that dot for the end of 2025, that median dot, I think will show 3 rate cuts instead of 2.
How do they engineer that? They'll get around a table and say, we can't do this. Do they actually independently put through forecasts and then we look at the median, or do they sit together and say, well, you've said this, you've said that, we need to make it this? How do they even do that?
There are a lot of bilateral conversations that go on, then they all meet together. Somehow it all works out.
Bilats.
Andrew Honhorst of Citi. Bilats at the Federal Reserve.
Yeah,
We've seen them in Jackson Hole.
Yeah.
They are
It's
real.
true. Yeah, go for a
sideline chats.
It's true, bilat hikes.
Not going to name names, but they are real. Let's get you an update on news elsewhere this morning. Here's your Bloomberg Brief. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John, just to revisit that CPI data coming in softer than expected in February. It rose at the slowest pace in 4 months. Core CPI up to 0.2%. That is slightly lower than the estimated 0.3% in our survey. The Bureau of Labor Statistics said nearly half of that advance in the overall measure was due to shelter. Elsewhere, House Republicans passed a bill to keep the government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. If it fails in the Senate, Republican leaders could try to pass a shorter-term stopgap later in the week. And in sports, Tiger Woods will likely miss the Masters tournament next month. The 49-year-old posted on social media that he underwent a procedure on a ruptured Achilles tendon. He said the surgery was minimally invasive and went well. Woods set the Masters record last year by making the cut for the 24th time in a row. And that's your brief, John.
Hey, Danny, thank you. Appreciate the update. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. A lot to get through. And looking ahead to next week, a week today, the Federal Reserve has got to get together and put out some forecasts. How do you put out some forecasts when you don't know what policy is going to be and it can change from day to day and within the day 5 times with great difficulty? Equity futures right now in the S&P positive by 1 full percentage point. The opening bell is about 41 minutes away.
The Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They're like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the latest
latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
The opening about 37 minutes away. Equity futures going into it, holding on to gains. Post CPI, equities firmer here by 1.2% on the S&P, up by 1.6% on the Nasdaq. If you are just joining us, just tuning in, CPI came out at 8:30 Eastern, so about 23 minutes ago, and it came in a downside surprise at 0.2%. The estimate was 0.3%. That's on both headline month over month and on core. So equities off the back of that, just a little bit higher. Let's talk about the week ahead, the day ahead. Here's your trading diary at 10:45 Eastern Time. President Trump meeting with the Prime Minister of Ireland. Thursday, PPI and another round of jobless claims. Friday night, the US government shutdown deadline. Look out for you, Mitch, that day as well, earlier on in the morning. Sneak peek of next week for you. Retail sales on Monday. Another big data point, an important one, going into the Federal Reserve on Wednesday when they deliver their decision. Talked about equities and reaction to CPI. Just want to talk about the bond market briefly. Mentioned this earlier on in the program. This is what's so difficult for a lot of investors right now. Bonds are behaving in really unpredictable ways. So if I said to you going into this print, what would yields look like if we got a downside surprise on CPI? You might say, yeah, I want the details. I'm not giving you them. I just want to know, what would it look like post CPI on a downside surprise? And most people would have said lower yields, and that lasted about 10 seconds.
Which is really fascinating to me. The bond market is getting a different message. They're looking ahead. They're seeing less than 3 cuts now being priced into the market from the Federal Reserve. They're seeing the forward look as being potentially more inflationary than the past look, and they're saying the Fed might have a more complicated decision ahead of it than what maybe the stock market is suggesting.
You have to think there was a sigh of relief when you saw the downside surprise on inflation come in, and then all of a sudden, oh no, but we want rates to be lower. So a bit of a whipsaw, I imagine, going on in the minds of Scott Bessent this morning and the president. I take away from all of this after yesterday's 24 hours, the market is desperate for clarity, and they're not going to get it with this president.
It's a policy-driven market, and that policy is being driven out of the White House. We spoke to David Kelly of JP Morgan just moments ago. Asked David whether this would bring the Federal Reserve any comfort going into next week. He said maybe a little bit, not much.
They need to look forward. The problem is, and this goes to Mohammed El-Ariad's point, if you get consumers that are already retrenching some of their spending, do they need to come out and say, look, we're not targeting 2% this year. We have a different framework. This is what it is, and we want to support the economy.
Coming up tomorrow, the conversation continues. John Stolfus of Oppenheimer, Greg Dacko of EY, the former trade official, Katie Kalukowicz, and Dirk Willer of Citi. Look out for that one. Citi downgrading U.S. equities in the last couple of days. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. Defending champion Iga Świątek made short work of her fourth-round match against Karolina Muchova. The Polish star took under an hour to put the win in the books, dropping just 2 games on her way to the quarterfinals. Świątek is looking good to become the first woman to win 3 titles in the desert.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
In case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Futures flying high and rates rising too. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shanali Basak. And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, bonds drop, stocks rally. U.S. inflation comes in lower than forecast, and it's offering some relief after months of stalling progress.
The global trade war enters a new and perhaps risky phase. The EU fights back as President Trump's steel and aluminum tariffs officially kick in.
And Goldman cuts its S&P 500 target, joining other banks and showing skepticism over the outlook for the stock market. All of that and more coming up, but let's take a look at these markets. Really interesting picture because we have two very different asset classes. The S&P 500, the NASDAQ 100 flying in the pre-market right now after we got that cooler than expected CPI, both on a monthly and an annual figure. So that's what's happening in the stock market, of course, after several brutal days of losses. Then you take a look at the bond market. You actually have yields rising across the curve right now. I highlighted the 10-year Treasury yield, but you're seeing the same thing over in the short end with the 2-year yield, maybe because there's already a lot of rate cuts priced into this market. But it'll be interesting to see if these two markets come back together by 4 p.m. because Steph Gill just pointed out to me that we were flying yesterday at this time, too, in the pre-market.
Yeah, we've seen a lot of volatility, obviously, and the question of why we're seeing rates rise is a good one. If you take a look at this chart, you can see here in white the 2-year yield over the past 3 days and here in blue stocks. It is strange that the yield rises. That means they're selling bonds after inflation comes in lower than expected. The Fed can cut, so you want to hold on to the bonds you have now rather than buying the ones that yield less in the future. But not if you want to put your money into stocks, and maybe that's what investors are doing, getting some cash to buy equities.
Little bit of a rotation, just a little bit, Matt Miller. Let's look under the surface and see some of that rotation live. We are watching shares of metal companies because they're moving higher as President Trump's tariffs on steel and aluminum imports come into force. Alcoa up 2% pre-market, and we're also watching Tesla, of course, because it's on day 2 of a recovery from its 15% sell-off we saw earlier this week. Tesla up more than 5% pre-market, almost 6%. Dip buyers finally coming in. Intel also higher because of a report that TSMC is pitching other chip makers about a joint venture to operate its factories. Intel up 5% pre-market. It's been seeing bids in fits and starts throughout the year amid rumors about deal activity. What's interesting, too, is all those partners, Matt, are up pre-market as well.
All right, really interesting stuff. We see stocks rally. Obviously, it's been a tough ride for stocks. And I think one of the concerns is that these tariff policies will lead to inflation, maybe inflation that's more than transitory. And then the Fed won't be able to cut. One of the reasons it looks like we're rallying is that inflation isn't so bad, at least yet. And so maybe the Fed will be able to cut. That's what the market wants.
Yeah, worries about higher inflation. We were talking about what actually was in effect in February, and maybe it was just those 10% tariffs on China. There's been so much back and forth, but it's higher inflation and it's reduced growth. It's interesting to see this rally hours after Goldman cut its S&P 500 forecast for 2025. They're now looking for 6,200. They had been looking for 6,500, but this forecast cut, they say, Shonali, is reflecting a reduced GDP growth forecast, higher assumed tariff rate, and a higher level of uncertainty. And that has really been what we've been hearing from the sell side all week.
What's the saying? The shoes are falling, the shoes are dropping.
The next shoe to drop.
Yeah, they're the next shoe to drop. Anyways, the other part about this, too, the inflation data, you see that stagflation worry, to your point that you were making a little earlier today, starting to be a little bit eased. And that is kind of one of the worst case scenarios you could have for the Federal Reserve. Speaking of the Federal Reserve, we're going to break down the inflation data with Bloomberg's Michael McKee, our top Fed watcher here at Bloomberg Television. Mike, when you looked at the data, bring us the good, the bad, and the ugly.
Well, the good was the decline in both the headline and the core. Significant decline in headline, especially because gasoline prices and airline fares went down, but 0.2 compared to 0.5 the prior month, and that gave us a 2.8% annual rate. That's the lowest in some time for CPI, 3.1% on the core year-over-year basis. As prices continue to decline. No change in housing. That was maybe a little bit of disappointment. There's hope that it continues to go down. But what moved, we have a sort of truce in the war on breakfast. Eggs and coffee up a lot during the month, and natural gas because it was cold. Rental cars, along with airfares, are showing us what could be done because of the fact that people aren't traveling so much that we heard from the airlines. Airline fares, as I mentioned, gasoline and toys also not up very much or down. And what we did see was goods prices just get to the point where they were rising again, a little bit lower than that. Services prices still up. If the tariffs start to have an impact, the blue lines should go down compared to the white lines. Those should start going up because the tariffs will be on goods. And so that's something to keep an eye on.
Yeah, Mike, we're going to definitely do that. Michael McKee there is our international policy and economics correspondent. I want to bring in Stephanie Guild here, Robinhood Financial Head of Investment Strategy. And Stephanie, I think, we can't count out inflation from tariffs. As Mike points out, we need to keep watching that because no tariffs have really been enacted. Okay, 10% on
China.
On China, but the truth is they sell really cheap goods, and we're not going to notice 10% from them. We would notice 25% on steel and aluminum. We will notice tariffs on European goods, especially if they're high and retaliatory. What's your take?
I think the president wants to get interest rates down. I think their whole goal, like the Trump hood, is now on interest rates. And that's where I think they want to focus. They're going to do what they can. How do you get interest rates down?
By slowing the economy.
Yeah. And that's why I think like all of this, it's why I've lowered my numbers on GDP. I've lowered my numbers on earnings growth. And I also went to 6,300 yesterday on the S&P versus 65. So I'm ahead of Goldman.
Yes, you are.
A little higher. A little higher. Because I still feel like, look, the economy is not Houdini. It just doesn't disappear that fast. The real economy is what I'm talking about. And I know the market is a forward discounting mechanism, but we are starting from a good place, from labor market, from inflation, at least not going higher for the last few months. So I think that there is still room for us to get out of this, but you have to be realistic about, the longer this goes on, the more, obvious it'll be that you don't have as much growth.
I want to go back to levels. So lowering your target to 6,300. You take a look at where we are on the S&P 500 right now, just below 5,600. So getting to 6,300 would be a pretty nice gain for the year as a whole. But tell us about the path to get there, because we've heard from a few sell-side shops saying that maybe you get down to 5,500, maybe you go as low as 5,200. What do you see the trajectory actually looking like?
I think the next resistance level on the S&P is 5,400. We obviously haven't gotten close to that. Every time we kind of get sort of, I think it was like 55, 50 or something like that, then we kind of bounce. Yesterday, we bounced and then came back down. I think, you know, if we break through the 55, then we're going to get to, you know, 5,400. But I think if we do get to a place where we just know what the tariffs are, you can plan around them. Lots of things shift, like then you can sort of see the future because earnings growth like still have been really good. And you can come down a bit, right? I think the ratio is every 1% change in GDP is a 5% change in earnings growth if you look back over the last 35 years. So if you can see at least just a 0.5% change, and you still have really good earnings growth.
You know, one thing we've been asking for the last few days is where are the dip buyers? If you're out there, give us a call. What are you buying? Because some of these levels do look compelling. At the same time, you are sitting with the market with a sea of hurt, particularly when you think about hedge funds, but you deal with the marginal buyer as well, with the retail investor. How much conviction do they have when they are stepping into this market to catch that knife?
I mean, this started with consumer sentiment, right? And then it created a growth scare, which then created a momentum crash. If you were to look across our platform, our customers are smart and they are buying the dip, but very selectively. They're buying it in the places that they favor the most. Tesla's was down at least anyway, like over 50%. Yeah. That's where you're seeing the dip buying. Also NVIDIA. That's where the two places they've been doing it. And then the rest of the buying has been across, like I like to call it peanut buttering because they're sort of spreading it across different index funds. The selling hasn't been huge. And then look, we have a good cash yield on our platform at Robinhood, it's 4%. So, you know, that's a place to park.
Where do valuations look attractive, or where do the dip buyers find value? I'm looking at Tesla here, and the PE is 105.
Yeah, it's still really
That's higher than most car makers, I would say, right? Let's check out Ford for a second.
Put it mildly. I think
Ford PE is 5.
Yeah.
So it's just 100 more.
Look, I think Elon has a following. And when the stock goes down 50%, right?
Donald Trump is his following now, right?
But I think there are places to buy. Like, I'm looking for turnaround stories. So, like, I still like Gap, right? They had good earnings last week. They had a bump from it. You know, I think, you know, if there are some more tariffs that coming with China, you can see them taking market share from Shein and Temu, perhaps. And they also have just working on their own business. I think there's value in European large caps. I think there's value in Chinese tech names. Like, I think diversifying outside of the U.S., because U.S. exceptionalism is now being questioned, is the right thing to do as well.
Yeah, Citi would definitely agree with you there, especially when you bring up China. But I want to talk about other turnaround stories that just can't seem to blossom. I'm going to the small caps and the mid caps too. I mean, people have been waiting and waiting for that trade. Maybe I've been waiting for that trade. What's the outlook there?
I was also in that bandwagon. I actually favored mid caps over small caps because I felt like small caps, you know, interest rates are going to be hard. Longer term interest rates are going to be hard to get down because we also have a decent deficit. And if we do have a slowing economy, tax revenues are going to come down. So we just have to watch that.
Dude, and it's bleak. I mean, come on. If you need to reshore production, we had a great story on the guy who made the pedals for Nirvana and Jimi Hendrix today. It's easy to do it's easier to do if you're a multi-billion-dollar company. If you're a little guy, tough.
But one of the narratives, one of the bullish cases for small caps is that a lot of these companies are very domestically focused. Yes. So maybe they would be insulated from some of these things.
And deregulation and possible M&A, it just doesn't, it hasn't come. It has not been the focus of the presidency. And there is a question about M&A, like, you know, being easier. So I think that's what's been hurting it. I still think there's opportunity in the mid-cap space, and it hasn't been down as much as small cap, but, you know, this has taken everything down.
We have no verdict on M&A yet, right?
Jury's out. I mean,
Chris Hughes may have been right.
Yeah, I gotta bring him on.
For the wrong reasons, though. I mean, what's interesting is with rates still high and with valuations all over the place, there's a lot of pain under the surface, guys, so you have to come to market. It just might not be at the prices you like. Stephanie, thank you so very much. Whole market just waiting for Godot. Stephanie Guild of Robinhood Financial. And coming up, we're going to get more details on the latest tariff on metals and the first signs of retaliation next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States. Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Ukraine President Zelensky is praising the U.S. for restarting military aid and intelligence sharing with his country. Negotiators from the two nations reached an accord in Saudi Arabia for a peace deal with Russia. Trump now has to put the pressure on Moscow to agree to the deal and accept a ceasefire, beginning with a 30-day halt to the three-year-old conflict. Russia's foreign minister said this morning that the nation would not accept the presence of NATO troops on Ukrainian soil under any flag or in any capacity. House Republicans passed a bill to keep the government open past a Saturday shutdown deadline. The bill will likely, though, need the support of at least 8 Democrats in the Senate to become law. If it fails in the Senate, Republican leaders could try to pass a shorter-term stopgap later on in the week. And the Trump administration will nominate Fed Governor Michelle Bowman as the next vice chair for supervision. This, according to Bloomberg sources. That announcement could come as soon as today. Shanali has been excited about it for like a year. The post was vacated by Michael Barr, who resigned earlier this year. Bowman's nomination would have to be confirmed as well by the Senate. President Trump's metals tariffs kicked in at midnight. The U.S. administration has imposed 25% tariffs on steel and aluminum imports, with no exceptions or exemptions for Canada or any of America's trading partners. The European Union is launching retaliatory countermeasures. The bloc plans to impose its own levies on around $28 billion worth of American goods. European Commission President Ursula von der Leyen laid out the bloc's plans earlier.
Our countermeasures will be introduced in 2 steps, starting with April 1st and fully in place as of April 13th. In the meantime, we will always remain open to negotiations. We firmly believe that in a world fraught with geo-economic and political uncertainties, it is not in our common interest to burden our economies with such tariffs.
Let's say with those tariffs, because joining us now, we have Bloomberg metals and mining reporter Joe Doe. Joe, it was great to have you with us when the news broke about potential 50% tariffs yesterday. Now that we finally have some clarity, take us into your reporting. When you called up executives yesterday, what did those conversations sound like?
So initially, when the president announced he was going to double the tariffs on Canada, I spoke to multiple people in the market who are actually supportive of tariffs. basically shrugging, saying, I don't know where this came from. I don't know how we got here. This is a bit confusing. Because remember, these are still businesses. They still like to have certainty to plan for. I do want to throw out one thing I remember from 2018. By the end of 2018, I was going to steel conferences and talking to executives of big steel companies, of re-rollers, everybody in the market. And they said, you know what we need from the president is for him to just make a darn decision. Because you might remember back then he was talking about exemptions, no exemptions, who he liked, who he didn't like. And they said, just make a call. If it's no tariffs, that's fine. If it's tariffs, that's good too. But our customers need certainty. And I think that's what we're going to start seeing right here, right now.
I totally hear you. And it's interesting. We have Howard Lutnick, the Commerce Secretary, speaking on Fox right now. And he says they will lower the temperature with Canada. And the world is watching, right? The way that the U.S. negotiates with Canada. 50% to 25%. While I hear you on the certainty, that's gotta be some relief. You almost wonder whether he said the 50s so that everyone would get comfortable with the 25.
Well, by the way, I mean, how does nobody you got to give credit to him for that win, right? Everybody's like, Trump backtracked, Trump retreated. He got Ontario to take off a 25% tax on energy exports. Someone's got to give him a little credit for that, right?
I don't know if anyone has to give him credit or if they have to give him full credit, but I do know that talking to service centers in the space yesterday, they said, listen, whatever happens, the ultimate person who's going to pay for these tariffs are consumers. And they're going to pay for it at a time when demand is weak, inflation is high, and borrowing rates remain high. As I mentioned yesterday, steel inventories across this country are at the highest in years. And now you're adding 25% more price on top of what they're already not paying. And this was one other thing that a service center person told me yesterday was, you're asking the consumers to pay more, and yet they're not buying.
It is interesting about the payee, right? Because Warren Buffett said on CBS last week, it's not the tooth fairy that's going to pay these, right? He also said tariffs are an act of war, which I think was fascinating, especially if you put that together with Ray Dalio's comments.
Well, you've heard the phrasing from the Trump administration that this isn't a trade war, it's a drug war. But to your point that there's been this narrative that these tariffs are being used as negotiating tactics. So spin this forward for us, because you write in Bloomberg News today about, there's calls now for more talks. What does that look like?
I think I go back to what was initially discussed across Washington, D.C., from major sources within the steel industry going back to November 7th, right, the day after the election. And what had become apparent to me, talking to different folks across this, they said what's going to happen is he's going to go all in on the tariffs, specifically aluminum and steel. It's going to happen. And once they go into effect, he'll negotiate backwards. Now, listen. I don't think any of them expected the kind of back and forth that we have seen for the past 2 months, right? On a Friday, we're going to do this, but on a Monday, no, we're not going to actually do it. But I do think we have gotten to the point where these tariffs have come in place for steel and aluminum, 25% steel, which we had before, 25% aluminum, that's much higher, but there is obviously still room for discussions. We do know, we have reporting that said that there was a lot of lobbying efforts going on in the past 2 weeks by the aluminum industry. We knew that the CEO of Alcoa was sitting in a room with Howard Lutnick and others. Rio Tinto representatives were there. The head of the United States Aluminum Association saying, you guys need to get rid of the Canada-specific tariffs. And listen, they're having the meetings. Does it mean something will actually get done? I don't know. But we do know the conversations are happening, and maybe there is some relief for markets to hear that these conversations are occurring and that there's hope that it could be down the road.
Well, to your point, you take a look at Alcoa, you take a look at U.S. Steel in the pre-market, both higher after big rallies yesterday. Joe Dow, gotta leave it there. Great reporting and insight, as always. That is Bloomberg's Joe Dow. Meanwhile, a quick check on broader index futures before the bell. You can see the S&P 500 still higher by about 1% after that cooler than anticipated inflation data that hit at 8:30 a.m. Same story if you take a look at the NASDAQ 100 and the small caps getting a bid as well. The Russell 2000 up about 1%. Much more coming up next. This is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Welcome back to Open Interest. A quick check on futures as we count down to the opening bell. You can see we're close to session highs in the pre-market. The S&P 500 up by about 1%, a little bit more if you take a look at the NASDAQ 100. Big tech really getting a rebound here, up 1.5%. Small caps too joining in on the action, despite that rise that you're seeing in bond yields. And if you're surprised to see such a big reaction to CPI, maybe you shouldn't be. We've had such a big sell-off over the past few days, but also if you take a look at the options market, really interesting data out from Piper Sandler before this print that we got at 8:30, that options markets were priced to swing 1.5% in either direction in the aftermath of this report. Of course, inflation has taken on such importance as we watch these tariffs, as we take the temperature of global trade. And Matt, we were talking about a little bit earlier that we haven't seen the full force of tariffs yet in February, but that is definitely where markets and investors' minds are.
Yeah, absolutely. I mean, we so far have only seen 10% on China, but now we have the 25% on aluminum and steel. And Howard Lutnick on Fox was just saying the auto tariffs will go into effect April 2nd. To me, it's interesting that Europe hits back with retaliatory instead of cutting their tariffs on U.S. auto imports.
Yeah, things are escalating, but this is a market happy to find a floor. Now, guys, we're less than 4 minutes to the opening bell. Stick with us. We're going to discuss it with Chris Ferrone of Strategis.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
All right, a real rally in futures, moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. You can see gains of more than 1% on S&P futures, 1.5% on NASDAQ futures, but this after huge drops that have pushed us more than 500 points off of the highs. I think about 600 points off of the highs from last month. Take a look at the New York Stock Exchange. You see the opening bell being run there, and no Formula One drivers. But if you look down at the NASDAQ marketplace, look at that. You've got Formula One or Formula Academy driver down there ringing the bell for Red Bull Racing. Really exciting, and I think Formula One actually kicks off this weekend. I will say MotoGP is far more interesting if you're interested in motor racing sport. In terms of the markets, though, very fascinating stuff going on today. Maybe kind of a dead cat bounce, but we got good data out of the CPI. Katie Greifeld, what do you see in terms of the live trade?
Yeah, cooler than expected CPI, but of course we're all focused on the trade picture right now after those import tariffs went into effect last night. We saw retaliation from the EU. Now perhaps we might see it from Canada. This crossing the Bloomberg terminal right now, that Canada said to prepare retaliatory tariffs on 30 billion Canadian dollars worth of U.S. goods. Of course, this was a bit expected, but you can see that the market really shaking it off to that point. The S&P 500 still higher by about 1%, 1.1% right now. We got a big wipeout over the past few days. We're still lower on the week. So to Matt's point, perhaps a dead cat bounce, though. I don't really like that phrasing. Moving on, the NASDAQ 100 is rallying a bit more. Big tech has been the biggest loser, and as such, it's the biggest winner on this day, up about 1.7%. The small caps, this index actually ended positively yesterday when you had both of your big guys down on the day, and it's up 1.2% today. We know it's been a year-to-date lemon, so it's still hard to get too excited about the little guys. But back to the trade picture, we're taking a look at shares of metal companies such as Alcoa, such as Century Aluminum, higher this morning, and that's as President Trump's tariffs on steel and aluminum imports go into effect. They're still higher right now as we see the EU and potentially Canada prepare their retaliations. Shanali.
Katie, I agree with you. We will keep on this show all the cats alive. We over here are keeping an eye on Tesla here. It is up almost 7% at the market open. It's higher for the second day. It continues to recover from Monday's 15% sell-off. You have seen some brutal selling in this stock, but you have some key analysts keeping sky-high price targets, Matt.
Yeah, Tesla is a fascinating story, especially after the president of the United States came out and did an endorsement for that company yesterday. Intel, also fascinating. We have a report that TSMC is pitching NVIDIA, Advanced Micro Devices, and Broadcom about taking stakes in a joint venture that would operate the chip makers' factories here in these United States of America. You can see the shares rallying more than 5% this morning. Goldman Sachs, though, has lowered its target for the S&P 500 down to 6,200 from 6,500. Strategists writing, our revised estimates reflect the recently reduced GDP growth forecast of our U.S. economics team, a higher assumed tariff rate, and a higher level of uncertainty. Let's take a closer look at just one more in a pile of reduced forecasts with Bloomberg's Alex Semenova. Alex, what do you see?
Hey guys, so of course at the start of this week we spoke about how Wall Street was starting to feel increasingly uncomfortable with the ultra bullish targets that they went into 2025 with. At that point, strategists were just, talking about how their targets have an increased risk of the bear case materializing. But we're actually having Goldman Sachs this time come out and officially change their year-end forecast to 6,200 from 6,500. I do want to be clear though, they still see an 11% gain from yesterday's close, so they're not actually changing their view that we are going to see upside. They're just marking their target to market. And it's important to note that last year they did mark their target to market 4 times when the market was going up. So I would take this with a grain of salt. They're really just reflecting that 10% correction that we've gotten in the S&P 500 this year.
You know, it's taken a while to get back down here. And Katie made this great point earlier that even if you're at 6,200, you're well over 10% above where we are right now. How much more downside risk is there? Who's talking about the next low?
So I do want to point out, we did an interview with Marko Kolanovic, who obviously left JP Morgan last summer. He was one of the few contrarians still calling for losses at a time that everyone else upwardly revised their S&P 500 forecast. And he said that it really depends on whether or not we get a recession. At this point, what we're seeing is just a growth scare from tariffs, a lot of uncertainty in company guidance about what the outlook is. But we don't have any clear deterioration yet in the fundamentals. So it depends. We could take, another leg lower, see some stabilization around 5,500 is what he said. But if things get worse from here, we could go down to the low 5,000s, or if we do get a recession, he sees the index dropping to the 4,000s.
Have to imagine he's feeling a little bit vindicated, and it's been fun reading his tweets or his posts on X. Alex, great interview with Kolanovic. I encourage everyone to go read it, and of course, thank you for your reporting now. That is Bloomberg's Alex Semenova.
4,000.
Yeah, brutal.
That would be certainly something.
The Bears
You're never
are
going to retire.
I know. It's my 401k is just getting hit.
Geez, yeah, don't even look at it. Let's move swiftly along to that point and broaden out this conversation with Chris Verone joining us at the desk. He is partner and head of technical and macro strategy at Strategas. Great to see you.
Great to be here.
I want to start with the technical part of your title because we were talking a little bit about technicals last week. The S&P 500's 200 daily moving average has been squarely in focus. You take a look at things such as the RSI, briefly getting to oversold territory. When you take out your crystal ball, you take a look at the fuzzy, funky technicals. What do you see in terms of where we're going from here?
Well, I think this discussion that we're having here reinforces the undefeated rule of Wall Street. It's that attitudes are shaped by price action, not the other way around. And you see these big changes in sentiment over the last couple of days. We've seen big swelling in inverse ETF volume. We've seen some action finally in the put call data. We've seen the survey work get a lot more bearish. So I think the frenetic pace of the market these last several weeks is really starting to take a toll on psychology. That's generally pretty bullish. And I think we're probably in the ballpark of a good tactical rally. Whether that means the resumption of the trend, I think will be told over time, but I think we're in the ballpark of a pretty good rally here.
You're the head of technical and macro strategy. Are the technicals more difficult to read in this kind of volatility? I mean, if the ticker is going crazy, is it more difficult to...
Matt, I think it's where you have to rely on what has really served you well over the years. And one thing we spend a lot of time on is credit, right? What turns a 10% correction into something much more sinister? Typically when credit conditions are really deteriorating or credit is disproportionately worse than what equities suggest. And that's just not the case here. We did some work this morning. Over the last 20 days, S&P is down about 10%. Double B spreads are only about 30 basis points wider. That is not disproportionately weaker to what equities have done. So I still feel okay here. Financials went into this as leaders. I know they got flushed with everything, but they're still generally in pretty good long-term standing. So I don't think this is the start of some major change.
I think that's such an important point. And we were talking about it with Rick Reeder at BlackRock earlier this week, that you have seen this real containment in the credit market, even as you get scary headlines that issuers are standing down.
Yeah, those are scary headlines. And it's interesting because not only do you have BlackRock saying, okay, maybe wait for spreads to widen a little more, you have Goldman this morning saying it as well. So clearly, too tight. Did I do that?
Yeah, that's pretty good.
So, you know, I want to actually switch gears just a little bit to have you weigh in on this tariff rhetoric. We were kind of talking on the sidelines here about what you're seeing in retaliation. The EU, 26 billion euro. Canada, another $30 billion. So that's $56 billion on what is a giant in the room of an economy, what, 27 trillion, right? Just feels like a drop in the bucket here, doesn't it?
Well, so let's think about it in terms of not my opinion, but what's the market's opinion of all of this? And what I have found particularly remarkable over the last number of weeks is while cyclicality has suffered domestically, cyclicality is alive and well in Europe, it's alive and well in Asia. The cyclicals in Europe continue to outperform, the cyclicals in Asia continue to outperform. So, you know, kind of our big call this year was cyclicality isn't extinguished domestically, it's just migrating globally. And I think you're beginning to see that, or certainly have seen that. And I take some comfort in the idea that you haven't seen the cyclicals take the same hit throughout Europe and throughout Asia. I mean, Chinese markets act great here against very low expectations.
By the way, I think almost everything is a drop in the bucket compared to the entire U.S. economy,
But,
right?
you know, it will hurt specific companies, that's for sure.
Yeah, I mean, there aren't many bigger numbers than the U.S. economy.
Well, that's what I'm saying. When you're seeing the retaliation so far, it doesn't seem to be that big.
Yeah, and it'll hurt specific companies. It'll also help specific companies. I mean, we're talking about Alcoa and U.S. Steel, at least from the share prices, they've been acting very positively.
In the short term.
In the short term,
yeah.
yes. You have to zoom out the charts, but just over the past 24 hours, we've seen rallies in those stocks. So I'm curious about how you approach this as an investor. So there's so much short-term noise here. Are you tactical in this environment, or do you just sort of cover your eyes and
Well, I think the big question out there is the tariff frenzy, is it ultimately inflationary down the road? And I, again, would kind of de-emphasize what one-month CPI print looks like, and then I would instead emphasize what is the leadership messaging of the market, and go back to second half 2021 into 2022 when we were kind of in the throes of that beginning first stage of inflation. Your leadership was very pro-inflationary. It was energy stocks outperforming. It was material stocks outperforming. That is not the market's messaging here. Aside from a bounce in materials today, they have not been your leadership. The energy stocks have not been your leadership. So I don't buy this idea that the market is dead set on all this tariff implementation ultimately being inflationary. I think, if anything, when you look at bond yields over the last number of weeks from 480 back to roughly 430 today, that seems like the market is more worried about the growth side of the equation than the inflation side.
I want to ask your take on credit, and I got a message from a viewer who says he thinks it's underappreciated in the market how much JGB Treasury spreads or Bund Treasury spreads have compressed over the past month. We've seen massive movement there. What do you think about Treasuries? I mean, it was even interesting to see today when the inflation number came out, yields first went down and then all came up across the curve.
Well, let's put this first in some short-term context. We're only 6 weeks removed from 10-year yields being about 480 when everyone was certain they were on their way to 550, right? And what happened lower. If you look at the last 2 years, we're essentially in the middle of the range. The average 10-year yield over the last 2 years is about 420, not too different from where we are today. The correct Treasury call for the last 2 years has been no call. It's been an extremely frustrating range. But Matt, I think you make really important observations about what's going on globally. German 10s look different. They look like they want to go higher. Certainly Japanese 10s have been moving higher the entire time. And
highest level in a decade.
And you see it with yen. And I would just emphasize to the viewers, think back to when tech's relative performance versus the S&P peaked last July. What else peaked last July? Dollar yen. So to think that strengthening of the yen is not disrupting or changing how money moves around the world, I think would be silly. And I think the biggest impact of it has been seen with tech's underperformance since.
Chris, we thank you so much for joining us here on set. I'm glad you brought up that yen point. It's been an important and underappreciated
I'm glad that people who are watching write in. You know, shoot me a message.
They have the
talk
sound
to
on.
us.
That's great.
Chris Marone of Strategas Research. Thank you so much. Of course, Strategas is a Baird company. I also want to, guys, point out a point that Chris was making here about the leadership, because on the flip side, you have the negatives, and consumer discretionary has lagged the market so meaningfully relative to what you're seeing elsewhere, down more than 12%. I've also got to say, the great Stanley Druckenmiller came into this year short this sector, according to his pick-a-ticker tracker, which is a game that is tracked by Robin. You see what I did there?
Yes.
We've
been talking about this all morning, this pick-a-ticker. It's a contest that Bloomberg does, what, together with Robinhood?
Yes, exactly. And you can look at what the great investors are doing. That includes Bill Ackman, who's leading, and Druck is high up as well, partially because of that consumer discretionary short.
We will talk more about that at 10:10 a.m. with Carson Block. But I will say, if he was short consumer discretionary, he's just short Amazon and Tesla. Amazon is 38% of the consumer discretionary index. Tesla is 14%. Then you start to get actual.
It's good to be short those
I know,
two stocks.
but I'm just saying it sort of distorts
It's
the
a
macro
messy
narrative.
read, to your point, that index.
I would just short Amazon if I were short consumer discretionary. But
You know, we will never know, because they can only really name the indexes and the sectors. He might be short something.
Tesla's still down almost 40% year to date.
It's the second worst performer in that index. Anyways, coming up, we're going to go to tech. We're going to talk about Intel, though, because it's jumping after TSMC makes a pitch to operate the chip makers' factories with a bunch of partners. We're going to take a closer look next. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Welcome back to Open Interest. We do have some breaking news from our neighbors up north. The Bank of Canada cutting its key interest rate 25 basis points to 2.75%. That had been the expectation. To bring you some details from that decision, the Bank of Canada will watch upward inflation pressure and expectations, threading a difficult needle here, though, because CPI is expected to rise 2.5% in March, and they're worried about the impact of tariffs. But at the same time, they say that they cannot offset the tariff harm. They can prevent ongoing inflation, and they warn about that economic hit that they might get. Of course, if we do see prolonged tariffs here, maybe a little preview of what we might hear from the Fed next Wednesday.
Yeah, we're getting some notes along from the Bank of Canada Governor Tiff Macklem, who says, looking ahead, the trade conflict with the United States can be expected to weigh on economic activity, while also increasing prices and inflation,
There you go.
We are also watching Intel. The stock is jumping this morning on a report that TSMC proposed to run the Intel foundry division in a joint venture with NVIDIA, AMD, and Broadcom. That's pretty big news. Here with more is Bloomberg's Jackie Davalos. So, Jackie, what do we know about the potential investment in JV?
Well, we should caveat that this is according to a Reuters report. There's been a lot of back and forth regarding what a deal could look like with TSMC and Intel. They've gotten a lot of encouragement from the Trump administration to really bring Intel out of this struggling period it has been in for years. Remember, this is the American manufacturing icon. A lot of Trump's focus has been to bring domestic manufacturing, especially for advanced chips, back here to the U.S. TSMC is a key partner because they control so much of that manufacturing, about 90% of that share worldwide. Now, this potential deal, it's not clear whether this supersedes the $100 billion commitment we heard about earlier this month. So this could be, something that was percolating before that $100 billion commitment actually came through. But what it entails is bringing in new partners, Broadcom, NVIDIA, Qualcomm, American chip makers and designers that could be part of this joint venture. But again, we don't really know if this is kind of stale, kind of coming out of the prior conversations, or if that $100 billion commitment
Jackie,
is the key step forward.
One question I have, to your point on NVIDIA, AMD, Broadcom, I guess when I see fierce rivals being named in the same breath, I get a little skeptical that everyone wants to play nice. And so what incentive do they have to work together to get this done?
They can stay within the good graces of the administration. Right now, TSMC is a great example of where political pressure really collides with what's best for their business. They have factories here in the U.S. When you think about the other American players, they want assurances, I'm sure, from the administration. Remember, Qualcomm was one of those that actually just had a meeting on Capitol Hill with the president and his administration to discuss manufacturing, tariffs, and other policy that could affect them. So as you look at some of these players coming in here, they're going to be beneficiaries of the support that the government then extends to the AI sector.
All right, well, it'll be fascinating to see when we finally get a deal done here, but Intel shares up about 5.5%. Jackie Davalos, great to see you. Coming up, one unit at JP Morgan churning out $100 billion worth of trades, offering hedge fund-like investing on the cheap. That's next in our Wall Street Beat. This is Bloomberg.
a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to Open Interest. We do have some breaking news now, and that is that Russian leader Vladimir Putin will probably agree to eventual truce terms with Ukraine. But, and this is according to a person familiar with the Kremlin's thinking, he wants to make sure his own conditions are included beforehand. Russian officials didn't discuss with their U.S. counterparts the specific deal. Of course, we've been watching this back and forth, and this is the latest reporting that we have, that Putin is likely to eventually agree to a truce, but with his own terms. We will bring you more details as we have them.
Yeah, absolutely. Eventually, I think, is the operative word here. He's likely to try to drag out the timeline, is what Bloomberg's reporting shows. We're going to switch gears now. Of course, though, the peace, when it refers to Ukraine, is a critical part of what is underpinning these markets as well. We're going to switch gears and go to the Wall Street Beat, to the most read story of the day, actually, on the Bloomberg terminal. A JP Morgan quant unit has built up $100 billion trading book. The strategic indexes business is at the forefront of the recent boom of products offering hedge fund-like investing on the cheap. Katie and I have been covering this super closely. Joining us now, Bloomberg senior editor Sam Potter. This one hit my heart because I'm a quant myself, a failed one, but a quant nonetheless. And it's interesting to see these strategies proliferate. Why is JP Morgan's becoming so popular?
But it's important to say that JP Morgan is one of a number of broker-dealers that are doing this, that are providing these services, and indeed it is one of the biggest and is at the forefront, but there are several other big names involved as well. This is something that's really taken off in the last couple of years. Essentially, you know, when we talk about hedge fund strategies, the sophistication, the complexities of them, actually some of them are quantitative in nature, and so they are rules-based. So the idea behind these is that you can take those set of rules and you can tie it up into a bank swap or into a structured note and then just sell that. It's not as sophisticated, not as flexible as the original hedge fund strategy, but it's a cheap and easy way to put on an exposure or take off an exposure. JP Morgan has, as I say, been very much at the forefront of this. And culminating now, and they've crossed $100 billion of trades.
Right. Sam, it pains me to say we only have 30 seconds left with you, but talk to us about how this fits into today's markets, the volatility that we're seeing right now.
Well, I mean, things are so unpredictable at the moment. I think that the ability to be nimble, to dip in and out of trades is very important. I think that's one of the big appeals of QIS. They are, as we say, easy to put on, easy to take off. They're also cheaper, you know. There's a lot of pressure in Wall Street these days to reduce fees, to reduce costs. It's increasingly competitive, as it always has been, but more so. And so if you can get access to something like trend following or an option selling strategy, but do it on a cut price basis, then it's pretty in demand.
Sam, thanks so much for joining us. Bloomberg Sam Potter talking to us about QIS. This is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Michael Wallace. More countries are fighting back after President Trump imposed 25% tariffs on all steel and aluminum imports.
And now it's Canada's turn, announcing $20 billion worth of retaliatory tariffs in response to the 25% steel and aluminum tariffs that President Donald Trump has leveled. This just hours after the EU announced its own tit-for-tat tariffs on certain U.S.-made industrial, farm, and consumer products. Trump's tariffs took effect today, though at the 11th hour, the president backed down from slapping Canada with an additional 25% on top of that. Vicki Barker, CBS News.
CBS News business analyst Jill Schlesinger says inflation cooled a bit in February.
Prices increased in February, but the annual inflation rate edged lower. The inflation rate from February of this year to February of last year was up by 2.8%. That's lower than the previous month's reading of 3%.
Egg prices were up 59% from a year ago. The Education Department plans to cut more than 1,300 jobs, almost half its staff. Education Secretary Linda McMahon tells Fox that's just a start.
What we did was to take the first step of eliminating what I think is bureaucratic bloat.
President Trump says education should be up to the states. National Education Association President Becky Pringle disagrees.
There are students who have been historically marginalized, and the federal government has a role to play in closing those gaps.
Police in the Dominican Republic have identified a person of interest in the disappearance of University of Pittsburgh student Sadiq Kananki. CBS's Manuel Bajorquez is in Punta Cana.
The young man who was last seen with her at the beach is considered a person of interest in this case, but they stress that it remains a missing persons case and not a criminal investigation.
CBS meteorologist Kate Bilo says another atmospheric river has arrived on the West Coast.
In Southern California today, we're going to be measuring snow in the feet across the Sierra Nevada range, and we're looking at upwards of 2 inches of rainfall across Southern California, which, especially for those burn scar areas, could lead to the risk of runoff flooding and possible mudslides.
4 astronauts will take off for the International Space Station later today to replace Sonny Williams and Butch Wilmore, whose week-long mission in June turned into a 9-month odyssey when their ride back home sprung some leaks. CBS's Mark Strassman.
NASA has said all along they could have brought home Wilmore and Williams at any time, for instance, if there had been an emergency. The issue has been that NASA has needed to have replacements go up before they brought these astronauts home.
This is CBS News. Billy Joel is postponing some concert dates after undergoing surgery. In an Instagram post, Billy Joel doesn't specify the nature of the medical condition or reason for having surgery. He writes he's undergoing physical therapy now under the supervision of his doctors. Joel is postponing 8 shows. The tour is set to resume in July in Pittsburgh. During a Connecticut show last month, a fan captured video of the Grammy-winning singer falling backward on stage, but the concert continued. Steve Kathan, CBS News. Air India is asking passengers to only use lavatories for their intended purposes after a series of clogged toilets. 5 hours into a flight to Delhi, a plane had to return to Chicago because 8 of its 12 toilets were clogged with clothing. There have been troubles with diapers and blankets, too. Michael Wallace, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well. Alex Steele is back from Houston, Texas. We're back at full strength here. We got a busy day, lots of news. We expect nothing less these days. Kevin Whitelaw, Bloomberg Brussels Bureau Chief on the European Union and its tariffs on the U.S. We'll get the breakdown there. Michael McKee, Bloomberg's International Economics and Policy Correspondent. He's going to break down the CPI data here today. Ann Berry, founder and managing partner at Threadneedle, to discuss the latest on the markets here. Oliver Crook, Bloomberg European correspondent, on the U.S.-Ukraine talks in Saudi Arabia. There is some news that perhaps President Putin from Russia is willing to engage. We'll have the latest reporting coming out of Ukraine as well. Right now, let's go to John Tucker and get a Bloomberg.
And this flash being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. Well, the inflation report we got this morning initially drove stocks higher. The Dow now giving up those earlier gains, and it looks like this comes after the Bank of Canada cited the trade war with the U.S. as a, quote, new crisis. They cut their benchmark rate a 1/4 point. In the U.S., the data this morning showed the consumer price index rising 0.2% last month. That's actually the smallest increase since October, but it doesn't seem to include any tariff results just yet. Dow right now down 116 points, down 0.3%. The Dow's being led lower by McDonald's, that's down 2.3%, and then Amgen, that is down about 2.2%. Intel jumping on a report that TSMC is pitching a foundry joint venture. The shares of Intel right now up 5.8%. Then Groupon, look at those shares, up 32%. The online coupon company giving a revenue forecast that beat the average analyst estimate. Remember Amazon? They were going to buy this for more than $1 billion. The little vacuum cleaner thingies.
Oh, yeah, Roomba?
Yeah, iRobot is raising substantial doubt about the ability to continue operating. iRobot shares down close to 38%.
But everyone loved those things.
Did you have one?
No, I finally splurged on my Dyson V8, which is probably the 100% best thing I own.
Yeah, but it's not like the
counting
robot.
my husband and daughter.
It's not a robot-y thing.
I mean, no, but it kind of is. It's that awesome.
You're getting excited about a vacuum cleaner.
Vacuum cleaner.
I'm not going to say anything more. Anyway, that's your market check. I'm John Tucker. Back to you. Welcome back, Alex.
Why, thank you. Alex Steele here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. Market Drivers is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. All right, let's take a look at some stocks on the move today. We are joined now by Isabel Lee, Bloomberg Cross Asset Reporter. What is on your list?
Tesla, it's edging higher by 8%, but year to date, it's down 38%. So the rout has been so bad that we have believers kind of backing away. I mean, Tesla is now the biggest decliner in the S&P 500. And here's how some people look at it. The downturn has been so extreme that Trump had to step in. He said on Monday night that he would buy a new Tesla to support Trump. On Tuesday, he chose a Model S that's red. It was delivered to him in the White House. Still, the stock fell under $230 this week. It's down from $400 almost 2 months ago. And even Wall Street analysts, even some with the most bullish recommendations, with buy recommendations, they've been taking a more cautious stance. So that's really something. And 4 analysts lowered the price targets on Tesla just recently.
You have to wonder how much of that is the Musk effect as a proxy for what is happening in the government, and also concerns about his split focus. How much of that is also like the subsidies, if they go away and the federal government is not going to spend money to build out EV electrification centers, does that reduce some of the interest in general in an EV?
100%. There's like a million reasons for why the stock is moving down. Even Germany, like there was a Bloomberg article last week that said even Musk's politicking in Germany was taking a hit, and Germans are actually acting by boycotting.
What else you got?
Groupon, which John mentioned, it's jumping by 33%.
Groupon in like
I haven't
25 million years.
I haven't too.
I've never used it.
How does it work?
This tracks.
It's just like online.
It does. Thank you.
I'm not the best person, but from my experience, you go on a website, just like everything in the world, and then they just have deals, and then you buy. But
some of the deals are really good.
Yes, and it looks too good to be true.
But it's not. It's real.
Yes, it's true.
But you know,
Like
so
for
example, but it's also more for services.
Yes.
So like here's
Massage
this
or facial.
restaurant
Yes, yes.
that is having a deal. You can get $40 off tonight, and you can click and go, or like here's the spa or something.
But I don't go out.
Yeah, I know. I'm talking to you, being like, I'm trying to find a moment to relate on this, but it's not going to happen.
Donovan's Reef doesn't have the
Maybe
Groupon
not.
down in Seabraid.
Well, the company gave revenue forecasts that beat estimates,
Okay,
so
very
maybe it will entice people like John to go out.
Yeah. All right. Anything else?
iRobot, so it's sinking 37%. It had disappointing quarterly results, and the management canceled its fourth quarter and full year results in the call and webcast. So that's always a little unsettling when the company does that, and then it's raising substantial doubt about its ability to continue operating. Recall that Carlyle provided a $200 million loan through its private credit arm in 2023, but now it's really struggling. And back to Alex's point, I also don't have an iRobot, but my friends who have it love it.
We have it. I think it's a scam.
Okay.
Yeah.
Oh, you don't like it?
Well, yeah, it's going, but I'm like, does it really clean? But I've been
Does
told
it?
I've been told it does, so I say okay.
I mean, it doesn't like mop your floors. That
Right.
would be cool though if they
yeah.
did that.
Yeah,
I'd
that's
love
coming.
that.
That's the next
Yeah.
one. But no, we've got it. We're happy. It works, kind of thing, I guess. All right.
All right, Isabel Lee, thanks very much. Isabel Lee, Cross Asset Reporter, joining us on those market drivers. Again, all the inflation headlines coming this morning, but the tariff headlines are really what's going to be moving those numbers going forward. The latest is that the EU is going to be targeting 26 billion euros of U.S. products in tariff retaliation. We want to get to Kevin Whitelaw, Bloomberg Brussels Bureau Chief. Kevin, what do we know about these details?
Well, the EU is basically laying out what it plans to do in the coming weeks as it tries to respond to these U.S. tariffs. They're trying to find a way to say that, hey, we're going to respond firmly, but still allow some time for a negotiation to see if the whole thing can be avoided. And so the first step is going to be that a set of tariffs that had been in place during Trump's first term in retaliation for the metals tariffs that he imposed back then, those are going to snap back into place, along with some additional tariffs that had been part of the whole package and hadn't quite gone into effect by the time they were all suspended under Joe Biden. So that is going to be a package of about 4.5 billion euros of penalties, and then there's a long list that the EU is now considering as it decides how to assemble a package of 18 or so billion euros of other additional goods, most of them agricultural goods or industrial products, that would then also be subject to tariffs starting sometime in mid-April.
Kevin, what's the feeling amongst the European Union members about the U.S. and maybe what the U.S. strategy might be? Are these tariffs for real? Are they really trying to change the world economic order, or are they more negotiating ploys for President Trump to get maybe some other issues that are important to him?
I think that's exactly what everyone's trying to figure out. I think the Canadians are trying to figure that out. I think Mexico's trying to figure that out, and I think Europe's trying to figure that out. And the next couple of weeks are probably going to be reasonably important in helping everyone understand that. There's not only these steel and aluminum tariffs, but Trump has also been talking about these broader reciprocal tariffs, and those are the ones that actually really worry the EU from sort of a longer-term sort of structural standpoint. And that's right. You know, Trump has talked about these as ways to gain leverage and force negotiations, but he's also talked about it as ways to raise revenue and perhaps even at some point, reduce or replace the income tax as the main source of U.S. revenue. Those goals, you can't sort of accomplish both at the same time. At some point, he's going to have to sort of pick what the overall strategy is here. And as it starts to play out in the markets, and as it starts to have impact on the U.S. economy, and when he starts to hear more and more from U.S. companies and CEOs and others about their concerns about sort of the unpredictability around all of this and the economic pain, that's when we'll really get a sense of just how committed he is to going down this road.
What do you think? What's the process like? Because the difficulty with Europe is that it's different countries, but all united, but there's no, financial center, there's no politicking, right? I mean, everyone has to answer to their own specific government. So how united can the EU be on this?
Trade is one area where they actually can be very united. It really is a core competence of the European Commission, which is the EU's executive arm here in Brussels. And so they really can make these decisions. They can, in this case, they're going to propose a list of all of these tariffs. It will go to the member states in a vote, but it can be done by what they call qualified majority, which just basically means it needs to have a preponderance, but not unanimity when it comes to trying to get this through. So far, at least, almost all of the words in the from EU member states are backing the Commission's approach, which is to say they will take and make a firm response to Trump's tariffs, even as they really hope for a negotiation. So far, the biggest problem is, up to now, most officials in Brussels haven't been able to find someone in Washington who takes their calls, who will meet them in person, and so they haven't really been able to engage in a negotiation because no one's talking to them yet.
Jeez. Kevin, the average Canadian's pretty upset with America these days and with President Trump, and it's all out there on social media. How about the person on the street in Brussels when you go out for lunch? How do they view the U.S. here? Is it getting down to a personal level?
There's really a lot of anger and hurt in a number of European capitals, and particularly in Brussels. You do get that from diplomats. You get that from people in the business community. I do think that there's a bit of a sense of betrayal, and this really does sort of shake the core of both an economic but also a political and military alliance and friendship that's dated back decades. And when it comes to trade and when it comes to all these arrangements, it's been a very prosperous one for both sides of the Atlantic. And there is a ton of concern about what this could mean, particularly as they watch with a lot of unease about the way Trump has been approaching affairs with Russia.
Well, and also, Canada. Talk about friends.
Yep.
Europe and U.S. is one thing, but Canada and U.S. is something also very different. All right, we really appreciate your time. Thank you very, very much. We'll be watching this laser-focused. Kevin Whitelaw is Bloomberg Brussels Bureau Chief joining us there. I spoke to the Canadian Energy and Minerals Minister when I was at CERAWeek, which is a premier energy conference in Houston, Texas. He was pretty outspoken. He's like, this is crazy. We're friends. You don't treat friends this way. Like, it was getting really worked up.
Yeah, again, it's all over social media. People really, not surprisingly, taking it very personally.
Right.
So that'll be interesting to see how that plays out from a policy perspective.
What's interesting in Canada is all the provinces can make their own export and tariff laws.
Okay.
So that's interesting to see, and you saw that with Ontario as well. All right, coming up, much more. Ann Barry will be joining us on what to do in this market. She's founding manager partner at Threadneedle. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. The major averages are mixed off the best levels of the session. The Dow, in fact, down 125 points, a decline of 0.3%. President Trump's 25% tariffs on steel and aluminum imports are taking effect this morning. That's led to immediate reprisals for the EU and Canada. The Bank of Canada cut its interest rate, citing the trade battle with the U.S. as a new crisis. In the U.S., consumer prices rose 0.2% in February, the slowest pace in 4 months, driven largely by shelter costs. It doesn't yet reflect anything related to the tariffs, though. Tesla leading gains in the mega caps right now. Tesla shares up 7.6%. And then you have Intel shares. They're among the most actively traded. They're up 4.3% right now. S&P 500 overall 29 points higher, again shaving some of the earlier gains, up 0.5% at 5601. The Nasdaq 100 239 points higher. That is up 1.2%. Mortgage rates in the U.S. dropping for a 6th week. The contact rate and a 30-year dropping to 6.67%. There's still over a 400 basis point spread in the Alex versus Paul mortgage index, however.
Yes.
Brutal.
You could drive it. You could drive a truck.
That's an actual index that I just created.
It's Alex versus everybody else. I think is kind of your point.
She got the low.
She got the
2.75, baby.
Yep. Awesome. All right. John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast Live. CPI data came in today. Month to month, 0.2%. The consensus was 0.3. That number was 0.4 last period. So that's pretty good. Michael McKee's going to tell us how good, or don't worry about it. International economics and policy correspondent for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Mike, how did you view the CPI print, and how do you think your friends at the Federal Reserve are going to view it?
Sort of backs up the stasis that the Fed is in right now. It was better than expected, but the core is still above 3%, and their target is 2%. So modest progress. Doesn't suggest they need to raise interest rates. Takes that kind of lean out of the policy theory, and then it seems like they can leave things as they are as they wait to try to find out what's going to happen with the tariffs. What's the impact going to be?
Talk about the impact. Bank of Canada. They cut rates by 25 basis points. Was this a surprise, or was it the why behind it? What did you make of that? It
was expected, and they have seen more progress on inflation than we have, but they've also been more aggressive. This is the 7th rate cut for them. But in their statement today, the governor, Tiff Macklem, went to great lengths to talk about how the Trump tariffs are going to hurt the Canadians. It's too early to see the impact yet, he said, but the surveys suggest threats of new tariffs and uncertainty are already having a big impact on business and consumer intentions. Canadians are pulling back on buying, and businesses have lowered their sales outlooks, and businesses are talking about raising prices. So they are very worried about what's going to happen, and so you can understand some of the retaliatory talk coming from north of the border.
When the tariffs are felt in this economy, where do you think we'll see it in the data that the government releases? This, and we'll see it in...
Yeah, it will take time to filter through in different categories. We should see, we may even see tomorrow in the PPI some steel and aluminum price increases because companies, based on the idea that they were going to get tariffs, have reportedly been raising prices. So we'll see if there's an impact there. And then you'll see it in the producer price indexes down the road sooner than you'll see it in the consumer prices, because consumer prices are going to go through the middlemen, and it takes a while to get into the overall numbers. Some of it's absorbed along the way, whereas the producers are basically paying the freight off the top.
But, you know, when I was talking to a lot of execs at CERAWeek, that energy conference, so I realize everyone's talking their book, but one of the themes was like, look, I contract pipe like months and months in advance, like if not years, right? So I'm not exposed to the spot market fluctuations in the same way, which is a fair point. A lot of them are also saying they get it from Europe, particularly for, say, infrastructure pipes, because they're really, really big. And I was like, okay, just wait, because I think that those tariffs are coming. But the idea that a lot of this is contracted, so the immediate effect might be a little ways down the road.
Well, you have that throughout the economy. Agricultural commodities are certainly hedged way into the future, and big users of energy are always hedging their energy supplies. So it does take a while to feed into the overall economy. Where you'll see the hit, though, more is small and medium-sized enterprises who are basically just, I don't want to say, the term wouldn't be living paycheck to paycheck, but it would be, buying the supplies as they need them rather than stockpiling stuff in advance. So that's going to hurt a lot of people. There are a lot of even retailers who buy low price goods from China or goods that are shipped through Canada and Mexico, and their costs will go up fairly quickly. So you'll see the mom and pop stores hurt before the big energy companies or steel companies. Yep. And it's important to note that American steel companies are going to raise their prices.
Yep.
That's the whole point of tariffs.
No, they're excited. Like the steel and aluminum guys are going to crush. Like they're like, yay, this is great.
Exactly. All right, Michael McKee, thank you so much. We appreciate it. Michael McKee does all the economic stuff for us here at Bloomberg. We appreciate that. What do you do in these markets? Public, private? Maybe privates are a little bit more attractive these days given the volatility in the public markets. Our next guest thinks about that stuff. Ann Berry, founder and managing partner of Threadneedle. She joins us live here in our Bloomberg Interactive Broker studio. So, Ann, I see in your notes here that this volatility is why you've retreated from public equity in general for a bit.
Yep.
And you've discussed that before. Now you spend a little bit more time in a private world. Where are you seeing opportunities in private equity?
Well, there's two sort of areas I think quite interesting. And I was actually talking to one of your colleagues here at Bloomberg about it recently. It's something I call correction capital. And if you go look specifically at the 2021-ish vintage, both in private equity, there are a number of deals done at very frothy multiples with enormous amounts of leverage relative to prior levels because debt at the time was so cheap. A lot of those businesses are going to need refinancing because rates have stayed higher for longer. That's an opportunity for fresh equity and fresh private credit to be put to work. Also on the venture capital side, as we all know, a ton of companies that raised capital in 2021 are starting to hit the cash wall. They're out raising again. They're doing it at much reduced valuations. Another opportunity there. So across the private spectrum, 2021 as a particular vintage is turning out to be a pretty fertile hunting ground.
What about the macro concerns, though? Like, how does that distort valuations for the good or better for private credit, to be honest?
Yeah, so on the private credit side, I think there's some overarching tailwinds. Yes, nobody likes tariffs. Nobody wants uncertainty around US GDP growth. But I think the timing piece here almost overrides some of that. Spreads have been compressed in private credit, but there's still a lot of good businesses out there that do not have optimal capital structures, providing a lot of deal opportunity. So when I think about it on a risk-adjusted basis, do I want to put my money to work in, to my mind, still overpriced equity markets, or do I want to sort of bunker down and get secure yields? That's sort of where I'm looking at the moment.
So when you talk to private equity providers, private credit providers, has their outlook changed in the last 3, 4, 5 weeks as this tariff rhetoric and the volatility in the public markets has become more prevalent?
I think there's chatter is sort of a couple of fold. Number one, we've sort of seen this before, right? If you go back to the last administration, remember executive orders, tariff instructions were coming out a mile a minute at the beginning of that administration. It did, though, calm down. Right. And once it calmed down, private equity deal activity was pretty robust for the duration of that administration. The expectation is that continues. The second piece of this, though, is there is, I think, anticipation that when the dust settles, deregulation is going to happen, and it's going to happen in a much stickier way than it had before in places like energy, in places like financials, and in places like technology.
So speaking of energy, again, shameless plug, I was down in Houston, Texas, talking to a bunch of CEOs. The behind-the-scenes convo was that everyone is pressing the pause button. Like, projects aren't being pulled, but no one's putting down more money, more projects. Everyone's literally wait and seeing. How does that affect the private credit market?
Well, I think for energy is a little bit different. I think
this was broad. I mean, it wasn't just oil. This was pretty much across the board in any kind of energy tangential project.
Well, I think private equity is, if we've got to think about it, is extremely tied. Private credit is tied to what happens in private equity. And so even, in the last 5 days, I mean, look at the Sycamore take private of Walgreens, right? A $10 to $23 billion deal is a sign that private equity is most definitely not pencils down, right? Where it will find opportunity, it will move. The other thing too, Alex, I would say, while people are not necessarily saying, let's push go now, the bigger force at work is there's $2 trillion of private equity dry powder sitting around the globe. LPs who invested over the last 5 years are saying, if you want to see my money in your next fund, I need to start seeing some distributions. And you've got a maturity wall coming up, 25, 26, and in 2026, that's an enormous proportion of the credit that's sitting out there. People have to deploy this.
It's interesting. I think, right around the election, I think the private equity, private credit, investment banking world was saying, all right, game on, animal spirits back. We're going to have a robust M&A environment, maybe less regulation from some of the Federal Trade Commission, the DOJ, maybe a lot more IPOs, get some liquidity for those private equity sponsors. Boy, things have changed in just the last couple of months. Or have they?
Well, look, yes, the tariff outlook has changed. The growth outlook has become more questionable. But here's what hasn't happened. No one's saying, oh, we think that M&A regulation is not going to get easier under this administration. No one is saying, oh, we think there isn't going to be more spectrum being sold, for example, when it comes to telecoms. No one is saying, oh, we don't, we think there's going to be, there won't be a more favorable tax environment. So again, I think now we've got this volatility, now we've got this noise. It feels as though President Trump is sort of testing the waters with all these different policies that are being thrown out a mile a minute, seeing what the reaction is. But at some point, when the dust settles down, do I think this administration goes in with a scalpel to regulation still, and that prompts deal activity? Absolutely.
So what kind of areas you think are best primed? Everyone seems to still love financials, right?
Yeah.
Where in private credit, either on a business level or sector level or regional, like what makes sense?
Well, I think when it comes to financials, if we look at the public side of it, I do think there's opportunity for the big banks who are facing, when the time comes, an end to the speculation around what's going to happen with Basel requirements and capital requirements, what happens with, the globally, systemically important banks. There is excess capital, if you believe there's going to be deregulation, sitting on these banks' balance sheets that, could lead to mid-teens plus increases in EPS just by the release of that capital by the end of sort of 2027. On the private credit side, I do think there's an opportunity in particular in industrials. You've seen a lot of stress around industrials, there's certain kinds of healthcare services, outsourced businesses is another place, where inflation has been difficult because you saw margins compressed with labor increasing. So I think there's opportunity across the board.
All right, Anne, thanks a lot. Really appreciate it. Anne Berry joining us. Great to see you in studio. I don't know if I've ever seen you in person.
In a minute. Yeah. I'm shorter than you think.
Okay, yeah. All right, fair enough. Yeah. Anne Berry, founder, managing partner at Threadneedle. My brain has like a 24-hour lifespan, so that's probably it.
Yeah, well, you've been doing oil and gas nonstop the past 3 years.
I know, isn't it so cool?
Wasn't that fun for you?
Oh my God, it was so fun. It's the only place in the world where, I maybe am a little bit of a celebrity. Maybe tiny bit.
Well, we saw you. You got every CEO there you got an interview with, so it worked.
All right, coming up, we're going to head over to Brussels. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages, they have turned mixed right now. The cooler than forecast February inflation pushed the S&P 500 and the NASDAQ 100 higher after a couple of days of heavy losses. They're pairing those gains right now. S&P 500, you have 4 of the 11 major industry groups up. Information technology, communication services, and consumer discretionary. Right now, they're in the lead. Tesla was the leading gains among the Mag 7 stocks. The electric vehicle maker rising for a second day after that rout that we saw on Monday. Shares of Tesla right now up 5.7%. And then Intel is getting a boost on the report that TSMC is pitching a foundry joint venture. Intel shares up 3%, we'll call it. And right now, the S&P 500 just 6 points higher. That's up 0.1%. 55.78 on the index. The Dow Jones Industrial Average down 259 points. The NASDAQ 100 up 130 points, and that is a rise of 0.6%. I don't know. What do you think about this? Heinz is introducing
big fan
chip dip. So it's ketchup, but the ketchup bottle is going to have a wide mouth jar, so you can dip potato chips right into the bottle of ketchup.
Genius.
No,
I don't know.
That's
I don't know. I'm not on board with this. I mean, it's
even salsa doesn't. I mean, salsa has a wide thing, but you still pour it into a bowl.
But it's like just a promotion.
What this thing looks like.
They're not gonna. I don't think it's gonna be a permanent thing, but we'll see. Whatever.
Okay.
We check the markets and all the other stuff for you right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash.
All right, JT. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We broadcast to you live from our Interactive Broker Studio right here in Midtown Manhattan. You can also check us out on YouTube.com as well. All right, yesterday, the U.S. and Ukraine have reached a 30-day ceasefire with Russia. Now it hinges on Russia's acceptance. While speaking to reporters at the White House, President Trump addressed that deal, saying it's now up to Russia to agree.
Ukraine has agreed to it, and hopefully Russia will agree to it. We're going to meet with them later on today and tomorrow, and hopefully we'll be able to wipe out a deal. But I think the ceasefire is very important. If we can get Russia to do it, that'll be great.
All right, joining us now is Oliver Crook, Bloomberg Europe correspondent on these talks. He joins us from Berlin. All right, Oliver, what do we know? What is the state of play?
Yeah, so listen, this is a ceasefire agreement, we should just say, cannot be agreed to by only sort of one set of parties. But we should say that the Ukrainians now finally got on board, and that is not what they wanted to do even 2 weeks ago, right? We were hearing from Zelensky and a number of top Ukrainian officials before that massive blow-up in the Oval Office, saying that basically they do not want to come to a conversation about a ceasefire. They want to come to a conversation about lasting, just peace. That obviously changed after the United States paused its military equipment deliveries to Ukraine, stopped giving them intelligence, all that sort of thing that kicked off last week. And now they've come to the table, and it sounds like they have agreed with the United States after those talks in Saudi Arabia with Secretary of State Marco Rubio to that 30-day ceasefire. The U.S. sees this as basically trying to create the conditions under which you can negotiate that permanent peace agreement. This 30-day ceasefire would also include an exchange of prisoners of war, release of civilian detainees, the return of the forcibly transferred Ukrainian children, and really to put together these negotiating teams, which haven't obviously had any contact between Russia and Ukraine since the beginning of the war. And that has led to the immediate resumption now of of American military kit to Ukraine, as well as intelligence. And, has been just basically the United States and Ukraine. And now, as you were just saying, basically everything is in Putin's court right now as to whether or not he's going to even entertain these discussions.
And to that end, Oliver, Bloomberg News has some reporting out that Putin eyes way to truce terms, but with his own conditions. I'm not really sure what that means. So maybe the broad question is, A, do we think Putin's going to engage in this process right here and now with this agreement? And what do we think he wants?
I suspect not just right here and now. I mean, I think that forever, since the beginning of this war for the last 3 years, time has been on the side of the Russians. So they have really in no rush, particularly since they've sort of gained momentum on the battlefield. Again, that could mean a great many things. We've heard a number of things from the Russians. They have said a number of things that are basically non-starters. They want to take basically all of the eastern regions of Ukraine. So that's Luhansk, Donetsk, Zaporizhia, and Kherson. These are not even territories that they fully occupy right now. So this would mean even further concessions. They would want legal recognition of that. They would want Ukraine to basically abandon its aims to join NATO. They would say that also European troops as sort of deterrent or peacekeeping forces with Ukraine are non-starters. So these are all things that the Russians have said in the past, that they basically are non-starters to any sort of agreement. That begs the question of what really is in the interest of the Ukrainians, or is this just going to be basically a pretense for the Americans to abandon Ukraine if they say, they basically cannot surmount the terms. What I think is interesting, and this was probably the most interesting thing we got out of the press conference from Marco Rubio yesterday, saying that basically they hope that the Russians will sign the deal, but if they do not, they'll know who the impediment to peace will be. That then provokes this question, and we don't really know the answer to this from the Trump administration. If the Russians refuse to come to the table and the United States is dissatisfied about it, what is Trump prepared to do about it? We've had some talk about potential financial market regulations and potentially sanctions on banks and finance, as well as fossil fuels. We haven't really fleshed out that side of things. We know the sort of the difficult circumstances they're willing to impose on Ukraine, but less so what they're willing to impose upon Russia.
Does Europe have a seat at this particular table?
Emphatically not. So I think the best that the Europeans can basically hope for is to get kind of an update at the G7 foreign ministers meeting that's happening right now in Canada. But basically, no, they do not have a seat at the table as it stands. I mean, I think that the U.S.'s plan, what they would like to see longer term, is the Europeans to take more security responsibility, obviously in the continent, possibly in Ukraine. But again, this is a very thorny discussion, even for the most hawkish voices within Europe. You hear it from the Polish. They are very reticent to ever commit any kind of troops, even as peacekeeping forces within Ukraine. So that is sort of a very difficult conversation to have, even nationally. So I think that their sort of role in this has been sort of ever diminishing, and I suspect is not going to increase anytime soon.
Oliver, what are the prospects for, and maybe timing of, a potential meeting between Mr. Trump and Mr. Putin?
Yeah, so listen, I think that Trump would like to see this happen sooner rather than later. I think, again, Putin is proceeding with sort of extreme caution. They've got all this sort of groundwork sort of laid for it. They would like, we know, to have that meeting, or Trump would like to have that meeting in Saudi Arabia. At this point, though, I think it's way too early to tell when that could happen. We do know from our reporting that Steve Witkoff, who's actually technically the sort of special envoy for the Middle East, but seems to be the kind of special envoy for ceasefires, generally speaking, he's going to be in Moscow later this week to sort of get the ball rolling there. But again, I think it's a little bit too early to say, to give a timeline on that at this precise moment.
Where are we in ramping up defense spending in Germany?
So listen, I think this is going to be this was the kind of the bazooka that was dropped the other week by the leader of the CDU, who's going to be the incoming chancellor, Friedrich Merz here. They were talking about basically reforming the debt brake, and that is a huge deal here in Germany. The debt brake is something that's not just a law within Germany. This is part of the German constitution. They put it in 2009 after the financial crisis. What's interesting is Merz ran on a platform basically saying that they will not reform the debt brake, and then 5 days after basically winning the election, and not winning sort of a decisive majority, winning just sort of the biggest proportion within parliament, said that they're willing to sort of reform the debt brake. That comes with its own issues within Germany at the sort of national level. I mean, you have the AfD, the far right, that has been basically accusing a lot of the sort of German politicians to be acting undemocratically. What they are now trying to do is force through this debt brake reform, which requires 2/3 of the parliament with the old parliament, despite the fact that they had an election, in order to get this money through. And listen, the market was very, very pleased about this in many respects, and this was priced in basically all the way to the market. And then there was some doubt about whether or not they're going to get it through. It seems they're going to be able to get the compromise in the lower house in the Bundestag, but it is not necessarily a done deal that they're going to be able to reform the debt brake to get all that defense spending done.
So when do we get clarity out of Germany there on this story, Oliver? Because that obviously is a big move.
Yeah, we should get it over the next couple of weeks. Right now, where it's basically stuck is at the Bundestag, where the Greens, they need to get the Greens on board in order to reform this at the first sort of step. The Greens have kicked up a bit of a fuss because they've lost basically a large proportion of their representation in the next parliament, and they want to put their stamp on things. I suspect they'll be able to get through that. But then there is the sort of the Bundesrat, which is the upper house. I don't want to get too into the weeds here of German politics, but then you need to get sort of a lot more complex arithmetic. So we will get clarity of this over the next couple of weeks. But if they can't get this through, this would be an absolutely massive blow. Of all the sort of talks we've had about defense spending and stuff that they're doing at the EU level, this was by far the most significant thing we've seen out of European defense. And we've seen it priced into a lot of the stocks and a lot of the companies. Rheinmetall put out their earnings today. This is the biggest sort of defense contractor here within Europe. They're expecting 25 to 30% growth in sales just this year. That could boost even higher if they get this through.
Yeah, I mean, we're talking almost 1 trillion euros. And a chunk change at the end of the day. Oliver, thanks a lot. Really appreciate it. Oliver Crook joining us. He is Bloomberg Europe correspondent. Well, in case you didn't know, I was in Houston, Texas over the last day and a half, speaking to many energy CEOs and officials and Secretary of Energy, Secretary of the Interior. It was really great. We got a lot of stuff going on there. I did sit down with a conversation with One Oak President Pierce Norton. So One Oak is a major U.S. midstream energy company, which means they transport stuff like natural gas, NGLs, that's liquefied stuff, and crude oil all across the U.S. energy corridor. So I asked him, like, can you actually build? Can you build, baby, build, if we're going to have tariffs on aluminum and steel?
What I would give some stats behind that is in 2007, when the shale revolution started, there was about 20 TCF a year of gas flowing in the United States. Last year it was
Trillion cubic feet a day.
Trillion cubic feet a day. Now it's 42 trillion cubic feet a day. So we've doubled that just since 2007. That took a massive build out. We've proven we can do it before, and I think we can do it again.
What do you need to see, though, from the administration? Because it's permitting, it's now tariffs, it's now, putting a pipe in the ground, it's avoiding any lawsuits, interstate.
Right.
Like, what do you need to see to get it done sooner rather than later?
Well, I think it's anything that actually accelerates, the permitting. Is a help to us. But we have a slogan at One Oak that, we don't pick sides, we pick issues. And if the issue is getting energy as quick as we can, then we need to focus all aspects of that, not just on the administration, but what is it that we can do as an intrastate company, an interstate company, and what is it we can do as an industry.
Aside from permitting, if we get aluminum and steel tariffs of 25%, what kind of headwind is that for build out?
Well, it's a timing issue. For us, we've already built out most of our assets. We spent $10 billion since 2017 in building out growth projects, and then we spent another $25 billion in mergers and acquisitions. So we've kind of gotten past that. So on the pipe, it's a timing issue. It's where are you in the process of either trying to negotiate a deal, or are you already putting it in the ground? In our case, you're already putting it in the ground, so it's not going to have a material impact on us.
To that point, your CapEx spend has ramped a lot as you're doing all those projects.
Right.
When is your peak CapEx?
Probably not until the next couple of years.
And what does that wind up looking like? Because that's a big spend. How do you reassure investors that it's really going to end there and what that looks like?
Right. It's probably around $2 to $3 billion a year. But given our size, we're now a $60 billion market cap company. We added from 40,000 miles of pipe to 60,000 miles of pipe. We cover 23 different states. We go all the way from the wellhead to water, and also all the way to basically the trucks that bring the refined products, the jet fuel, the diesel, the gasoline, to the end user.
When do you think you would be more free cash flow focused versus investment focused? What does that turn look like?
We're already free cash flow focused.
Okay. You could be both, like all that investment cycle and
both.
Okay.
Yeah, and the reason is because if you have enough free cash flow, it opens up all levers, for capital allocation. Our first priority is to actually spend money on these high return projects. The second one is to look at the dividend increases. The third one is reducing our debts. You do all that, and you do all of that kind of stuff, and we've announced the $2 billion buyback program on our stock. We still have money left over from that. But our commercial people find a way to find those good projects for us. So I'm not worried about spending that in the right way.
If oil prices slide, they were at 6-month low yesterday. If natural gas prices slide, does that hurt you? How does that affect that
Well,
cash flow?
what we've seen is that the producers are way more resilient than they used to be. Used to, when prices would go up or down a small amount, they would either throw rigs, at the issue, or they would lay rigs down. Now that gap seems to be a whole lot wider, and part of that is because they're much more efficient than they used to be. They can drill longer laterals, especially where we are really concentrated up in the Permian Basin and the Bakken Basin. They're drilling, they used to drill a 2-mile horizontal lateral. Now it's almost 3. So they can do it for less capital.
I love that you brought up the Permian because we heard from Mike Wirth yesterday of Chevron that the Permian eventually is going to plateau in the next few years. Do you see that on a takeaway capacity basis?
Well, I've been in this business for 40 years. And one of the things that I've seen is every time you predict something like that, usually they find a way of even becoming more efficient, so therefore opening up more drilling, so you got your probable reserves, you got your possible reserves, and then, but your proven reserves are what they're really after. So I would question, Mike, and see what is it that is he talking about proven or probable reserves? Because they have different pricing points.
Mm-hmm. When you take a look at the kind of infrastructure build out that we're seeing, and I know that you're already putting pipes in the ground, what do you think we need to move stuff in the next 5 to 10 years? Like, what stuff are we going to be moving around?
We're going to move all kinds of molecules. What people typically talk about is natural gas, which in our business we call methane. But we're also going to move molecules for ethane, for the petrochems. We're going to move molecules for propane, which we just announced a dock down in Texas City with our partner Marathon to provide propane all over the world scale dock. We're going to be moving isobutane, normal butane, gasolines, and in our case, we move jet fuel, we move gasoline for cars, and we also move diesel fuel. So all of those molecules, there will be more of those to move in the future.
In your line of sight with those molecules, any signs of a recession in the U.S., slowing economy, slowing demand?
So far, not.
Not.
Yeah.
Definitive not. From
like
Pierce
that. Okay.
Norton, One Oak president and CEO. Of course, it's a major U.S. midstream energy company, so they transport all the stuff. Now, the big issue here, not to nerd out on you here, is that in order to make all of this happen, and I mean all of this, like power demand, data centers, you name it, you need pipelines and stuff. You need transmission lines, which means you need permitting reform. And I know that people's eyes glaze over when you hear that, but it's a mess.
Now,
and
is this administration, does the industry have expectations that this administration will be better?
Yes, but will it stay better? Will it be permanent? Permitting reform, or will it be small tweaks? Because to get permitting reform and get all of the potential lawsuits from states taken care of, all your pricing, all your sourcing, and pipe in the ground in 4 years could be very much impossible. So you need permanent reform in order to make it happen. That part, I think, is a little bit TBD.
What has changed, though, is the reasons we need this energy. And I think that being AI, which most people don't know what AI is, and I might throw myself into that camp, but I know it's a thing, and I know it's generally net positive, and it's a strategic imperative for the United States. Therefore, in order for me to be a leader in AI, I have to be a leader in or a supporter of energy.
Yes. And I spoke to some of the big power players. So Constellation Energy, NRG, NextEra, these are all the guys. Like, their stock moves like AI stocks because they're the power providers, right? They were saying, though, that their demand growth that they've seen has nothing to do with AI.
Oh.
It's still cloud.
Okay.
It's still population growth. It's still just general demand. The AI is then layered on top of that. So these kind of forecasts, like the current money that they're making, has nothing to do yet with those data centers.
Interesting.
Which I found to be extremely interesting, that we're way in the first inning when it comes to beefing up that kind of demand.
What is the energy folks down here in Houston, what were they feeling about just the tariff discussion?
Oh my God, they love it.
They love it.
No, I'm kidding.
Yes.
Okay, so on the record, everyone was always talking about how that they're minimally exposed, it's de minimis, it's just, maybe 5% of their costs, it's no big deal. Off the record, no one loves it.
Yep.
And they also don't love the uncertainty. And as I was mentioning before, I asked particularly Patrick Pouyanné, who's the CEO of Total Energies, who is offshore wind projects, right? I said, are you throwing them in the trash? He's like, no, we're pausing. And I was like, why pausing? He's like, they're 30-year leases.
Yep.
This is a 4-year administration.
Right.
But pause is still a pause.
Yep.
And pause is still not putting capital into certain projects.
And when I think of energy projects, these things take time.
Long
and a
time.
lot of capital. So you have to have some level of certainty before you start putting all that money into the ground.
Absolutely. And the buyers have to too.
Yep. All right, good stuff. I mean, we got plenty more to go too, but I mean, it just goes to the issue of, the energy is just one of those industries that doesn't like uncertainty.
No.
Certainly the markets don't like it here as well.
See, Paul likes it now.
Yeah, I'm all in. Again, landman.
All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on SiriusXM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The second hour of Bloomberg Intelligence starts right now.
is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. I'm Alex Steele alongside Paul Sweeney. This is the second hour of Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks, and we have a great hour lined up for you. Speaking of, in just moments, Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, will be joining us on all the political stories of the day. There are a lot of them. Where are we with tariffs, particularly Canada and EU retaliation? Shayna Sizzle is President and CEO of Banrion Capital Markets. What does all this translate into when it comes to market reaction? We're seeing a rally today. Does it last? Is it just a relief rally? And Erica Edelberg, Bloomberg Intelligence Chief Mortgage-Backed Securities Strategist, will join us on housing and when Paul can refinance. But let's kick it all off for you right now with the Bloomberg Business Flash. For that, we go to Charlie Pellet.
All right, thank you very much indeed. U.S. stocks just dipping into the red. We have got the Dow and the S&P giving up earlier gains. Here's where we stand right now. We are looking at a 9-point drop right now on the S&P 500 index. The S&P down by about 0.2%. The Dow in the red by 0.8%, down 340 now. Nasdaq holding on to a gain, up by 70 points, higher by 0.4%. The 10-year at 4.28%, with the 2-year 3.95%. Gold up 0.3%, 29.23 the ounce. West Texas Intermediate crude up 2.1%, 67.62 a barrel. Brent at 70.78 right now. Brent, the global benchmark, up 1.7%. And a retreat today for Bitcoin, 81,390 now on Bitcoin, lower by 1.7%. Bottom line here, down days. So should investors be buying the dip? That question this morning on surveillance for Callie Cox, the chief market strategist at Ritholtz Wealth Management.
At this moment, if you're looking over the next week or month or so, I would get a little more defensive here. We're still trying to figure out what this policy story could look like. We're trying to figure out the extent of the job market damage. We got data today showing inflation is still quite tame. I just wouldn't try to be a hero in this environment.
Callie Cox of Ritholtz Wealth Management. You can hear more of the conversation on the Surveillance podcast, and you can download that wherever you get your podcasts. Tesla is urging Delaware's highest court to salvage Elon Musk's record-setting pay package after a lower court judge rejected it twice, taking his epic legal battle over tens of billions of dollars in stock options to the next level. We've got Tesla shares gaining today. Tesla up now by 5.1%. So again, recapping here, a dip into the red. Stocks lower now with the S&P down 14, down 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We are streaming live as well on YouTube, so head over to youtube.com/Bloomberg Podcast Live. That's where you'll find us, as Charlie was reporting here, red and green on the screen. Let's see where the action is under the hood. We go to Nora Melinda. She covers all the equity markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Nora, what are you looking at today?
Well, some action here in the market. I'm keeping an eye on Brown-Forman shares. They're falling today. This is after the EU is punching back with its own tariff plans against Donald Trump's 25% tariffs that he's put on imports of steel and aluminum that went into effect. Now, the EU is saying that it plans to establish countermeasures next month that will apply to products that range from boats to bourbon. So, of course, we know Brown-Forman is a whiskey maker. And so we're seeing shares of the company down about 6.5%. That's the biggest intraday decline that the stock has seen in almost 3 months, but we do see a lot of investors just a bit apprehensive as we're going back and forth with this tariff war. And if it could actually hit whiskey, of course, that would impact Brown-Forman.
Yeah, and Brown-Forman was one of the first companies, like in the third quarter earnings, who started to warn about potential tariff issues. So there is that as well. And I was talking to the Canadian Energy and Mining Minister yesterday, and he was like, Canadians are just mad.
Yeah.
Like at one point, they were surprised and bummed. Now they're just mad. So like boycotting products
just red.
wouldn't be a crazy thing to like speculate on to some extent. Is Tesla getting any love after, President Trump bought one?
So Tesla is getting a bit of love, rebounding for a second day, as you mentioned, after that news that President Trump was buying one of the Teslas there, I believe a red one, if I'm not mistaken. But this is all after Monday's 15% nosedive for the stock. And of course, we know this has kind of been a beaten down name if you think about the Mag 7. I mean, if you look at Tesla shares, they're down about 40% so far this year, and we're just here in March. But the stock is rising for its best day today since November, up as much as 9%. There's definitely some interesting stories out. We have my colleague Esha Day. She wrote a story. Even Musk fans are dashing for the sidelines with Tesla in free fall. We've been hearing a lot of analysts that are becoming a bit more critical of the stock. Earlier today, we had Carson Block of Muddy Waters coming on BTV, and he said that Musk is doing irreparable damage to the Tesla brand, but he doesn't necessarily bet. He doesn't want to bet against Elon Musk because he feels that he can pull a rabbit out of a hat at the last moment.
Well, I saw even Dan Ives, one of the biggest bulls on Tesla, came out with a tweet yesterday and just saying it's time right now for Musk to put his focus back on the company.
Right.
Wow.
Yeah.
That's interesting.
That's a really
groundbreaking.
pressing statement there.
I think, kept his buy rating, but he said, no, that real damage is being done. Now is the time to step back from politics and focus on his companies, from just speaking on behalf of stockholders. So.
Yeah. One last stock I'm looking at, keeping an eye on Intel. So we are seeing those shares climbing for their best intraday gain in 3 weeks, earlier up as much as 7%. Now, this is after news that Reuters reported that TSMC has pitched NVIDIA, Advanced Micro Devices, and Broadcom about taking stakes in a JV that would operate Intel's factories. So under this proposal, TSMC would run the operations of Intel's foundry division, but it would not own more than 50%, according to Reuters.
That would be interesting.
Very interesting.
I mean, it makes sense in the fact that, finding a buyer straight up for Intel, it seems impossible, right? Like, who would be able to pick that up? So this JV...
Yeah, that's interesting. That's creative. That's a
very
good
creative
investment banker type of idea from somewhere.
There you go. Look at that.
Yep.
Counting your people.
Right.
All right, Nora, thanks a lot. Norma Linda joining us from Bloomberg News with all of those stock movers. So the headlines coming fast and furious from everywhere when it comes to political risk. Joining us now is Nathan Dean. He's Bloomberg Intelligence Senior Policy Analyst. Nathan, what is the rhetoric that we're going to see out of the White House this afternoon based on now Canada putting tariffs on U.S. steel and aluminum and the EU threatening retaliation as well?
I think it's going to be very similar to the Truth Social post that we saw from yesterday from President Trump in responding to the Ontario Premier Doug Ford in terms of those tariffs, or at least the export taxes that he was putting on electricity to those 1.5 million Americans up in Minnesota and New York. And I think this is what you're going to wait. You're going to see this exactly the same thing coming from EU because, look, we've always been telling our clients when it comes to tariffs, President Trump goes out there with these big statements and then subsequently walks them back, negotiates, and it doesn't really see the fruition. However, over the last few days, we begin to see the small incremental tariffs take place. The 20% tariff on China, the metals, the aluminum and steel tariffs on Canada just yesterday. So these tariffs are now coming into fruition. And so I think the rhetoric is going to continue, but we always have to just go back to the idea that there's one person that decides whether these tariffs happen or not. It's President Trump. So you always have to just keep your mind open that he could potentially walk some of this back.
I've asked this before. I'll ask it again. And now it's on this issue of tariffs. Where are the Democrats? Who's the voice?
Yeah, so they're still trying to figure out their voice. I mean, obviously, there's been a lot of push in terms of from House Democrats trying to tell their Senate colleagues that they should vote no on this government funding bill that's making its way through Congress in response to DOGE, in response to tariffs, just in response to President Trump's agenda. The Senate Democrats are actually meeting today. They have to figure it out. There's going to need to be 8 votes for the Democrats on Friday because Senator Rand Paul is going to vote no. Otherwise, we're going to risk a government shutdown. And I just do not think the Senate Democrats have a strategy yet in place that warrants, what their response to President Trump will be. And as a result, a lot of the news cycle continues to be dominated by President Trump and his actions.
I have to say, the fact that we could have a government shutdown has not at all been on my radar.
Nope.
That seems like the last thing we got to worry about here when it comes to being a market participant. So, no, where are we, though? Will it shut down or are we good?
Well, your view is absolutely correct from the mindset of those who pay attention to the markets, because when it comes to government shutdowns, there's very little impact to markets. I mean, the 35-day shutdown that occurred under President Trump's first administration, markets went down and then subsequently came back up. But where we are at the moment is yesterday the House Republicans passed a bill. It's not a clean bill, but a clean-ish bill, mostly clean, but has a lot of things in there Democrats don't like. But what Speaker Johnson did is he said, look, we've passed the bill. He sent the House home. Everybody left town. So now it's up to the Senate Democrats to decide, are we going to support this bill, or are we going to risk shutting the government down? And because the House is gone, a shutdown will most likely occur. I think the Senate Democrats will ultimately take the deal. I may be out of consensus out of that, but I just do not think that the Senate Democrats right now are aligned on their strategy. And just as a few minutes ago, Representative Alexandria Ocasio-Cortez was tweeting out that people should be calling the Senate Dems because it looks like, in her words, they're going to start to cave. So, I don't think the government's going to shut down. But again, for those people who pay attention to the markets, there's really no impact here. I mean, a short-term shutdown really even doesn't impact the equities like large defense contractors.
What's the sense of timing, Nathan? When will we get a decision on a potential shutdown or what the Senate's going to do?
I think tonight you'll start to see the comments from the Democrats.